Central Bank of Chile invites you to the 26th Annual Conference, where we will focus on understanding the implications of climate change and ecosystem services degradation for macroeconomic and financial stability. This November the 27th and 28th in Santiago de Chile. 26th Annual Conference of the Central Bank of Chile.
Good morning, and welcome back to the second day of the Central Bank of Chile's annual conference. My name is Mariana Garcia Schmidt, and I will be introducing the sessions and also giving you all the announcements that we need today. We have here with us the program of today. Start today with session 3, which is entitled Climate Change and Biodiversity Loss as a Financial Risk. So we have here with us the chair of the session, Gloria Peña, who is the statistics director of the Central Bank of Chile, and the presenter of the first paper, Hye-Yoon Jung. So I leave you with the two of them.
Well, thank you very much for being here, and welcome to this session. We will have the presentation of two very interesting papers. The first one will be held by Hye-Yoon Jung. She is a financial research economist at the Federal Reserve Bank of New York. Her research interests are in international finance, financial intermediation, asset pricing, and climate finance. She holds a PhD in finance from NYU Stern, a Bachelor of Science in Economics from UPenn Wharton, and a Bachelor of Art and Science from UPenn School of Engineering and Applied Science. Hye-Yoon, you have the floor, and 35 minutes, please.
Okay, thank you. Thank you so much for having me. It's a great pleasure to be here. My name is Hye-Yoon Jung, and I'm excited to present my paper, Measuring the Climate Risk Exposure of Insurers. This is joint work with Rob, Sean, and Sharon at NYU Stern, and I'm at the Federal Reserve Bank of New York, so the usual disclaimer applies. So understanding the impact of climate change on financial stability is a very important question for researchers, financial institutions, and regulators alike. And insurance sector is one of the key financial sector sectors and insurance companies can be exposed to climate change risk through their operations, as well as their investment holdings. For instance, physical risk can affect insurance companies with higher than expected claim payouts, and transition risk can affect insurance companies' investments, for instance, in fossil fuel industry, as economies shift to less carbon-intensive environment. However, measuring the exposure of climate change risk is challenging for multiple reasons. So here are some of the major empirical challenges and how we try to address them. So first of all, analysis based on the past climate events may not capture the changes in the perception of risk, and this is because market expectations can change without a direct experience of climate change events, and also asset prices today can reflect the changes in the future climate risk, even if the damages are decades away. So we use a market-based methodology which allows us to fully incorporate changes in market expectations. And second, climate risk itself changes over time, and how firms, financial institutions, and market participants respond to the perceived risk also changes over time. So to this end, we estimate our model dynamically, allowing for volatilities and correlations to be time varying. And third, data gaps and timeliness have been pointed out as one of the major challenges, and our methodology only requires publicly available market data, and using market returns allows us to design plausible and sufficiently severe scenarios. And we estimate our model on a daily basis, so we hope that this measure could be a useful complement to other climate stress testing methodologies. In this paper, we use a market-based approach to assess the resilience of financial institutions, especially insurance companies, to climate change risk. And the methodology involves 3 steps. First, we measure the climate risk factor, and we construct a novel physical risk factor and test its validity in event study analysis. And once we have the climate risk factor, then we estimate time-varying climate beta of insurance companies. And the climate beta of each insurer will capture the insurance company's stock return sensitivity to the climate risk factor that we measured in the first step. And we estimate this dynamically, so we do not assume static balance sheet of financial institutions. And once we have the climate beta estimates, then we can compute systemic climate risk, which we are calling C risk. And the C risk is defined as the expected capital shortfall of insurance companies in a climate stress scenario. And we use this methodology, we applied this methodology to study large insurance companies' climate-related risk exposure. So here are the key findings. First, we measured P&C, property and casualty insurance companies' physical risk exposure. And we find that in a physical climate stress scenario, the 1% tail event, we find that the top 10 largest P&C insurers were having negative C risk, suggesting that they were actually having capital reserves rather than capital shortfall. But on the smaller insurer side, we find that their climate betas were higher, which suggests that the risk does not seem to be concentrated on the largest P&C insurers. And on the life insurer side, we measured life insurers' transition risk exposure. And we find that the life insurers' transition climate beta went up substantially during 2019 and 2020 when the fossil fuel prices collapsed. In terms of the magnitude, we find that the aggregate marginal transition C risk of life insurers went up by over $70 billion. This is about 13% of their market cap. This magnitude is somewhat lower than the banks, but still it seems meaningful. And in the last part of our paper, we did validation exercises, and we find that P&C insurance companies having higher operational exposure to risky states or having higher physical climate beta, and life insurers having high corporate bond exposure or having higher transition climate beta, which add to the economic validity of our measures. So let's start from the physical climate risk factor construction. So in the paper, we have multiple physical risk factors, but let me introduce the simplest version using a portfolio of P&C insurance company stocks specifically designed to fall as the physical risk goes up. So specifically, we merge data on P&C insurers' direct premiums earned, and we merge that with the data on property damage following natural disasters from shelters at the state year level. And for each year, we compute insurer-specific realized risk, which is defined as this formula, where the risk is the weighted average realized damage in the past year. So this term, it's not working. Okay, so the left-hand side term is the exposure to state S, and it's multiplied by the riskiness of the respective state, which is proxied by the property damage happened in the past, the previous year. And we scale it by the market equity to incorporate the size factor. And once we have the risk measure of each insurers for each year, then we form a portfolio of P&C insurance company stocks weighted by the risk. And we tried variations of the risk measure. We tried using the standard deviation of the property damage instead of the last year's property damage. We also tried subtracting the direct premium earned to think about the net damage after considering the premium earned. And we also tried using the loss to equity ratio, which is a little more direct than this approach, and we find that they are highly correlated. So this is how we argue that the physical climate risk factor works. What we did was we regressed the constructed physical climate factor on the shock dummy variable, where the shock dummy variable takes a value of 1 if it was the start date of the natural disaster event and 0 otherwise. And what you see here is the cumulative coefficient gamma over time. 0 is the first day 1 of the disaster. And you can see that as expected, the climate risk factor falls over time. And around day 12, the coefficient is significantly negative. And we were thinking that the response is somewhat slow, so we tracked what's happening in the newspaper articles. And first of all, what you see here is the average number of New York Times articles over time. The 0 is, again, the day 1 of the disaster. And you can see that around day 12, the number of the coverage goes up. So it seems that the attention, it takes time for the attention to go up. So that suggests that the news articles respond to natural disasters with a few days of delay. And also in terms of the content, what you see are the headlines around the Hurricane Katrina, which was one of the most damaging hurricanes in the United States. And on the day 1, the headline was saying that a blast of rain but little damage as hurricane hit South Florida. Only after day 12 or so, there was discussion of the damage and also the relief. So the natural disasters impact are often not immediately clear, and we think that this could be a reason why we're seeing somewhat slow response here. And we also tried using another factor based on true cost physical risk scores, and we find that the responses are quite similar. So once we have this factor, then we can compute the insurance company's climate beta and the C risk. So let's start from the P&C insurer's physical risk exposure. So to estimate the physical climate beta, we regress the P&C insurance company's stock return on the physical climate factor we just constructed and the market factor as the second factor. And we estimate this dynamically. So the beta is going to be time varying, and calling the loading on the first factor the physical climate factor. And what you see here are the top 10 US P&C insurance companies' physical climate beta. And although we do not find any secular trend here, we find that the climate betas were higher during the global financial crisis, and we see some interesting divergence going on in the recent time. And I'm going to explain these variations in the climate beta by using the data on insurance companies' operational exposure across the states, and that's coming in the later slides. And once we have the climate beta estimates, then we can compute C risk. And the C risk is defined as the expected capital shortfall conditional on climate stress. And the C risk is a function of D, which is the book value of debt of the insurance company. And W is the market cap of the insurance company. And long-run marginal expected shortfall is expected equity loss conditional on the climate stress. And K is the prudential level of equity relative to assets, and we set it as 8%. And lastly, theta is the climate stress level, and we calibrate it to 20%. And this is because negative 20% is the 1 percentile of the 6-month return distribution of the physical climate risk factor. So just to recap, this climate stress scenario that we're considering is the 20% decline in the physical climate factor over the 6-month time period. And the beta from the previous step goes into the long-run marginal expected shortfall term there with the theta. And here are the estimated physical C risk of the US P&C insurance companies. Because the C risk is defined as the expected capital shortfall, the positive numbers mean the shortfall, and the negative numbers can be interpreted as excess reserves. And these are the top 10 largest US P&C insurance companies' C risk. And you can see that they are mostly negative, which means that they actually have excess reserves rather than shortfall. So that's because these are the largest ones. This suggests that the risk does not seem to be concentrated on the largest insurance companies, and this is different from the banking sector. On the banking sector side, we find that the largest institutions were having the highest C risk. And let's move on to the life insurer side, and the potential mechanism we have in mind is through the life insurance companies' asset holdings. They have a lot of corporate bonds, and we thought that brown corporate bond exposure can affect the life insurance company's transition risk exposure. So to estimate life insurance companies' transition risk exposure, we follow the similar steps. We first estimate their climate beta. So again, we use the same framework. We regress the life insurance company's stock return on the transition climate factor now with the market factor. And for the transition climate factor, we use the stranded asset factor we used in our previous paper. It's capturing the relative performance of fossil fuel industries relative to the market. So that's the transition climate factor here. And you can see that the climate betas were pretty much 0 until 2019, and there was a substantial rise in the climate betas during 2020 when the fossil fuel prices collapsed. And this is quite similar with the banking sector as well. Once we have the climate beta estimates, then we can compute the transition C risk of the life insurance companies. And these are the top 10 largest US life insurance companies' C risk. And you can see that some of the life insurance companies were having positive C risk during 2019, 2020, but a lot of them had negative C risk. Okay, in the last part of our paper, we do 2 validation exercises. First of all, we test whether life insurance companies having a lot of brown corporate bond were having higher transition climate beta. So to test this, let's think about life insurance asset side. They will have corporate bond portfolio. Some of them will be for the brown industry. Some of them will be on the green industry. And to characterize each industry, we regress industry stock return on the same transition climate factor and also the market factor, and we obtain the time-varying transition climate beta for each industry. And once we have the industry-specific climate beta, then because we observe life insurance companies' corporate bond holding, the composition of the portfolio, W, we can compute insurer-level bond portfolio beta. And just to give you a simple example, if a life insurance company was having half of its corporate bond portfolio in the brown industry and half of the portfolio in the green industry, and if the brown industry has transition climate beta of 1, and if the green industry had the transition climate beta of -1, then this insurance company's portfolio beta is going to be 0. And we compare the portfolio beta computed in this way with the climate betas you saw earlier from this plot. And that's what you see in this bin scatter plot. What I'm plotting here is the bin scatter plot of the insurer climate beta based on the market approach on the y-axis and the portfolio climate beta on the x-axis. And the x-axis is computed from this methodology. And this is based on the US insurers' asset holding data for 16 publicly traded insurance companies for this time period from 2000 to 2020. And you can see that the relationship is positive. So this suggests that life insurers' transition climate beta reflects what they are holding on their asset side, the corporate bond portfolio composition. And we tested this idea formally by running regression. We regressed the market-based climate beta on the portfolio climate beta, and we find that the coefficient is positive and significant, even after including insurer-level characteristics as controls. And moving on to the P&C insurers' portfolio beta, we take a very similar approach. But now let's think about P&C insurance companies' liability side. So on the liability side, they're going to have insurance policy portfolio, and some of them are made to the risky states. Some of them are going to be made to the safer states. So here we test the hypothesis that P&C insurance companies having greater exposure to the risky states were having higher physical climate beta. So to test this idea, we needed to characterize each state. And to do so, we used municipal bond returns. So for each county C municipal bonds, we regress their municipal bond return on the same physical climate factor. And we run this at the weekly level, and we use the repeat sales methodology to account for illiquidity of the municipal bond market. And once we obtain each county's climate beta, then we aggregate to the state level by taking the 99th percentile of the county level beta as the state level beta. And this is because we think that if a state has highly positive beta and highly negative beta, and they don't really cancel out, so we take the largest one as the state level beta. And because we observe the composition of the policy portfolio across states, that's the finest granularity we could get. And because we observed that W, we could aggregate the state level climate beta to the insurance company level. And that's what we are calling policy portfolio beta. And again, just a simple example, if a PNC insurance company is having half of its policy portfolio in a risky state with beta equal to 1, and if it is having half of its policy portfolio in safer state with beta of 0, then its policy portfolio beta is going to be 0.5. And again, we are going to compare the policy portfolio beta with the market-based beta you saw in the previous slides. And here's the bin scatter plot. What you see is the bin scatter plot of the 21 insurance companies over 2000 to 2020. And the market-based climate beta is plotted on the y-axis, and the policy portfolio climate beta is on the x-axis. And again, the relationship is positive. So this suggests that PNC insurance companies' physical climate beta reflects what they are having on the liability side, specifically their policy portfolio exposure across the states. We tested this idea formally by running regression again. We regressed the market-based climate beta on the policy portfolio climate beta, and the coefficient is positive and significant. So to conclude, in this paper, we measure climate risk exposure of life and PNC insurance companies in the US using a market-based approach. And we find that large PNC insurance companies were having relatively low physical C risk, but smaller PNC insurance companies were having higher climate betas. Taken together, we find that the risk is not concentrated in the largest PNC insurance companies. And on the transition risk side, we find that the aggregate marginal transition C risk of the life insurance companies went up over by $70 billion following the collapse in fossil fuel prices during 2019 and 2020. And based on the validation exercises, we find that the market-based physical climate beta reflects PNC insurance companies' policy portfolio composition, and the market-based transition climate beta reflects the life insurance company's corporate bond portfolio composition. So this concludes my presentation, and I can use the remaining time for questions, and I look forward to the discussion. Thank you.
Thank you, Hei-Yun. Now we will have Catherine Wagner that will comment the paper. Catherine, she is an assistant professor of economics at the University of British Columbia and a research affiliate of the CES IFO network. Before joining UBC, she was an assistant professor at UC Berkeley in the Department of Agricultural and Resource Economics, and a postdoctoral fellow at the Stanford Institute for Economic Policy Research. Her research focuses on environmental and energy economics and public finance. She holds a PhD in economics from Yale University, a master in economics from the University of British Columbia, and a bachelor in economics and accounting from McGill University. Catherine, you have 15 minutes for your comments. Thank you.
Great. Can you hear me okay?
Yes.
I have this vision of my face taking up the whole screen in the conference room. Thank you very much for that introduction. I think that was almost as long as my presentation will be here. It's a pleasure to be here. I would love to be there in person, but joining today from Vancouver to discuss measuring the climate risk exposure of insurers. And we're advancing. So I won't spend too much time going over the paper just because I think that was a very clear presentation, and the paper as well reads very clearly. So the title of the paper really reflects what it's about. How much are insurers focusing on the US exposed to climate risk, where the methodology is going to be more broadly applicable. And the paper is super well motivated by the increasing cost of natural disasters, which may threaten insurers that are more exposed in the different ways that the paper discusses. So they're going to construct forward-looking market-based measures of physical and transition risk, where there are two key contributions coming out of this definition: forward-looking and the market-based parts of these new measures, which are also newly applied to the insurance sector. And as Huyen discussed, there are two primary findings of the paper. The first is that insurers with high physical risk exposure experience a decline in stock returns following natural disasters, and then insurers with high transition risk experience an increase in climate beta during the fossil fuel price collapse. So I'm going to make three main comments here, and then a few smaller comments, and I'm very happy to hop on a Zoom call later to discuss further, since we won't be able to chat during any of the breaks in the conference. So my first comment is related to how climate risk is defined in the paper, or more specifically how climate risk exposure is defined in the measures that you're using. So as we saw, climate risk exposure is going to be defined here based on observed property damages in the previous year in the primary physical risk measure that the paper is going to use. The other is going to be based on insurers' claims for the 2000 to 2023 period. And so I reproduced this equation from the paper, which shows that the physical risk is going to depend on the share of direct premia in individual states as a share of the overall direct premia earned by the insurer, weighted by the property damage in that state in the previous year, and then weighted by the insurer's market capitalization. And so there's a question here of whether risk exposure should be based on realizations of climate risk here, or the expected risk underlying the distribution in any given state. And so this measure is using risk realizations based on property damages or claims. And a defining feature of natural disaster insurance markets are that these risk realizations are very spiky and may not necessarily reflect the distribution of risk underlying those realizations. And so do observed damages in this time period accurately capture the distribution of climate risk, and is using these observed damages forward-looking here. And if, in fact, as the paper suggests, we do observe stocks responding to these realizations of risk, my sense is that maybe this suggests that underlying risk isn't necessarily being priced into the stocks if this is considered new information. So it might also be interesting, in addition to the risk realization measures that you use, including the same measure of physical risk, but using risk models. So First Street Foundation, for instance, has one for flood risk. The Climate Impact Lab has other measures that are going to incorporate other natural disasters, and you may be able to find others. And just to drive this home here, right here, I'm showing the time series of National Flood Insurance Program payouts from some research that I've done. And we can see here in 2005, Hurricane Katrina really caused a lot of damage. But then in 2010, there were relatively few floods. And so if we're always looking at property damage in the previous year, does this suggest that insurers are updating at that rate based on the tail event, Hurricane Katrina happening or not. So it'd be interesting to discuss this a little bit further. My second comment is about market risk, climate risk market capitalization. So in the paper, you mentioned that these market-based measures are going to rely on the assumption that equity markets and investors are actually going to price climate risk. And so then I have the question, well, if we observe that your physical risk measures are actually responding to natural disaster events, doesn't this suggest that maybe they aren't accurately pricing these events if this is considered to be new news? Are people overreacting to tail events and so on? So again, there's this question of expectations and underlying risk distribution versus realizations of risk. And so I don't know that there's anything really to change here other than to add a little more discussion of whether this assumption is reasonable, given that some of the literature seems to suggest that climate risk isn't capitalized into things like home prices. I've included one reference here. And so just a little bit of additional discussion and nuance seems warranted, and some discussion of how our interpretation of the results might change if this assumption doesn't hold, or if what we observe is actually an overcorrection. And these are the results from the paper, right? So we saw this graph of the insured premium factors actually responding here to a natural disaster event. So what does this say about this risk or underlying risk being priced in? My third comment then is about just readability of the paper. And this is something which hopefully will be easy to address. So there are many references throughout to your prior work, Young et al. 2021 for the definitions of sea risk, marginal sea risk, climate data, methodologies and definitions. And so I found myself kind of reading this paper with the other ones next to me and kind of cross-referencing when this paper that you presented today points to definitions that are elsewhere. And so there's a sense in which reading the paper suggests that you should be familiar with this other one. And so I think just including a section providing an overview of the methods in the other paper would help this one stand on its own a little bit more, and would also provide additional background. A few minor comments then. The first is just whether average annual property damage is the most appropriate definition of riskiness of states. So when you get to your validation exercises, Texas, Florida, and California are considered the highest risk states because they have the highest annual property damage. These are also the most populous states, so it might be interesting to look at a robustness where you consider per capita damages, which might better reflect relative risk across states. As well, there's a lot of discussion here about the signs of the results. So for instance, insurers with high physical risk experiencing a decline in stock returns following severe natural disasters. But it might also be interesting to include some additional discussion of the magnitudes. I wasn't quite sure about how to interpret some of these magnitudes, maybe in a comparison to other shocks, in addition to the signs. So this would be helpful for me anyway. So overall, I think this is a super interesting and important topic. I'm a little bit biased in this respect. And I think that this paper is a really important extension of what's a small but growing literature at the intersection of climate, finance, and insurance. And it'll be interesting to follow some of these measures over time to see if the insurance industry is actually able to adapt to some of these climate risks and take them into account. So thank you very much.
Thank you, Catherine, for your comments. I don't know if you want to react immediately to them, and then we will have some time for question and answers.
Yeah, just very quickly, thank you so much, Catherine, for your thoughtful comments. They are really, really helpful. And just to respond very quickly on your main comments, the climate risk exposure. So we are constructing the risk measure based on the previous year's property damage, and the mechanism we have in mind is that it takes time for insurance companies to adjust their exposure across the state. So the exposure is going to be persistent, and we think that the damage is a proxy of the riskiness of the state, but we completely agree that it's not a perfect measure. And I really like the idea to use the First Street Foundation and the Climate Impact Lab's risk model. I think that would be really helpful. And your second comment on the market pricing, so we are really capturing the unexpected shock. So it's the unexpected part of the shock after the part that's already priced in. And that's why we are seeing that the climate factor is declining when there was higher than expected shock. That's how we are thinking about it. And we will make sure to make the paper stand on its own. It's a great comment. And obviously, the Texas, Florida, and California, they are the largely populated areas. So that's why we tried netting out the premium. But it should be very straightforward to scale by the population. We will try that. And the magnitude, we are working on it. We completely agree that it would be very nice to connect the size, the magnitude compared to the natural disasters damage, for instance. And thank you so much. And I'd be happy to answer any questions.
Okay, I don't know if somebody from the audience have other questions. We have some time for that. And if you have, okay, Mauricio, please.
Congratulations on your very nice paper.
Thank you. Thank you.
How do you take into account reinsurance in your analysis? Reinsurance is a significant player in this market, especially for property and casualty, more than life insurers. So maybe the insurers in your analysis are not absorbing the risk, but that does not mean that the risk disappears. Somebody is absorbing it. In this case, a fraction of it, the reinsurers.
Yeah.
So because this is a conference on financial stability, we want to have a global view of how these risks are absorbed throughout the whole financial system. So that's my question. Thank you.
Thank you. Absolutely. We are working on it right now. And we were wondering if the low C risk actually has something to do with their reinsurance holdings. And we started working on the reinsurance data. We can observe what reinsurance contracts that the P&C insurance companies are holding. So we are getting there, but I do not have a good answer at this point.
Okay, please, go ahead.
This is really interesting. Thank you. This is related question on the property and casualty insurers and how they seem to be adequately capitalized for these risks. Would it be overstating it, or would a reasonable interpretation be that these large ones especially are pretty sophisticated companies? They're running all of these models. They're doing climate assessments. They're making these projections, and actually they're able, largely speaking, to price their insurance products correctly, and the market is just recognizing that. Would that be a fair interpretation, or is that overreading?
We want to answer that question, and I think Catherine's suggestion to look at the risk models of First Street Foundation or Climate Impact Lab would be really helpful to think about your question. We've been wondering whether the shock is really the news to the insurance companies or the market, and we were not able to distinguish that, and it would be very interesting and useful to know whether the market, is the response coming from unexpected shock to the market participant or the insurance company. So we are working on it. Thank you.
Okay, please. Sorry, you after. No. Okay. Okay. You and then you, please.
No, I was just wondering, I mean, this is not my field, but how common is securitization in relation to climate events? I mean, we all know the mortgage securitization, and we all know the IAG story back then in 2008. So yeah, that's just it's a general question. I would like if you could answer briefly how the securitization markets in climate events work, or.
So securitization, as far as I understand, I don't think it's very common. I think reinsurance contracts are more common. The insurance companies are reinsured, so the ultimate risk might not be at the P&C insurance companies, but they might be at the reinsurance companies. We thought about the CAT bond, the catastrophic bond that hedged catastrophic events, but we found that those are common only for specific types of hazards like earthquakes, so we don't think that's the climate-driven event, but we will try to understand what's going on if there is securitization market.
Okay, please.
So, beautiful paper, I really enjoyed it, and as somebody who's not in the field, I understood what was going on, which is really nice. The question I had is, what's been the response from insurers? Have you had a chance to present this to these companies and see what do they say?
So far, we haven't had the opportunity. I don't personally have any connection, but I would love to learn more about their risk models and how they are thinking about the natural disasters getting worse over time. And we know that in the US, in California, some insurance companies completely exited. So I would love to learn more about what they are thinking.
Okay, I will ask for an applause to Hei-Yun and Catherine.
Thank you so much.
And now we will move to the second part of this session, and I will ask Mauricio Larraín to come here. ¿Cómo está? ¿Todo bien? Now we will pass to the second presentation. It's a paper about biodiversity risk, and the presentation will be held by Johannes Trevel and commented by Mauricio Larraín. Johannes Trevel is the David S. Love Professor of Finance at the New York University Stern School of Business and researcher at the NBER, CEPR, and CES-IFO. He was awarded the 2023 Fisher Black Prize by the American Finance Association, given every 2 years to the top financial economists under the age of 40. He has won many other awards and holds editorial positions at prestigious journals. He conducts research in climate finance, household finance, social network analysis, macroeconomics, and real estate economics. He holds a PhD in economics from Stanford University and a Bachelor of Philosophy, Politics, and Economics from Merton College, Oxford. The floor is yours, Johannes. You have 35 minutes, please.
Great, thank you very much. Can everybody hear me out in Santiago? And see the screen, just to make sure we're all on the same page before I start talking. Okay, no? Okay, well, I'll start anyways, and hopefully you guys can hear me. Thank you very much for inviting me to participate in this conference. Unfortunately, only remotely, since it's my teaching semester, and so I'm teaching climate finance tonight. I think this paper fits very nicely, following on from Hei-Yun, who gave a great paper and overview also on the financial risks related to climate change. This is joint work with Stefano Giglio, Teresa Kuchler, and Xuran Zhang. And we were motivated to think about this topic, given sort of this broader recent interest in understanding and ultimately managing the complex relationships between the economy and the health of our planet. Again, sort of from a financial side, really trying to think about what the role of the financial sector is, what the implications for asset markets are, what the potential implications for financial stability are, and so on. As we just saw in Hyun's presentation, there's been sort of a burgeoning research agenda in this field that I would broadly call climate finance. So questions around how does climate change affect economic activity and asset values, and the role that financial markets can play to accelerate the green transition. There's kind of an equally important, but I think much less studied theme, and I was really excited to see, that while it's much less studied, it's kind of an equally important part of the conference you put together. That's around the economic and financial implications of biodiversity loss. We think that the biodiversity loss could be similarly important to climate change in terms of its overall economic impact. But there's also much less that we know about it. And so what we're going to try and do in this paper is really take some very first baby steps in terms of attempting to measure biodiversity risks over time and across firms, and really trying to understand the extent to which those risks are already affecting economic activity and potentially asset values today. I'm going to preface this by saying this is really the first sort of, again, baby step that we're taking here. And so, we're going to try and make reasonable decisions at every step of the empirical analysis. But we're very open and very hopeful that other people will, enter this field, start thinking about this, build on what we've done, criticize what we've done, and really try and help us better understand this question. In order to facilitate that, and I'll come back to this in the end, we have released all of the data and all of the measures of aggregate and firm and industry level risk exposures on a special website, biodiversityrisk.org, that I hope will sort of start as a building block in terms of a broader understanding of at least the finance professions of the risks of biodiversity loss. So what do we mean by biodiversity loss? We're going to broadly define it in this paper as the sum of genes, species, and ecosystems. And in doing so, we're intentionally taking a somewhat narrower view than what's an even broader topic called natural capital, which might include, in addition, things like water scarcity and so on. Why did we make that choice? In some sense, we made that choice because biodiversity in itself is already highly complex. It's much more complex, much more multifaceted than climate change as a topic to think about. And so in order to make any progress, we thought we would limit ourselves to this, not to discount the importance of things like, water scarcity for economic activity, but just to turn it into something that might be a little easier to handle from an empirical perspective. And when you look at the literature, you see estimates of the losses of ecosystem services to the economy, that those losses has caused damages of anywhere between $4 and $20 trillion per year. Those are very large numbers. There's also a very, very wide range. And when you look in these papers, it sometimes, is a little bit difficult to figure out at what point you draw the line and you stop calling it natural capital or ecosystem services. You can go all the way to the extreme and say all economic activity depends on the ecosystem because we need oxygen to breathe, and if it was gone, we would all be dead and there'd be no GDP. Again, none of the papers go all that far. I think there's some uncertainty about where you should draw the line, about what you think about as the economic contributions of biodiversity. But either way, whichever approach you take, wherever you end up drawing the line, you're going to end up with very, very large numbers. There's two mechanisms through which loss of biodiversity might affect economic activity. And again, in this paper, we're going to take a relatively narrower perspective. We're going to try and think about how it affects firms' economic activity. Just to give you three types of examples of the first category, which is physical biodiversity risks, which basically come from the direct effects of losses of biodiversity and ecosystem services. So things like deforestation or habitat loss can lead to lack of raw material and supply chain challenges for a whole range of firms, anywhere from paper to furniture, to a whole range of other industries. Secondly, the loss of species or genetic biodiversity can affect the R&D sector of pharma and biotechnology firms. I'm going to provide sort of specific evidence for that. And then sort of more broadly, biodiversity loss can lead to broader disruptions of ecosystems and economic activity, to increased vulnerability to climate change, etc. Now, these are just a few of the mechanisms, as you start thinking about why would we think about biodiversity loss, not as something that we only care about per se, right? There's sort of an intrinsic value to having species variety, etc., but also why we want to think about it from an economic perspective. The second mechanism is when we think about transition biodiversity risks. So those are risks to economic activity that come from responses to reduce biodiversity loss. All types of regulatory activities such as land use regulations, sustainable forestry requirements, etc., can make it much more expensive to operate for firms in the energy sector, for firms in the transportation sector, etc. But also shifts of consumer preferences. I think a big example here is shifts away from palm oil use due to its effects on deforestation, or reputational costs that have increased substantially from things like causing oil spills or something like that. These are all, broadly speaking, transition biodiversity risks for firms. We'll see in a bit about which of these two risks, at least from the perspective of companies, is more important. But just to kind of start out, these are the types of mechanisms, the types of channels that you would think about if you start trying to figure out, okay, why should I think that biodiversity loss, which is tragic in of itself, might actually also affect economic activity, through affecting economic activity might affect asset values, and maybe even down the road financial stability, though I think there the evidence is at best at an early stage. I don't think we have any evidence yet that biodiversity loss is necessarily a financial stability risk. So the first thing that we wanted to do in this project is to, again, this being very, very early in this research agenda, to broadly understand whether or not biodiversity risks are risks that we should think about more, that we should worry about more from a financial and economic perspective. We wanted to ask, well, how do other people, how do other researchers, but also how do other market participants and how do regulators think about these risks? Do they think they're important or do they not think they're important? And so the first thing we did is we ran a survey of the perceptions of these types of risks amongst finance academics, professionals, public sector, regulators, and policy economists from around the world. We got about 700, just under 700 responses to the survey. Now, there's absolutely no claim that anything in the survey is representative, right? You have all the same concerns that you generally have about who responds to a survey, who you reach out to, etc. So this is not a claim about an overall sort of, representative set of numbers, but it is a first type of indication about whether or not people in those categories think that studying biodiversity risk from a financial perspective might be a promising avenue to go. So what do we find? First question we ask people is to try and classify whether or not they perceive both either these physical biodiversity risks or these transition biodiversity risks as financially material for corporations in the United States. Again, we had to sort of narrow the geographic scope of the question somewhat, just because in particular, when you think about transition risks, which are very much affected by local types of regulations, where in the world you are would very much affect the extent to which your operations are affected by these types of risks. So when we ask this question, we find that about 70% of respondents perceive physical and transition biodiversity risks to have at least moderate financial materiality for firms in the US. So this is the first column that you see here, both for physical risk and for transition risk, when I pool across all of the respondents that we have. So about 70% of respondents think it's either moderately or very important. There's a split about half-half, 35 roughly find it very important and 35 roughly find it moderately important. One interesting thing for us was that private sector respondents report by far the highest perceived materiality of these risks. And that reminds me of where the climate finance literature was about 5 or 6 years ago when I started thinking about climate change as something that might affect financial markets. And I went around and asked my colleagues if they thought that this was something that was important. I think the general response was, well, we think climate change is a problem, but it's not an economic problem, it's a social problem. But the economic effects are going to be small. Yet when you talk to people in industry, they had already started to understand that the financial materiality might be bigger. Now I think academics and regulators very much agree that climate change can have large-scale financially material implications. Again, biodiversity loss looks a little similar in the sense that the private sector has a much higher probability of perceiving the risks as financially material relative to the academic sector. There's a question whether or not the academic sector's perception will converge to that of the private sector or the other way around. The second question we asked was about what time horizon if people perceive these types of biodiversity risks to materialize, if they're already important today and if they're going to come at various points in the future. And here the takeaway is that only about 20% of respondents believe that the risks are already materializing today. In the short run, people think that the transition risks, i.e. those that come from regulation to prevent biodiversity loss, that they're going to be more important than the risks, the physical risk materialization, the actual losses that come from the loss of biodiversity. Okay, so with that as a little, just setting the scene of how people are thinking about it, we said, okay, we should really try and study formally whether or not biodiversity risks are priced in equity markets. That's kind of the first step that we have in finance to try and figure out, is this a risk that people worry about? Is this a risk that people are willing to pay to avoid? And subsequently, which is a very related question, as we'll see, can we use financial markets to share and hedge the underlying biodiversity risks? Now, the way that we traditionally do this in finance is that we would form long-short portfolios based on the underlying risk exposure, right? So you would form portfolios that, where you go long the firms that have a lot of biodiversity risk. You go short the firms that don't have a lot of biodiversity risk. You control for other risk factors. And you're trying to see whether or not that portfolio that overweights firms with a lot of biodiversity risk exposure, whether or not that portfolio outperforms the market or has higher expected returns than the market. Why? Well, if it does, then it suggests the risk is priced, right? Investors require extra expected returns in order to be willing to hold firms that are exposed to either physical or transition biodiversity risk. Now, in practice, we never ever observe expected returns. And so what we would do is we would proxy for expected returns with realized returns. We would say over very long horizons, average realized returns will approximate expected returns. That approach to seeing whether or not a risk is priced is just not going to work for relatively new risk such as biodiversity risk. Why? Well, we need decades of data in order to be able to get precise measures of realized returns to then call it equal to expected returns. So you need tons of data with relatively stable structural environments in order to estimate those means with any precision. For something like biodiversity risk, which is plausibly priced today, it's very hard to make the case that 10 years ago it was priced in any markets at all. And so we've seen big structural breaks, which means the time series that we have to work with is going to be much, much shorter than what we'd need for this first approach. And so what we're going to use is an alternative approach where we're going to construct measures of aggregate biodiversity risk, and I'll talk about how we do that. And then we see whether or not that long-short portfolio, whether or not the returns of those co-move with the risk realizations. Again, the idea is if you find a portfolio that's long the firms that are very exposed to biodiversity risk, if that portfolio underperforms in periods where we have lots of risk realizations, that again would be suggestive of the risk being priced in financial markets. And the reason why the second approach is more promising is because, as we all know, in relatively shortish time series, it's much easier to precisely estimate covariances and correlations than it is to estimate means. So in order to do that, we need to first construct measures of aggregate risk, and then we also need to construct measures of risk exposures in order to allow us to form these long-short portfolios that I described. So how do we measure aggregate biodiversity risk? Here we're going to build on an idea that we've used in earlier work with Rob Engel as well, where we say, look, biodiversity risk, just like climate risk, is a very slow-moving risk where we don't observe a ton of high-frequency in-sample realizations. But what we can do is, in order to study the price responses to realizations of such a slow-moving long-term risk, we can look at price responses to higher frequency measures of news about future damages from the risk. So again, rather than saying, let's see if this portfolio goes up in value every time the Amazon forest gets destroyed, which doesn't really happen at a very high frequency. What we can see is whether or not this portfolio goes up in value every time we get news about the rate at which the Amazon forest is destroyed. So the risk realization, the actual destruction, doesn't have to have happened yet. But when we get news about future realizations of the risk, and we can look at price that can also be indicative about the potential pricing of risks in financial markets. And so we're going to treat the concept of news quite literally, and we're going to construct several measures of aggregate biodiversity risk by studying coverage of news about biodiversity risk realizations in the New York Times. Again, given our focus on U.S. firms in this paper, New York Times as a US-based newspaper seems like a good starting point for this. We're going to take a relatively unsophisticated approach in the results that I'm going to be presenting to you today. We're going to define a dictionary of biodiversity-related terms, such as ecosystem, deforestation, etc. And then we're going to encode the sentiment of the article covering biodiversity risks using a natural language processing tool. And then we're going to count whether or not in a given week or in a given month there was primarily negative or primarily positive news about biodiversity risk realizations. Just as a little preview, we are updating our measures quite substantially since we first did this work. There's been, as you guys all know, huge progress in large language models, things like ChatGPT and others, that allow us to actually do a much better job at capturing time series variation in these risks. So we'll have an updated draft at some point with sort of a different risk measure, but that's what I'm going to present to you today. In the paper, we also construct a second index that's less about news, but it is about attention to risk. So we're going to look at Google search activity for terms such as biodiversity loss, species loss, etc. And we're going to see we're going to try and measure periods in which individuals pay particular attention to these risks. Again, the idea would be if the portfolio outperforms in periods where we have a lot of attention to these risks, that would also be indicative of the pricing of these risks. So how does this index look like? So this is just a time series version of it. And one of the things you realize is that over time, biodiversity risk has gone up. And that biodiversity risk spikes around periods that in some sense make sense. So for example, the biggest spike came in a month when Trump announced changes to the Endangered Species Act. So that's kind of a first bit of indication that we are capturing something meaningful with this aggregate index. One big question that we had throughout the entire project is trying to figure out, and again, we were pretty open about what we would find on this, trying to figure out whether biodiversity loss was truly conceptually distinct from climate change, or whether or not they're broadly capturing the same type of topics. Now, climate change and biodiversity loss are obviously related, right? So climate change leads to further biodiversity loss as the climate changes, and certain species, have to move, etc. And biodiversity loss, leads to more climate change to the extent that, a lot of biodiversity is a carbon sink, right? So there's obvious relation between the two. But we're going to argue, and we'll have evidence for this, that in many important dimensions, they really are quite distinct, and they should be thought of as separate risks and as separate topics for broader investigation beyond sort of the financial market work that this paper is focused on. And one way to see this is if you use the same technology to construct a climate news index. So you're trying to figure out what are periods in which we get, bad news about climate risk realizations. You see that they're somewhat correlated. In fact, I think the correlation is like 0.22 in the time series. But that there are many of the big biodiversity-related events, such as Trump's announcement of changes in the Endangered Species Act, did not result in spikes in the climate risk index. And similarly, a bunch of climate-related risk events, such as Bush's withdrawal from the Kyoto Protocol, did not result in spikes in the biodiversity news index or the biodiversity risk index, right? And so, while there are some common events such as wildfires, which lead to coverage of risk realizations of both climate and biodiversity risks, overall the two risks in the time series seem relatively distinct, and that's kind of a first, I think, important piece of evidence that it really is a standalone topic that I think should be studied separately. And I'm going to have a bunch of additional evidence on that just in a few minutes. So the next thing that we then need to do is we need to figure out the exposures of different firms or different industries to those types of risks. Because again, in order to study whether or not the risks are priced, what we need to do is we need to form long-short portfolios that go long, say, firms that are not exposed to the risks and go short firms that are exposed to these risks to try and study whether or not you get a positive co-movement of those types of long-short portfolio returns with risk realizations. There's a big challenge here. It's even bigger than trying to measure climate risk exposures of firms, which is something that I've spent quite a lot of time thinking about. The disclosure standards and disclosure frameworks for firms' biodiversity risk exposure are even less well developed than climate risk exposure measurements and disclosures. And so what we're going to try and do is we're going to have several different ways to try and measure different firms and different industries' biodiversity risk exposures. The first one, which I'll spend most time showing you today, is to try and study firms' 10K statements. So 10K statements are regulatory filings that firms have to make in the US with the Securities and Exchange Commission. And in those filings, they have to disclose all of their material risks to their investors. And so we'll use text analysis to study whether or not a given firm actually discloses biodiversity risk exposures, either of the transition risk or the physical risk types to their investors. The second thing that we're going to do is we're going to go back to our expert survey where I showed you some initial results on. And we're going to ask people to rank, about 20 different industries by the, how those experts perceive these different industries to exposed in terms of their risk. And then lastly, we're going to look at the types of, stocks and industries that the relatively few ETFs and mutual funds that are actively trying to sort of, be funds that benefit from, say, biodiversity regulation, what types of stocks those mutual funds would hold. One takeaway before I talk a little bit more about the three measurements is that all three approaches give us relatively similar rankings of industries in terms of their biodiversity risk exposure, which makes us confident that, again, we're picking up something that at least at a first cut seems meaningful. So again, we're going to have three different measures of using the 10K statements. One, which is just a very simple one, which just checks, do these firms identify any risk? Do they mention, in their risk disclosures, anything related to biodiversity? The second one is we're going to try and be a bit more sophisticated and make sure that the sentiment in which the risk is disclosed is actually negative, right? That this is not, disclosed as there's a potential opportunity here. And then lastly, we're going to try and come up with a measure that really tries to hone in on the regulatory risk exposure rather than sort of, physical risk exposure. We're going to have these survey-based measures, as I described, where our survey participants were asked to select industries that they believe were most negatively affected either by physical or by transition risks. And then, so we're going to measure the physical and transition risk exposures, the share of survey respondents who select a given industries as being affected by the risk. And then we're going to, as I mentioned, have these 4 biodiversity-related funds. And trying to see what industries are overweighted relative to the market in those biodiversity-related funds to try and figure out what those fund managers think are the industries that are positively and negatively exposed. Okay, so over time, one of the things you see is that self-reported biodiversity risk exposures as measured in the 10K statements have generally increased over time, from about 1% of firms mentioning these types of risks in 2000 to about 4 or 5% of firms measuring these risks in about 2018. And actually, surprisingly, they've just declined a little bit since then. The other thing I think just to realize when you're trying to think about, well, is this going to be quantitatively as important as climate risk? You see that, with only about 4 or 5% of all firms mention those types of risks. I think you're going to get a much larger share of firms mentioning climate risk. Now, again, what's important here is those are US firms, and biodiversity risk, unlike climate risk, which is really global in nature, I think biodiversity loss is a somewhat more localized phenomenon. And I think as a result, the regulation in response to biodiversity loss are also much more localized. And therefore, you might be able to get much different levels of risk exposures across different countries. But within the US, about 4% at the moment mention these types of risks. What are these sectors and industries that have the highest biodiversity risk exposures? It's energy, it's utilities, and it's real estate. And on the flip side, sectors such as semiconductor, software, and communication services have rather minimal exposure. So where does the exposure of energy, utilities, and real estate come from? Here's just some examples, again, coming directly from the 10K statements about how firms describe their own risk exposures. So in the energy sector, you hear a lot about reputational and legal risks, where drilling activities can lead to oil spill and habitat destruction. And that's a big risk that they worry about. Or regulatory risk, where environmental regulations aim to prevent further biodiversity loss. So here's an energy firm that says if one of our LNG terminals may adversely affect a protected species, we may be required to follow a plan to avoid those impacts, right? So that's one example. In the utility sector, you have a lot of physical risks mentioned, so in particular in the water utility sector, degradation of watersheds, etc. In the regulatory risk sector, you're going to get a lot of mentions of species and habitat protection, limiting firms' ability to operate. The bottom example here is from the 10K statement, actually of a renewable energy firm, and I'll come back to that. It's a firm that says the company is subject to law regarding the protection of wildlife, including migratory birds, eagles, etc. And so these have become more stringent and actually make it hard for this firm, which is a wind energy firm, to operate. There's other examples here. So various types of real estate companies worry about endangered species protection. And then also firms in the materials sector mentioning both physical risks, in particular the availability of and quality of raw materials, and also regulatory risks. So this is a firm here that's in the timber sector, and it talks about various types of timberland protections may adversely affect their ability to operate. Lastly, I just want to give you one more example. To me, actually looking at these 10K statements, and we have a lot more in the paper, was really, really helpful, because as I was just starting to wrap my head around the economic mechanisms through which biodiversity loss may affect economic activity, I found it personally really, really helpful to read how firms themselves talk about these risks and why firms themselves might or might not worry about it. So here's a pharmaceutical company that says we focus on the use of biodiversity as a means of natural product drug discovery, and as a result, sort of the loss of biodiversity would impede the R&D process. And then lastly, a firm in the capital sector says many consumers demand certified, sustainably harvested wood, as concerns about deforestation have become more prevalent. So again, this is a transition risk that comes less from the regulatory side, but from a change in consumer preferences. So these are just a bunch of examples of different types of industries and how they talk about their biodiversity risks. One thing that's interesting is when you're trying to rank firms based on their biodiversity risk, and you also rank them based on their climate risk, what you see is that, broadly speaking, there's like a small positive correlation, but there's lots of firms that end up being exposed to one type of risk while not being exposed to the other type of risk, or maybe even negatively being exposed to the other type of risk. So one example I want to focus on is the utility sector here, which was the second highest biodiversity risk exposure, but one of the most negative, in some sense, climate risk exposures. And when you open this up, what you start realizing is that much of this comes from the renewable energy sector. So the renewable energy sector is a sector that benefits a lot from climate transition risk realizations that make it harder for its competitors, oil firms, coal firms, etc., to operate. But actually, regulation in terms of biodiversity risk actually are really harmful for the renewable energy sector. Wind farms and birds, we already had a specific example from a wind company that says that, once you have to take into account migratory birds and so on, it's really hard to operate wind farms. Hydropower dams are very damaging to migratory fish. Solar has huge land use requirements, and there's been an increasing concern that offshore wind leads to the death of whales. This is an article from the New York Times, in October, in August, and basically what they describe is they say, that groups have protested and sued to stop federal approval of wind turbines. They claim damage to whales with no firm scientific evidence behind it. But, we're kind of seeing more and more examples of where, regulation to stop climate change, which would need us to expand dramatically renewable energies, kind of come into conflict with regulations to stop biodiversity loss. Okay. So then we have these exposures across different firms and different industries to these risks. And then lastly, the question is, how much are these risks priced in equity markets? So what we're going to do is we're going to form equity portfolios of industries sorted by their biodiversity risk exposures. We're going to hold long positions in industries with low risk exposures and short positions in industries with high risk exposures. And again, if biodiversity risk is priced, the return of this portfolio should co-vary positively with the aggregate news index. This is a portfolio that should do well when we get bad news about either physical or regulatory biodiversity risks. Another way to think about it is this should behave like a hedge portfolio. Holding this portfolio should hedge the arrival of the news, should allow us to share the risk more broadly. And so when we do that, what we find is that the out-of-sample correlation between returns on this portfolio and AR1 innovations in the aggregate climate in the aggregate biodiversity news series sits somewhere between 0.1 and 0.2 in terms of correlation. Now you might wonder, well, 0.1 and 0.2 does not sound very high. And in some sense that's true. And for me, who's not a traditional asset pricer, I was rather disappointed when I started thinking about hedging macro risk factors and I saw correlations of 0.1 and 0.2. But it turns out that this is about as good as it gets, even when you're trying to hedge things like inflation or unemployment or things like non-farm payrolls in the US, just because stock returns are so noisy that getting out of sample correlations of 0.1 and 0.2 is actually pretty successful and certainly suggests that investors are, at least to some extent, thinking about pricing these risks. You can also ask whether or not our measures of biodiversity risk exposure are simply recasting information from other firm characteristics. Another way of saying that is you can try and figure out whether or not, if you just try to form hedge portfolios based on a lesser regression on industry returns or a lesser regression on the factor zoos or all of the risk factors that have been identified in the practice, or just the pharma French factors, whether or not those portfolios allow you to also hedge the arrival of the news. And the answer is they don't, right? So while if you take the average biodiversity risk exposures across all of our different approaches, you get an out of sample, correlation with the news realizations of about 0.2, trying to use other mimicking portfolio approaches based on existing factors basically gets you a zero out of sample correlation. So what do we find? We find that biodiversity risk exposures do vary substantially across firms and industries, that the variation is economically sensible. When you look at the 10K statements, for example, these firms do describe some very plausible mechanisms, and that long-short portfolios on these characteristics co-vary with aggregate realizations of biodiversity risk, and as a result, allowing us to conclude that the risks are priced. Now, just knowing that the risks are priced is sort of a relatively low bar. Rejecting the null that they're not priced is a relatively low bar. From the perspective of, say, a regulator, what you really want to know is if the risks are priced adequately. Why do you need to know that, or why is that the key question for you to look at? It's because if they're not priced adequately yet, you can get large repricing.
Sorry, Johannes, sorry
Yes.
to interrupt you. You have just 1 minute left, so if you can
I'm
summarize,
on my last
please.
slide.
Okay.
I'm on my last slide.
Thank you.
I'm on my last slide. So it's very hard, so if they're not priced adequately, changes in the risk pricing and changes in beliefs about the risk can lead to large changes in asset prices without actually needing any additional information on whether or not any additional information about or any actual realizations of the risk. It's very hard to say if the risks are priced adequately. It requires structural models. It's the research frontier in the much more developed field of climate finance. We don't really know if climate risks are priced adequately. We know they're priced, but we don't know if they're priced adequately. So one thing that we did is we went back to our survey respondents and just asked them. And just as one data point, about 30% of people had no opinion. They had no idea whether or not these risks were priced adequately. To be honest, probably more than 30% didn't, but the rest at least gave us some indication. And out of those that gave us indications, 2/3 said that they're not yet priced adequately. Okay, so that's the conclusion. So this is really the beginning of what of dipping our toes into better understanding the financial implications of biodiversity loss. We introduce measures of both aggregate biodiversity risks as well as measures of exposures to these risks across firms and industries. We try and study the pricing of these risks in equity market. I think we can reject the null hypothesis that they're not priced. we have made no progress in terms of trying to figure out if they're priced adequately beyond asking people and realizing people think they're not, but that doesn't mean they're not. I want to remind you that all of these measures across firms and across industries we release at biodiversityrisk.org. So if you want to work on this topic, and I hope many of you will, you can use those as a starting point for your own work. And I'm going to stop right here. Thank you very much.
Thank you, Johannes. Now I would like to introduce Mauricio Larraín, that will discuss this paper. Mauricio is Associate Professor of Economics at the Universidad de los Andes, Chile. Before this position, he was Vice President of the Financial Market Commission of Chile, Associate Professor at the Catholic University of Chile, Roger F. Murray Associate Professor of Finance at the Graduate School of Business in Columbia University, and researcher at the Central Bank of Chile. He conducts research in corporate finance, corporate governance, and banking. He holds a PhD in economics from the University of California, Berkeley, a master in financial economics, and a bachelor in economics from the Catholic University of Chile. Mauricio, the floor is yours. You have 15 minutes.
Thank you very much for the kind introduction. Thank you for organizing this very relevant and timely conference, and thanks for inviting me to discuss this paper. Johannes was saying that in this paper he takes some baby steps. This is a huge baby. I see it a little different. I think this is a tour de force on biodiversity risk. It's a very complete paper. It's a very ambitious paper. I'm sure it's going to be a reference in the future very quickly. At the core of the paper is measurement. To truly understand something, you have to measure it first. And this paper does a great job in measuring biodiversity risk. It measures it from different angles, from different levels of aggregation. At the aggregate level, using the news-based measures. At the firm and industry level, using different sources of information, 10K statements, also encuestas, surveys, and mutual fund holdings. So it's very complete. And he even does an analysis, which I think he didn't have time to present this, about whether it's how it's measured across counties. So there's a spatial and a geographical dimension to it. So measurement first. Once you have the measure, Johannes makes a connection between asset prices and biodiversity risk. And he finds that biodiversity risks are already priced into equity stock prices. And then throughout the paper, Johannes makes the very strong point that climate risks are different than biodiversity risk, and we have to think about them in a different way. I found this very interesting. In my personal experience, I have some limited knowledge on climate finance, very little on biodiversity finance, so I learned a lot from reading this paper. Moreover, the paper does a nice service to the profession. All the data is available online in the biodiversity risk website. That's a very generous act from Johannes and his co-authors. And I'm sure that many researchers, academics, and policymakers will use this readily available data to further conduct research on this topic. I would say that I think it's fair to say that Johannes is a leader in the new and dynamic topic of climate finance, and with this new paper on biodiversity risk, he's only strengthening his leadership. The topic of biodiversity is very relevant for Chile. I'm sorry, Johannes, that you're not here in Chile so you can see it with your own eyes, but we have a huge stock of natural capital. Our geography spans from one of the most arid deserts in the world, in the north of Chile, to the Antarctica in the south. We have the Andes Mountains with some peaks up to almost 7,000 meters, oceans, fjords, archipelagos, etc. And because of this variety of ecosystem and variety of climate, we have a huge variety of forms of life, more than 30,000 species, plants, animals, fungus, bacteria, etc. So biodiversity is very relevant for Chile. Yet, in Chile, at least at the finance and macroeconomics level, we have not studied this topic too much. We have done some work on climate finance. I was a board member of the Financial Market Commission for 6 years, and in the year 2020, we published the strategy on how to face climate change in the financial market with 3 main pillars. 1, disclosure. Firms and financial institutions have to disclose their exposure to climate risk. Second, risk management. Financial institutions have to introduce the management of climate risk into their overall risk management policies. And third, market development. Promote the development of a market that can finance sustainable activities. But this has nothing to do with biodiversity risk. It's all to do with climate change. That said, very recently, we have been moving towards understanding the effects of biodiversity risk. And here the Central Bank of Chile has played an important role. At the beginning of last year, the Central Bank of Chile published an important policy paper connecting biodiversity to macroeconomic growth. And more recently, just a couple of months ago, the Central Bank of Chile published a methodological paper to try to understand how to measure natural capital, different methodologies. And believe me, this is not an easy task. Moreover, at the beginning of this year, Chile became the first country in the region to create a committee on natural capital. What is the objective of this committee? To advise the government, to propose things related to the measurement, preservation, restoration, growth of natural capital. The idea is to introduce nature and biodiversity into the design, into the implementation of public policies related to sustainable activities. So as you can see, this is a very timely topic, a very relevant topic for a country like Chile. And Johannes does a great job. I have a couple of comments that I hope can make the paper even stronger. Number 1, this is a question that I have for Johannes. Is biodiversity risk truly priced into equity prices? According to Johannes, the answer is yes, but I did my homework. And I read a couple of very recent papers, 2023 papers on the same topic. There are some European guys that actually find that biodiversity risk is not priced into equity markets. And then there's a newer paper by some French researchers that they identified this tension and tried to solve it, and again they find that biodiversity risks are not priced into equity prices. I am not an expert in asset pricing, but I would like to know what's happening here. Maybe this has to do with the difference in the biodiversity risk measures that are being used. If that's the case, it will be useful to understand what are the advantages and disadvantages of the different measures used by the different papers. Or maybe it has to do with different methodologies. If that's the case, again, it will be useful to understand what are the trade-offs between the different methodologies. So that's my first comment, to try to understand this tension in this very new literature about whether biodiversity risk is priced into equity markets or not. My second comment is a suggestion. So to analyze the connection between biodiversity risk and asset prices, this paper takes a cross-sectional approach. And my suggestion is to complement this cross-sectional approach with a time series approach. In particular, exploit the COP15 event. So as a reminder, the COP15 event was a conference exclusively on biodiversity. It took place in 2 different phases, first in China, then in Canada. And this conference raised awareness of biodiversity issues around the world. And in fact, if you look at the New York Times Biodiversity News Index that Johannes constructed, you can see a spike around this event. So there is some action going around this event. So then, Johannes, maybe what you can do is just look at what happens with stock prices before and after the COP15 event. That's the time series variation. And then for firms that have high versus low exposure to biodiversity risk, the cross-sectional approach. So I think it's fair to think that this is a plausible exogenous shock to investors' expectations regarding regulatory or transitory risks. And maybe this type of approach can complement nicely the cross-sectional approach that is already performed in the paper. My next comment is also a suggestion. So when looking at asset prices, this paper looks at equity prices. But then I ask, why not also look at bond prices? The biodiversity risk exposure could lead to higher default probability of a company and therefore higher financing cost. So here my suggestion would be to look at credit default swap spreads. Because the CDS spreads, they represent very directly and clearly a firm's credit risk. And the data on CDS is available from Thomson Reuters, so it shouldn't be hard to collect this type of data. The other nice thing about the CDS is that you can also look at the term structure of the CDS spreads in order to look at the effect of biodiversity risk on different horizons. As Johannes said in his presentation, the materialization of biodiversity risk depends on which horizon you're looking at. So looking at the term structure of CDS has that advantage. You can pin down in which exact horizon these risks are more relevant than others. So that's another suggestion, again, to further strengthen the analysis on equity prices. And to conclude, some thoughts about the policy implications of this paper. Johannes said that we really don't know if these type of risks affect the stability of a financial market or not. And we have the data. Johannes has provided the data to do this. So maybe the Central Bank of Chile, maybe the Financial Market Commission of Chile, or regulators elsewhere can try to answer this question. One possibility to answer this question is as follows. So look at banks. The regulators know exactly the exposure of the loan portfolio of banks to different sectors, retail, construction, energy, etc. And then Johannes provides a sector-level measure of biodiversity score. So in principle, what we can do is calculate a biodiversity measure of exposure at the bank level, which would be the weighted average of the biodiversity score of the industries in which the bank is lending to. And of course, the weights are just the relative size of the loans. So maybe you have a bank that has a high exposure in sectors such as real estate, utilities, or energy. Well, that would be a bank that would have a high exposure to biodiversity risk. And then, of course, the last step is to aggregate this bank-level exposure to biodiversity risk across banks in order to get an aggregate measure of exposure at the banking level. So you have the aggregate exposure measure, which is relevant from a macro-prudential point of view. And you also have the the individual bank exposures, which is relevant for a micro-prudential point of view. Maybe the aggregate exposure is not too high, but there could be a particular bank in the system that has a very high exposure to this type of risk. So identifying that financial institution, it could be very useful from a policy point of view. And of course, it's very easy to add a time series dimension to this. You can calculate this type of measure at the monthly level where you have the data, and you can see whether the exposure is increasing in time, whether it's flat, or whether it's decreasing. And then it's also very natural to extend it to other financial institutions. In the case of Chile, there's two other main financial institutions besides banks that are very relevant: life insurance companies, and then also pension fund managers. And then you can do the exact same formula than before, but instead of thinking about loan exposure, you think about securities exposure. So what you want to know is whether the portfolio of securities of these two institutional investors, to what degree are they exposed to biodiversity risk, and how does that exposure vary in the cross-section of institutions. So again, Johannes, thank you very much for writing this paper. I hope you will publish it in a top journal very soon, and you will get many citations. Thank you very much.
Thank you, Mauricio. I don't know, Johannes, if you want to answer or comment about Mauricio's suggestion, proposal, and questions.
Great, and I'm sorry I'm not there with you to hang out and catch up in person. Your suggestions are all great, and again, I still view this as largely dipping our toes in terms of the scope of the analysis, and all of the things you suggested are things that we or maybe someone else should undertake to kind of build this field further. I think the one thing I do want to comment on briefly is sort of the apparent tension you highlighted with the two other studies that have undertaken this paper. The studies differ on both of the approaches you mentioned. I think one of them is data. We construct our own exposure measures that are public. They use data from a private vendor called Iceberg Labs that I do not have access to. So I don't know the extent to which the exposure measure contributes to it. My sense is it's not the main reason. I think the main reason is methodological. So the other two papers take the standard asset pricing approach, where they sort portfolios similar to us, again, a different exposure measure, but let's assume they're the same. And they go long the high exposed firms and short the low exposed firms. And what we should observe in principle is if the risks are priced, you should expect the more exposed firms to outperform, right? You require a risk premium to hold the more exposed firms. They should do better. They don't find that in the data. And I think the reason they don't find that is because we have a structural break in the middle for exactly the reasons you pointed out, and in fact reasons they find in their own work, things like the Montreal Agreement, etc., have changed people's attention to this type of risk. And so what has happened is during the sample period, imagine in the beginning no one was worried about biodiversity risk, and by the end at least some people are worried about this. What would happen over the period from no one being worried to some people being worried? It would actually lead to an underperformance of the more exposed firms, because suddenly this risk that you previously didn't care about, you now worry about. So they would underperform in sample in order to give you a higher expected return out of sample, right? But when you have structural breaks like that, the approach of saying, well, in sample they underperform, so I can't find evidence that they have a higher expected return. No, we can never measure expected return. We can only ever measure realized return. And in some sense, the reason they outperform now is so that they have a lower price and a higher expected return going forward, right? So whenever you have structural breaks within a sample about attention, to a risk. By the way, we have the same with climate risk, right? We have ESG should underperform because it hedges climate risk, yet in sample for many years it outperformed when we transitioned from a world where nobody cared about climate risk to a world where we cared a lot about climate risk, which led to great performance of solar stocks for many years. That doesn't mean solar stocks, are risky in terms of climate risk exposure, right? In fact, I think they're going to underperform going forward. They're going to have a lower expected return. But during the period when we started learning about the risk, they had a high in-sample return. And I just think the approach that these papers take in terms of equating expected returns with in-sample realized returns during a period when attention to a risk changes so much, I think doesn't work. And in fact, when you look at the papers in terms of covariances, which is, I think, what still works, they find exactly the same things. So the beauty of sitting in front of my computer rather than with you in Chile, I can actually pull up the paper again. And in the last sentence, what they say is, they say that consistent with this finding, stocks with a large footprint lost in value the days after the Kunming Declaration. It's exactly the analysis you were suggesting, right? So in terms of covariance, they find exactly the same thing. And in fact, they even argue that investors have started to require a risk premium going forward after Kunming, so that the outperformance might have ended, the underperformance might have ended between now and then. So I think just any paper that just looks at relative returns of more and less exposed firms, equating an in-sample return with an out-of-sample expected return during a period when there's structural changes, I just don't think is the right approach, which is why we picked the covariance approach. And in fact, to the extent that the other papers also look at the covariance, what happens to prices around big announcements, around big news events, the results line up quite nicely, which makes me think that it's not the fact that the Iceberg Lab measure is so different to our measure, but that it's really the methodological approach where, for the reasons I described, I prefer the one we took.
Okay,
But thank you very much for the discussion. It was super helpful.
we have some time for another question. Please, go ahead.
First of all, thanks. This is really interesting paper. It's really interesting work, and I'm so glad you're making this all public. That's a wonderful service. I had a question for you. So I was puzzled. You were saying that, that you really don't want to take a longer-term view of this, or I mean that you're going to only look recently. But the Endangered Species Act was passed in 1973. So if you looked at parts of this, like particularly thinking about things that, could cause problems for endangered species, it would seem like you actually have a long history in the U.S. So, I was kind of interested or thinking about particular parts of biodiversity. As you said, it's everything. But, could you be looking at things which affected species and then, measures which would be particularly like land-based? So anyway, that was the basis of my question. But anyway, thanks for a really interesting paper.
No, it's a great question. And in some sense, it's impossible to know when to start, because you want to start measuring, like you don't want to include periods where you could be pretty confident that it wasn't priced, because it's not going to teach you anything. And it's going to confound what you observe today, but we don't really know when it started being priced. And so I do think your idea that maybe some of the regulatory risks, at least around endangered species, actually been around for a long time. I agree with you. For those subsets of the risks, it might be possible to find pricing even earlier. Part of the reason why I'm not 100% sure if it's going to work, but again, it's an open question, is when you think about the time series of the risk disclosures, right? They've gone up by a factor of 4. So between 2000 and today, about firms that talk about any types of risk, including the transition risk related to regulation, such as the Endangered Species Act. So there's a question about, did they not disclose it because just no one in finance was paying attention? Is it because it wasn't enforced then and it is now? But that's something that one would have to think about if we're going to take that longer term approach.
Thank you. I think we have some more questions if there is another one. Or if it's not the case, well, I would like to thank the presenters, the discussion, and all of you for your attendance and for your active participation. And as a statistician, I would like to say that I was very happy with these 2 presentations. They are very inspiring and motivating us to continue this further work. So thank you very much, all of you. And I ask for an applause for everybody.
So thank you to the presenters and to Gloria. With that, we finished, and we're going to stop for a coffee until 11:15.
morning, everyone. So we're going to resume with our keynote speaker today on day 2. It is my pleasure to introduce all of you Professor Maximilian Hofhammer. He's the George Pardee Junior Professor of International Sustainable Development and Chair of the Berkeley Division of the Academic Senate. Professor Hofhammer received his bachelor degree in environmental science from UMass Amherst in 1996, a master's also from UMass Amherst in environmental and resource economics in 1998, and a PhD in economics from UC San Diego in 2003. The same year, he joined the faculty at UC Berkeley, and his research focuses on environmental and resource economics, energy economics, and applied econometrics. He is the recipient of many accolades, and his research has been published in many renowned academic journals. He loves the mountains in wintertime and spending time with his family, and he has this really super good quote on his website where he says this: attempting to make the world a better place, but cost effectively. His talk today is going to be about the updated social cost of carbon methods and what to do next. So Professor Hofhammer, the floor is yours.
Thank you. This is nerve-wracking walking across the stage. All right, thank you so much for being here today. Before I start talking about some economics, I wanted to thank Governor Costa and members of the board for supporting this event and bringing in such an amazing cast of academics and practitioners to talk about this important topic. I also wanted to thank Elias Abagli, Sofia Barduco, Gonzalo Garcia, and Alberto Unduraga for actually putting the details together here and keeping us on time and making sure everything's done. So thank you very, very much. Also wanted to thank my colleagues who traveled far, people who got up at 5 in the morning to discuss papers remotely for their participation. So one thing about being a keynote speaker, which I've only done this a few times, and I find this much more nerve-wracking than presenting a technical paper. So you get to take a step back and just think some big thoughts about an important topic. So one thing that I've learned during this conference already is it's really exciting that environmental economics has sort of infiltrated other fields of economics very slowly. So Steve Pulaski, who's always been one of my heroes, we talk to the same sort of environmental people over and over, but all of a sudden, folks in finance, folks in macro, folks in behavioral are starting to think like, what does energy efficiency mean? What does climate regulation mean for our fields? And is there meaningful things we can add to the overall discussion? So seeing Philippe, my keynote is going to be deeply underwhelming compared to what the tour de force you got yesterday. Just hearing him say, we've got to do things now, we've got to do multiple instruments, and you've got to focus about both mitigation and innovation separately. So hearing one of the leading growth economists in the world say that, it made me feel all warm and fuzzy, I have to say. So what I wanted to do today is I proposed a few topics. When I was in graduate school, my advisor always said, Max, you remind me of a puppy. You just get interested in so many different things. So I proposed 3 different topics, and the organizers chose the social cost of carbon, which I think is a really good moment to talk about this. Not to necessarily tell you what the number is. I'm going to tell you right now it's $190, so let's get that one out of the way. But I think what we learned from an exercise we just went through with regards to the social cost of carbon is an amazing story about collaboration between folks in academia, folks in public agencies, and folks in think tanks coming together to really construct a policy tool or measure that is going to be, I think, deeply influential more broadly. So it's a little bit of a storytelling exercise about what happened. Some of you in the room know this story quite well because you were parts of it. So I've added at the end some new ideas, hopefully, that'll help us think about what we could do going forward. So during the first dinner here, Jim Stock, Marshall Burke, and I, walked outside and had some dinner and started talking. And then Jim Stock came and said, "Where did 2 degrees come from? And was this would an economist recognize that 2-degree number?" Turns out the 2-degree number did come from an economist by the name of Bill Nordhaus. In a 1975 paper, Bill sort of drew a line at 2 degrees and said, this seems to be like a threshold that we probably shouldn't cross. But it's not necessarily motivated by what a resource economist thinks about, sort of a time series of emissions with uncertainty about technologies and a finite sort of amount of carbon for given temperature targets that the atmosphere can absorb. So there's still work to be done there. I'm going to take 2 degrees as given for a second, as does the rest of the world, and just provide a little bit of context. So I made you a movie. This was one of my proudest achievements right here. So this is basically taking carbon budgets seriously and saying if we want to get to 2 degrees, there's a fixed amount of carbon we can emit. If we would have started, let's do this one again, in 2001, the trajectory was was still looked like a pretty steep trajectory of emissions reductions that's coming. But emissions have just been growing and growing and growing over time. And of course, what then happens is the sort of pathway to reduction, taking into account if we get unlimited, carbon sequestration and direct air capture that's free, then, this all looks different. But the notion here is this is a little bit like you've put on a lot of weight before the holidays, and the holidays are approaching closer and closer, and you can't get yourself to stop eating the cookies and the delicious drink. So the challenge becomes steeper and steeper and steeper until at some point you're just not going to meet your weight loss goal. This is, of course, much more serious. This is at the planetary scale, where what we're going to try and have to achieve here is pretty drastic decarbonization over the next 30 or so years. Now, what does this mean, right? We talk about the 2-degree goal. We could spend lots of time talking about how 2 degrees is defined. It's an annual average of average surface temperatures. But, we're starting to cross that threshold. So this was one of the sort of more scary headlines in the news a couple of days ago, where globally we've crossed the 2-degree threshold for the first time for a couple of days there. So we're not permanently there, but we're certainly heading there. So I used to have a 1.5-degree target presentation in my presentations. I've taken that out because we are way past 1.5 degrees, and I think we should stop talking about it and try and make the 2 degrees if we can. Okay, so economists. When we talk to each other, we're all very happy, and we like each other most of the time, and we understand what each other is saying. When we leave the safe halls of academia and policy think tanks and central banks that are not just populated by economists, we're not loved quite as much outside. So one of the solutions that economists have been running around the world saying, if we're going to get out of this emissions problem, carbon pricing is clearly the first best, it's the only thing we should do. We should tax carbon, tax carbon, tax carbon. So where are we today? This is a different picture of the carbon tracker that I think Steve or somebody showed something similar right here. This is an optimistic picture of what carbon pricing looked like globally last year. Now, why is this optimistic? The way the World Bank shows you these pictures, if there's one subnational jurisdiction in your country that has priced carbon in some sort of way, your whole country is covered. Kansas does not have a price on carbon. California does. So the United States here counts as covered. What they do, though, which is quite fair, you can't really see that here. There's these little pies that are next to the individual continents right here. The colors tell you what share of emissions on each continent are covered by an actual carbon price right here. So for North America, it's 16%, Latin America and the Caribbean, 17%, Europe, it's more closer to 30%. If we're talking about East Asia and the Pacific, it's 35%, which has something to do with China's nascent carbon pricing systems right here. So one way you could look at this is if you're an optimist, you could declare victory and you could say, wow, this idea of sort of a Pigouvian tax that we teach in principles has really sort of spread across the world, and we're pricing one of the most important externalities just beautifully in large parts of the world and some of the major economies of the world. If you're not an optimist, if you're more sort of a Debbie or Donald Downer, you could say, look at the picture earlier, we're going to have to decarbonize rapidly. This ain't going to do it, right? We're going to have to do more than that. So I'm more on the Debbie Downer side, I have to say. I'm deeply concerned about, us using carbon taxation as the only tool to meet this decarbonization challenge. What's even more worrisome, and this is going to become important when we talk about the social cost of carbon and what this means in the public sector and in the private sector separately here, is that just because it's priced doesn't necessarily mean it's very expensive, right? There are some parts of the world, so if you look at Uruguay and Liechtenstein and Switzerland and Sweden, which are not the world's largest economies right here, they have relatively ambitious carbon prices, $120, $130. Red here is a carbon tax. Blue is a cap and trade, a tradable permit system right here. Both, place a price on carbon. And that's sort of the puzzle that Jim Stock alluded to here, where he showed, two papers have differential effects. So there's different mechanisms here, but both are a price. But if you go down here, I'm not going to point at Chile down there, but I will. That price is relatively low. This is not a critique, right? But that's sort of what we're observing. So the key thing here, that's takeaway message number one to me, is what economists have failed at accomplishing is taking the political economy of this whole notion of carbon pricing fully seriously. So in political science, there's some folks doing really interesting work like Jonas Meckling and others that are thinking very carefully, not just about is a carbon tax the right thing, but what is the resistance to taxation and how do you think about actually making this a more broadly implemented policy tool. Before I switch over to the other price of carbon right here, I do want to say, and even though I'm German, I'm also going to obnoxiously focus on what's happening in the US because that's where I live every day and that's what my work focuses on. There's an interesting thing playing out in a couple of years when the Trump tax cuts are going to expire, which, there might be some interesting ideas floating around that both sides of the aisle could possibly support in this particular region here. So I'm not declaring carbon taxes have no future. I think there are opportunities, but we've certainly got to take the political side of this much more seriously. This is also evidenced by the fact if you look at the Council of Economic Advisors in the Biden administration or the White House in general, there are way more sort of political folks walking around than folks with PhDs in economics in previous administrations. Really interesting people to talk to, but the density of economics has gone down quite a bit. Okay. So the first price of carbon, that's one that people actually pay, right? You pay it in your gasoline, you pay it in your heating fuels, whatever sector is covered. That's the thing we sort of teach in Intro to Economics. The second carbon price that, frankly, I hadn't really thought about very much until about 12, 13 years ago is this notion of the social cost of carbon. Economics has done many great things. The national income product accounts, I still think, are maybe the most important contribution. Economists, Kuznets, like counting how much stuff we make and consume is really important because without measuring things, it's very hard to pass good policy. The second coolest thing that I think economists have introduced into the policymaking process is the notion of benefits and costs, right? Before we make decisions, compare the benefits of a new rule to its costs. Obvious to everybody in this room that this is a good idea. If you disagree, I really must talk to you during coffee, all right? So one question that people have asked, we were relatively good at thinking about the costs of air pollution, for example, and other factors. But climate was a really tricky problem, right? What is the damage of 1 ton of CO2 emitted today over the next 300 years across all sectors of the economy globally. This is a room full of central bankers forecasting something 280 years into the future gives you nightmares, right? The struggle is like 3/4 out already poses a challenge. So we're doing something really far out, and we're doing it not just for one possibly relatively closed economy, but we're doing it for the globe where, think about agriculture, energy, all kinds of sectors are going to be affected by this. So this, what I'm going to say here, is a difficult number to calculate, and are we ever going to get it exactly right? The answer is definitely no. But the question is, can you calculate a number that's good enough, that's credible, that will actually withstand sort of political scrutiny and peer review as a number that measures these damages globally? Okay, so I usually don't have pictures of Ronald Reagan in my presentations. It's not something I do, but this is an Avedon portrait that I actually really like. So the social cost of carbon, that's what SCC stands for the rest of this talk. Ronald Reagan is a hero of the Republican Party and my more conservative friends. He was also a movie actor, so now people are talking about maybe Arnold Schwarzenegger could be next. He was not born in the United States, so you can't be president. But Ronald Reagan mandated the use of benefit cost analyses if agencies want to pass new rules and regulations. So it wasn't an optional thing. It would be nice if you conducted benefit cost analysis. You have to do it. There are rules written around how you do it, and that to me is one of the big contributions in the early 1980s policymaking process. I was 8 years old at the time, so didn't realize this was happening, but I'm very glad it did. Now, where does this become spicy in the climate reign? So the Department of Transportation, which does things like regulate fuel economy, do you get to drive a 8-cylinder Ford on average down the street, or should we, think about having smaller, more efficient engines right here? Tried to pass a rule that placed $0 on the benefits of avoided greenhouse gases, right? So, basically the atmosphere is a free trash can that you get to use as much as you want. The Court of Appeals, which is the US legal system is still sort of a mystery to me, but the Court of Appeals said, we don't know what the number is, but we know it's not 0, right? There is some damage that CO2 is going to cause, so figure it out. Now, in 2009, President Obama came in. At the time, there were lots of environmental economists in the administration. So Michael Greenstone at the University of Chicago, who has the Milton Friedman Chair in economics. I really like the fact that the Milton Friedman Chair is held by an environmental economist. And I think Cass Sunstein sort of pushed this along. So there was a process where agencies across the administrations, was more than a dozen agencies, came together and said, we're going to figure out one number that we're going to use in all cost benefit or benefit cost analysis across the government. So this group was called the Interagency Working Group. It had names that environmental economists would recognize within the agencies working on this, and they issued a social cost of carbon. At the time, it was something like $40. It was actually $42. If you've read The Hitchhiker's Guide to the Galaxy, it was lower. The revised version was 42. I always say Jim's shaking his head. No, Max, it wasn't 42. Final number was 42, which is also, if you've read The Hitchhiker's Guide to the Galaxy, the most important number in all of the universe. But maybe that joke goes flat here. So the notion is they came out with a number, and what they did pretty immediately is they asked for peer review of that number, which is the first step to me of what made this really powerful. In the United States, there's the national academies. Government can go to the national academies and say, we would like you to review what we did and tell us what we did well, and tell us what we didn't do well and how to fix it. So Ken Gillingham, who was working in the White House at the time, came to the national academies to a panel, and I'll talk more about this in a minute, and basically issued a charge saying, review what we did and tell us honestly, independently. This is not a justification or providing backing for a number. We could have said, this is terrible, you shouldn't use it. We didn't. And review this. So in late 2016, we issued a report. It's a beautiful report, I have to say. And then President Trump was elected and basically took that report, put it in the trash can, could not do away with the social cost of carbon because it's a number that was mandated, but did some really tricky things, which I'll show you in a second, changed the discount rate and turned it from a global into a domestic number, which essentially turned the social cost of carbon somewhere between $1 and $6 a ton, making it not very meaningful in most analysis. One of the first acts President Biden did after getting elected is reconvene the interagency working group, put the people back together, and said, let's update the social cost of carbon and address all the challenges by the national academies. So that's the story I'm going to tell you for the next sort of 10 minutes or so, which I think is just a beautiful story and one of the most fun periods in my life, I have to say. I like weird things. But the social cost of carbon, some people say it's not that important. It's used in benefit cost analyses just in the US alone in close to 100 regulations now with roughly $1 trillion in total benefits. So while nobody directly pays it, right, it prevents bad policy from being passed, right? And it also helps good policy make it across the hurdle for the right reasons in some settings. And we can talk about, you know, how big it has to be to do that if you want. Okay, so here's a terrible graph. So I'm warming up the room for Tamara Carlton and Marshall Burke, who are masters at visualizing data. But if you go from the bottom to the top here, that's how time increases. On the y-axis, you have a number of different rulings of how the federal government actually used the social cost of carbon in the past, starting with the 2008 NHTSA rule. And then, you know, we go from Bush 2 to Obama to Trump and now to Biden. If you're looking at the top row here, the 2023 EPA, the new social cost of carbon that was just peer-reviewed and is out of peer review now, is just simply much, much higher than what we had before. Now, I'll tell you a little bit why that is and where to go from here. But I think that the stark thing you should look at is the 2018 EPA number that essentially took that number to 0. And after adopting what we did here, again, the global number with the new discount rates, the number really did change. Okay, so quick reminder. So I don't know if Jim Stock is right or not. Jim Stock is usually right, but very rarely he's not. So the question is it time to declare victory on the social cost of carbon after this exercise and move on to other stuff? I'm in favor of both. I think some people should certainly continue working on adding sectors to the social cost of carbon and making it better. Is it the only thing that climate economists should be working on? The answer is definitely not, right? So why does the social cost of carbon matter? What you've got here in the green line on the left, if you have a $51 social cost of carbon, which is bringing the $42 number into $2020 right here, some things like clean power plan, you know, reforestation, maybe direct air capture doesn't make it yet, but you see a number of policies that under $51 actually make it, but a number are still to the right. So this is obviously not surprising to anybody in this room, but a higher social cost of carbon, if it's the right number, right, brings more technologies into a positive benefit cost ratio right here. So the new number is, just if you're thinking about scale here, somewhere around $190 right now. Low carbon fuel standards, we can talk about this for a while. I am not a fan. Okay, so how do you calculate the social cost of carbon? It's a modeling exercise, right? There's no way it has econometric components, but it is an integrated assessment model. It's super simplified, and every economist that's ever looked at has their favorite critique of what's not, you know, done here. Maybe it doesn't have the right geographic resolution and so on. But let me talk about what this actually does. So the first thing you need is a set of socioeconomic projections. So you need projections of population growth by region, not out to 2100, but you actually need it out to 2300. So really long range forecasts of population and income, right? How wealthy people are, and I'll get back to Elias's point from yesterday right here, in the future really depends on how well they can adapt to climate change, and also tells you how much built up stuff and valuable stuff is in the way of natural disasters possibly driven by climate change. So income really matters for both adaptation but also on the damages side right here. Then you combine population and income and you turn it into an emissions trajectory. So rich and highly populated gives you a different CO2 profile than poor and lower populations. Then you take that emissions trajectory, you feed it into a climate model, and it tells you a time series of surface temperatures and sea level rise and whatever else comes out of your climate model. That's the top right thing. And then you do, and that's what Tama and Marshall, I think, are going to spend some time about, translating temperature and sea level rise into economic damages. So you need a dose-response function like we have them in public health. If I give you an aspirin, will you have less headache? Only here is if I make it warmer, will you have more electricity consumption and more mortality? So that's where a lot of the economics comes in, is estimating these dose-response functions, translating temperature into damages. I'm also going to note that 98% of all public funding for climate change has gone into basically the top right panel right here. So 98%, billions and billions of dollars have been spent understanding the climate system. Very little money has actually gone into translating how the changes in the climate system actually affect humans and animals and land. So not asking for money, but just noting that maybe in terms of priorities, it'd be really good to switch towards the social impact side while continuing to study the climate system. So what's the social cost of carbon? Okay, we've translated wealth and population into emissions, emissions into temperature and sea level rise into damages. Then what you do is you go back and you add 1 ton of carbon to the atmosphere at one point in time, and you trace out how that changes temperature, sea level rise, how that changes damages, and then you take the wedge between the damages without the ton and the damages with the ton, and you get a time series of damages, because CO2 lives for 1,000 years or so, and you discount it into the present, and that discounted present value is the social cost of carbon. Why is this so hard? It's the fact that it's a stock pollutant and it has global effects across so many sectors. Okay. So that's what it is. The number, the interim number, and the one we're currently still using is $51 US per ton, but it is, we're on the verge of seeing an update here. So I promised I would talk about collaboration between academics and policymakers. So this National Academies report was just a wonderful exercise. Most people in this room above the age of 35 have probably been asked to do one if you're in the United States. So Maureen Cropper and Richard Newell, who are 2 very famous environmental economists, chaired it. There were climate scientists on there. There were people who do uncertainty. There were people who are doing expert elicitation. There were people who do demography kind of stuff on there, and a bunch of economists. And we came out with a recommendation basically saying, instead of the Excel spreadsheet that most people use to model the social cost of carbon, right? DICE lived in both a spreadsheet and some computation, but most of the other models were just Excel spreadsheets. Can you sort of break this out modularly, have people who understand something about GDP forecasts do those, have demographers who understand something about population do those, then have the climate folks build a climate model that actually reflects how the physical system worked. The previous version was a climate model that was peer-reviewed mostly by economists. Economists should not peer-review climate science. So you basically have this lovely modular structure where individual communities can work on improving these individual modules that then fit together sort of like a Lego toolkit to come up with that number. The big advance here, to me, everybody has their favorite aspect here, was to really think very carefully about uncertainty in the social cost of carbon and how that uncertainty propagates from the beginning, from the socioeconomics, through to temperature, through to parametric uncertainty in some of these models right here, to really get a full characterization of the uncertainty around the number. And they did an amazing job on that. other bits right here that we proposed, and this is, I think, a reasonable thing to talk about in this audience, is if you're going to use an econometric model to forecast 300 years out of sample, you're going to get crazy predictions. So there were two things made here that I'll talk about a little bit more, but a really clever combination of both statistical methods and expert elicitation, where experts sort of looked at forecasts and said, this isn't reasonable, we should rule these ones out right here. We're going to talk about damage calculations in a second. That to me was the other big thing. A lot of the damage functions in the old sort of climate models came from the time when Richard Toll wrote his dissertation in the late 1980s, early 1990s. We've done a lot of understanding of what temperature and sea level rise do to human well-being, so updating these damage functions is key, and I'll punt a lot of this to Tama and Marshall. Discounting was another thing. Instead of using sort of fixed rate discounting here, use discounting approaches that actually reflect the rate of economic growth in the underlying damage projection right here. So let me just quickly go through this and then close with something that's a little more entertaining, because we're just before lunch right here. It really took a village to get this done. Why? Right? So if the National Academies comes back usually and says, you want to improve this, the EPA goes ahead and hires a bunch of consultants and does a bunch of stuff themselves and updates the number right here. But under Trump, there was no interagency working group. So two groups basically wanted resources for the future that Jim did a lot of work with and I was a little bit involved with, and another group at the Climate Impact Lab at the University of Chicago basically held the torch and implemented all of the recommendations by the National Academies during the Trump administration. So there were 4 years there where people outside of federal government updated the number. When Biden got elected, on the right here you have 4 of the most important environmental economists in North America. These are my friends at the Environmental Protection Agency right here. The EPA could just pick up that work from those 2 modeling groups and implement it relatively quickly. So we did not lose 4 years, but we generated real science in those 4 years. So let me quickly just show you what this looks like, right? So this is your what an IAM looks like these days. Same thing as we had before, but now in box form. What was really cool about population projections is we've heard a lot about the SSPs, right? There's 4 or 5 of them. I always describe them, and this sounds really disrespectful, but when I give my kid a crayon and I ask him to draw a line, there's a line, right? It comes with a story, much like my kid's line is going to come with a story. The stories are different for the 4 different lines. It doesn't come with a probability, right? I can't tell you how likely any of these are, and I just don't know what to do with them, right? So what I really like about the new work that comes out here is they spoke to people who do population projections and thought about what does a full distribution of population in different regions look like over the next 300 years to fully characterize the distribution of population projections. Much like when we think of these beautiful money supply forecasts that central banks issue, where you folks did these nice sort of waterfall things for many, many years. So the gray shaded area here is not 4 crayons, but the black line here shows you, I think, the median of the population projections, but the gray fan right here fully characterizes the uncertainty around that. They did something very similar for GDP growth, and this is, maybe we can come back to that in the discussion a little bit. So Jim Stock, Mark Watson, and Ulrich Müller have this nice paper, How to Do Sort of Long-Run Forecasting. And I'm not going to do it justice here. If you have any questions or criticisms of this, he's sitting right there. But the basic notion here is forecast per capita growth rates of GDP instead of trying to forecast levels of GDP out here. So again, what you're getting, you have your crayon lines, the SSPs. But what this project did is it showed you a full distribution of what GDP growth rates, I do believe, by region look like for the next 300 years. The noteworthy thing here to me is we're still predicting sort of a perpetual sort of 1.7 percent growth out 300 years, which leads us back to what you sort of pointed at yesterday. The level of wealth predicted by that a couple of hundred years out is absolutely massive. And the question is, how does that, which ones of these are enabled by different types of climate scenarios here? So I think that's a question I struggle with. Emissions projections. I love this picture because that's where the kid got really excited with the crayons, right? So the SSPs have some really high emissions, some really low emissions, but again here you combine the population and the GDP projections and you get the full distribution of emissions going forward. So really beautifully done on the socioeconomic and emissions pathways. This is going to seem super boring, but I swear it's not. The old climate model in the existing social cost of carbon models, IAMs, was not good is an understatement, right? So most climate scientists, when they saw that, said, okay, we can do better. So there's now a very simple climate model in there. I believe it's called FAIR, that actually is consistent with physical principles of the climate system and how we think sort of emissions propagate into temperature. So we can translate in a consistent way temperature changes, but what I want to point out here is the uncertainty traces through the model now, right? I take one scenario, I draw a scenario of population growth and GDP. I can trace that out, what that does to temperature, and then I take the same assumptions and I feed it into my damage model. So it's internally perfectly consistent, and then it's just a question of computational power. So climate model is sort of boring, but really important. Where it gets really exciting is with damage functions. So the current model, when you listen to people say, what kind of damage function would you like in a best case scenario? It should be global. It should have long run adaptation. How is my great-great-great-great-grandchild going to air condition with what technology in the year 2250? I have no idea, right? Try and put yourself 200 years ago, 1823, and try and predict what today looks like. That's very similar to what we're trying to do here. It should be causal, right, because causal inference is important, should be valid over that 3-century period right here, should of course account for extreme events and nonlinearities, and should be spatially and hopefully also, sort of socio-demographically heterogeneous. So what we've got in the current model now is we've got mortality, energy, agricultural impacts, coastal damages, and labor productivity. That's currently in there. There's going to be more sectors, and I'll complain about which ones are missing. Ones we lost in the process from previous models were forests, water, vector-borne diseases. How do mosquitoes all of a sudden migrate, and where does malaria come from? Even though there's really exciting news about a malaria vaccine, so that whole thing might change quite a bit. And big storms aren't in there either. And we have nothing on species loss. I'm looking at Steve and Justin right here. That's your job, and habitats. Migration, air pollution, crime, and conflict, right? So we're limited to really 4 to 5 sectors in the current number right here. Everything else is not in there. Discounting. One of the most important things that didn't just happen here, but that also happened in the US more broadly, there's something called the circular A4 that tells you lots and lots of detail about how you're supposed to do benefit cost analysis and how governments discount certain values right here. That's just been updated for the first time in forever. So I highly encourage anyone interested in these types of topics reading it. It's a really great accessible tool that lays out some of the most recent literature right here. But they really changed discounting. So Billy Pizer and Richard Newell were sort of really at the helm here saying, the rates should be consistent with policy rates, so somewhere between 2 to 3%. There was a really nice expert elicitation by Moritz Strupp and a bunch of others in the AHA policy that sort of said, most experts think a 2% rate is roughly the right way to go, but it should certainly take into account economic growth in the way we teach in graduate school right here. So what they did here is they took this, and there's a paper that's been hotly discussed, but how to actually calibrate parameters for these discounting modules to match near-term rates, where you then have to really think about what long-run behavior of interest rates is. So there's some nitty-gritty stuff here about interest rates that's actually really important in the social cost of carbon that folks that do macro have things to say about. Okay, so the question I want to ask, I only have like 6 more minutes right here. Did the number change? Yes, it changed a lot, right? So the interim values, that's the old models, are on the left. So that's the distribution, because you run these sort of 50,000 times and you show a distribution of the social cost of carbon and then report the mean or the median, depending on who you are. On the right-hand side is the distribution of the proposed values. So the thing to note is everything changed. The scenarios, the climate model, the damage functions, the discounting. So there was a lot of snark out in the literature saying, oh, you just changed the discount rate. I could have done that. You could have saved yourself all the work, right? So you're seeing in the old times it was 2.5, 3, and 5%. The new values are 1.5, 2, and 2.5%. So is it just the discount rate? We're overlapping at 2.5% for both of these. If you compare them, for the 2.5% discounting the old values and the new values, the distributions are fundamentally different right here. So it's not just the discount rate, it's the approach to discounting. It is all of these other good things that I've talked about a second ago. So science here really made a difference in a policy relevant parameter that is really important. Now, one discussion I keep on having, and this is something that I don't think there is full agreement here across the economics profession right here. What I'm showing you currently are the damages to the entire world. Why should the United States care about what happened to Chileans? Why should Chileans care about what happens in the United States? Shouldn't you just count damages here in the Andes and on your land and so on and ignore what happens elsewhere? So there's been a push by a group of people to say maybe the domestic number is the right number, which of course is a fraction of the global number right here. I'm going to use this soapbox and just say the domestic number is the wrong number to use. From economic first principles right here, if you want to get to the optimal emissions level and benefit cost analysis, you have to use the global number. Because if everybody compares their number to their domestic number, you're not going to sufficiently invest in mitigation or pass the wrong rules. The question then is, well, Max, you don't like it, right? But could we calculate that number? Well, you could write one down or estimate, right? But the thing I keep on saying is the social cost of carbon on Americans, for example, is not just physically in the United States. There's 9 million Americans living abroad, some serving in uniform in other places, others just working elsewhere. So if you're just using the domestic one, you're ignoring all American citizens elsewhere. You're also ignoring the security risk to individual countries from climate-driven conflict elsewhere. And you are completely not getting effects on international trade and sort of general equilibrium effects, which frankly aren't fully in these models yet anyway, so that's really a cheap shot. Okay. One other point, and then I actually want to skip my usual whining and just tell you something about windmills for a second, about other things that are interesting. But there's this concept of equity weighting, right? So the notion here is pretty simple. A given consumption loss, if I lose $1, I'm a well-paid economist at a fancy university, if I lose $1, it doesn't hurt as much as if somebody else who makes $5, $6 a day loses that same dollar, right? So there's a bigger loss in well-being to a poor person from an equivalent consumption loss than to a rich person. There's an approach called equity weighting, which goes way back. It never really made the mainstream right here, but it recognizes this and just simply assigns a higher weight to climate damages occurring to low-income regions. So this is not necessarily just equity within a room here, but this is just recognizing that different countries have different levels of wealth here. And this is not some Berkeley hippie kind of approach right here. This is consistent with standard economic theory, but it's a different way of calculating the social cost of carbon. Now, is this something that Max just talks to his students and friends about and nobody cares? The Bundesumweltamt, which is the German Environmental Protection Agency, actually uses an equity-weighted social cost of carbon because they think it's the right number to use. Does it make a difference? Makes a massive difference. So David Anthoff is working on a paper to do this for CO2, and the numbers, I assume, are going to be much bigger. Okay. Can I use 4 more minutes to talk about something that came up over dinner? Okay, I'm going to skip a bunch of, oh, sorry, before we get to this one, was going to complain about missing sectors, but you know what they are. One thing I'm just going to say, open source computation, like Justin said yesterday, is clearly the future here. There used to be this attitude that individual economists had their little consulting shops with their little model, and they were hired by people around the world and made a huge amount of money doing this. But it prevents progress and it prevents good science. What David Anthoff and Fran Moore and others did, they put these models, the official EPA models, into something called the MIMI project. You can download it all. If you can write in Julia, which is a really fast computational language, if you can write in Python, you can write in Julia. You can run these models really easily, really quickly. You can modify them any way you want. So simply putting these into the light has made a huge amount of difference. Okay, so one thing I quickly wanted to conclude here and then talk about windmills for a moment. The social cost of carbon is clearly important, but I think where that number, whether governments use it or not, is of course up to individual countries. Not each country needs to calculate its own. Once we've calculated this number once, everybody else can go ahead and use it. So that's a nice sort of public goods characteristic here. But somebody yesterday brought up this notion, like, what's the role of the corporate sector here in emissions control right here? So large corporations adopting internal carbon prices or imposing an internal social cost of carbon. Amazon, for example, has committed to being, net zero by some year. And they've taken this really seriously and started thinking about how do we incorporate a carbon price internally from soup to nuts, right? From the time you manufacture the thing until it arrives in the big bubble wrap box at your door. So the social cost of carbon also gives folks just a guide as to how high that number could be. There's subtle differences along optimal policy path versus not, but we can talk about that over lunch. Okay, something came up over lunch or dinner yesterday that is my favorite project that we just finished. It's coming out in a nice journal in a couple of weeks. Chile is at the frontier of building massive amounts of renewable energy infrastructure. There's wind in the south, there's solar in the north, and one of the big things, the costs of the renewable energy transition that keep on being used against the cost of the renewable energy transition. So this is my link from the social cost of carbon to another cost. There's this story that we hate the view of windmills, right? So Johannes, I think, mentioned that this morning, that people really don't like the visuals of windmills in their front yard and it's damaging people's well-being. So I asked the same question 10 years ago and just couldn't figure out how to do it. So if Sophia and I live next door to each other and I can see a windmill from my house and she doesn't see the same windmill, I can compare the value of my house to her house, accounting for number of bedrooms and size of yard and so on. And if I did this for all the homes in the United States, figure out what the visual disamenity from a windmill is. So what we did here is windmills don't kill birds. They do kill a couple of birds, by the way, but house cats kill 2.4 billion birds a year. Windmills, $234,000. So lock up your cat, don't protest against windmills is the, sorry, you want a picture? I'll send it to you, a high resolution. And this comes from the US Fish and Wildlife Service. This is not some, no, there's a real externality to having house cats. Windmills are huge, right? So what we did is, are solar and wind farms ugly or beautiful? I think they're really beautiful. They remind me of watching Star Wars. Other people think they're really ugly, so I wanted to know, on average, do people value these or not? So what we did, using a crazy amount of computational power for the entire United States, calculated which homes can actually see a windmill and which homes can't. So you need to calculate, there's windmills everywhere, there's houses everywhere, so pink here is windmills, blue is housing values, And then we have a high-resolution surface of the United States. We know where every windmill is, how tall it is. We know where all the houses are and how much they sell for. So I can show you which houses. The pink one over there cannot see the windmill, but its two orange neighbors can see the windmill on the hill. We do this for all housing transactions in the United States over the past 25 years and wanted to figure out, do people dislike having windmills next door? The answer is, if you live right next to a windmill, yes, you don't really enjoy it. So you have to, but you have to really have the windmill like a half a mile to a mile from you, consistent with roughly a 5% drop in property values. That value diminishes and is essentially indistinguishable from zero at about 6 miles or 10 kilometers out. At that distance, if you held an aspirin tablet in your hand about an arm's width apart, that's how big the windmill, average windmill appears right now. So the further away you are in space, the less you care. The average number we came up with, it's about a 1% drop. Oh, sorry, I'll stand right here. Thank you, that's very kind of you, but this I'll just reposition, different type of adaptation. So we looked at, the average number is about a 1% drop in home values, but the interesting stuff here is we show that low-income folks mind this view much less than rich people, and Republicans really hate windmills much more than Democrats do, and more windmills is worse than fewer windmills. Maybe the most important finding, and I swear I'm almost done right here, is if we look at a time trend in that treatment effect over the 30-year period that we look at, that effect diminishes towards the end of the sample. So the first windmills, when we didn't know what they were, people were like, oh, that's really ugly. Now they put them up and we're just like, it's like transmission infrastructure. You don't even see it's there anymore. It's just part of the landscape, right? So it seems that over time we've gotten used to these windmills and that effect has gone to almost zero, okay? So what I want to conclude with is, and I'm sorry I hijacked the last 3 minutes here with a just really tangentially related project right there, but I'm really interested in not just the social cost of carbon, right? How much damage do emissions do by 1 ton, but thinking about how do we estimate the costs of the underlying energy transition going forward that enables us to meet the carbon challenge right here. So I think, you know, folks should continue working on the social cost of carbon, but I want us to think much, much more broadly. I was really excited by this habitat work yesterday, looking at the macro work. We're going to hear about migration later today. So I think our toolkit and how we look at the world is uniquely suited to help answer some of these big questions that stand in the way of you know, coming even close to that trajectory I showed in the beginning. So thank you very much, and that's all I got to say.
Thank you, Professor of Hammer, for a very compelling and interesting talk. Yeah, Elias.
Thanks, Max, for that great presentation and the evidence you provide for pet control in my house, which I hope it will be effective. I have a question about what exactly enters the new work that's being done on the social cost of carbon, in particular related to something we touched upon briefly yesterday, related to tipping points. So there was a paper presented that had some simple functional forms that had tipping points in it, which I thought it was the right conceptual approach, which is not present in most models. I'm just guessing it's not present in the computational social cost of carbon. And I'm not sure why. I mean, there seems to be a well-populated, relevant literature on tipping points. We are not sure about their probability. We are not sure about their costs. But the recent work is basically telling us that the tipping points are closer and they're more likely than we thought they were. So if you take a simple model and you add the probability of switching to another equilibrium, you put basically a Lagrangian multiplier to that, right? That will increase the social cost of carbon, I'm guessing significantly, because every half a degree Celsius, puts us a lot closer to hitting some of those tipping points. So there's a lot of uncertainty on the tipping point themselves, but there's a lot of uncertainty in everything that's related to this. So it's not a good reason to exclude them. And my prior is that this is like a big quantitative change if you include it in the calculation. So I would love to hear your thoughts about that.
So I think that's a... Got it. I think it's a great question. When we say tipping points, you always want to worry, are we talking about climate tipping points, or are we talking about sort of on the damage side? So the old models page, I think, had extreme events in there, right? So there were some sort of tail events that were modeled right here. I wasn't quite sure, what they were. It was like a category of extreme events. So I'm not sure, the sort of nonlinearities and what's in the FAIR model on the climate side. I know on the damages side, if you look at the mortality functions on all of those are highly nonlinear. But I think if I were to answer your question, the beauty of this now is if you think there's something missing, you're the MIMI project away from actually adding it and seeing whether it makes a difference right there, right? So I think what we've currently got in the light under the EPA numbers are things that pass, strict peer reviews, sort of best sort of scientific standards right here. But to get order of magnitudes of some of these things out and see whether they should be added, I think, you could do it, and there's certainly teams working on that. But Bob Pindyke has been sort of saying that for many, many years, very, very loudly, saying, all this social cost of carbon marginal impact stuff is not the stuff we should be looking at. We should be looking at the big disasters. That's where the costs come from, even if they're low probability events. But putting numbers on that is hard. He's got a paper where there's some numbers in there, but they're certainly, I don't think they're in the current models.
This is a great overview, and we keep our cats indoors. I want to underscore a point that you made. This is a little bit more of a comment than a question, although I'll try to make it a question. I want to underscore a point that you made, which is that this has really been a team project by a large group of economists over many generations to accomplish this. When I was in the when I was a member of the Council of Economic Advisors in 2013, it fell on my shoulders to take us into the 2013-2014 release, and which is where we got the $51 number, traces to that revision. And it was, in hindsight, just remarkable how much, that was 10 years ago, how much resistance there was internally. The political, we had a lot of trouble actually getting that release and getting it over the political hurdle of doing it. We actually ended up doing the release on the Friday before Memorial Day weekend. And the only reason that it actually got out is that the president overruled his political advisors and wanted to see it happen. But this is just, there's so many people who have been involved with this over many years, and it's really a huge triumph. I guess the one thing that might be a little bit more of a question is going back to my assertion that this is just a fantastic line of work. There's a ton of open questions. We can still think of many ways that this could be improved, but if you go back to the abatement cost figure that you had, this updated one from Larson et al. 2022, most of those are well below and I think you made this point, they're well below the 190, 180 range. The ones that are above have they would fail just any old cost effectiveness test. LCFS is just a mess of a policy compared to many alternatives that will be decarbonizing much more effectively, efficiently, and more rapidly than an LCFS within the transportation sector. So this is, I think I'm just repeating myself here with this assertion that, while this is really interesting and we could all pursue these interesting intellectual questions further, that might not be the highest and best use. But it's a good example of how we as economists have already teamed up and worked on different aspects to really make a really important contribution, but now there's new contributions to make.
So I agree with all of that. The one thing where I still think there's interesting economics to be done, other than just estimating more damage functions, is the sort of general equilibrium stuff that some of these trait models are now trying to incorporate to see how that affects the overall number. Because right now there's, what happens in one region doesn't really affect another, and that's clearly not how that's going to work. So, I'm always thinking about, is it policy relevant and can I publish it in a really good journal? At the same time, that stuff I think is clearly there's a huge upside, and we saw some examples of these models in this conference. But I'm with you. There's other stuff that's much more pressing than all of us working on more damage functions. Some people still should.
Yeah, super quickly. So thanks for great talk. So a couple of just reflections and maybe a suggestion as well. So there's also comparable data on house value increases relative to those that have put photovoltaics on them. And that's changed over time, and so that would be another data set, I think, to really look at in the United States and maybe beyond the United States as well, because now you've got distributed PV in gigawatt scale in Brazil and elsewhere as well, going on. And then also a counter data set might be interesting. My gut tells me it's a counter data set in the UK, where the value proposition to a homeowner for a wind turbine actually is beyond the value of the house, but it's actually the cost of the energy provided by a given company. That is not in the calculation in the United States, I believe. It's a purely separated distinction between, I'll call it the visual impact and the value of the house. And so there may be a subtlety there that changes the value proposition and I'll call it the consumer value, depending upon what I'll call it the offer is. And so PV has a different offer, wind in the UK has a different offer in the US as well. So potentially, and I don't know if you've got any thoughts on the PV system economic value proposition relative to wind or not, if you've studied that data. So thanks.
So the only thing I'm going to say there is the windmill doesn't do anything to my house. I put up PV when I put on a new roof, and we painted our front door, and we put in a new kitchen. So if the causal inference police comes after you, it's much harder to break that with a solar PV system, which is a private decision, versus the windmill. The only private decision is, do I stand outside with a sign yelling, I don't want any windmills in my view shed. But Ken Gillingham has asked some of these questions really nicely, and I think Stephen Jarvis at LSE is doing some work along those lines in the UK. So it's a hard but really interesting question.
One last question.
Yes, thank you so much for this great presentation. I want to double down and emphasize something that you noted near the end about the importance of open science and open source code. And I'll give you a very brief story. We had a student come through who wanted to run dice, and he used the Excel spreadsheet, and then he used the hard-to-use GAMS code, but I pointed him to the Mimi Julia page, and this has been greatly effective at accelerating his work. And so I would just list this as an example of something that would have taken, which was a master's student more or less all of his time to get his head around this, is becoming something that is both a better and more replicable program, but also just much faster at getting new researchers up to speed. And so I just want to compliment, the efforts there with the MIMI project and all the other related things, and to say that I really think this is the way to go, and that this will have direct benefits for some of the research that I presented the previous day, because it's sort of obvious how you can take then these models, and we didn't have a climate model in our ecosystem services model, but it's sort of an obvious next step, and that's what we have this student doing. So I wanted to just compliment on that particular point.
I'll close with one cute anecdote. I was giving a talk at some conference at MIT, and I put the MIMI thing up. And then some guy asked a question that I didn't know the answer to, and 20 minutes later, same guy raises his hand and says, "Oh, I just downloaded MIMI. I did this. I added this little module thing, and I changed it, and the answer is 4, just so you know." So it's, I mean, there's a combination of MIT students and the software, but it is, I agree, just absolutely the way to go.
Well, thank you, everybody, and thank you, Max. Let's give him a round of applause. Thank you for the talk.
Thank you.
So now it's time for their lunch. We're going to reconvene in 1 hour, 1:30.
you very much, everyone, for joining us now for the fourth session of the conference, which is entitled Climate Change and Ecosystem Services Degradation from a Multidisciplinary Perspective. And I think Max did a very good job with his keynote lecture as an introduction for the talks that we are going to have today. We are going to start with Tama Carleton. She's an assistant professor at the Brennan School of Environmental Science and Management at UC Santa Barbara. She's the director of the Energy and Climate Program at the Environmental Markets Lab, an affiliate of the Climate Impact Lab, an affiliate of the Center for Effective Global Action, and a faculty research fellow at the National Bureau of Economic Research. She completed her PhD in agricultural and resource economics at UC Berkeley, and she's an environmental and resource economist focusing on questions at the intersection of environmental change and economic development. So we thank Tama for joining us today, and she is going to present, her talk is about updates on the social cost of carbon. And then we are going to have the pleasure to have Joaquin Vial as a discussant. Joaquin is an adjunct professor at the Economic Institute of the Catholic University of Chile, and he is a researcher at CLAPES UC. Previously, he was a board member of the Central Bank of Chile and vice governor of our institution between 2018 and 2022. Joaquin completed his PhD in economics at the University of Pennsylvania, and his research areas are economic development and natural resources economics. So now we welcome Tama, and the floor is yours, Tama.
Great, thank you so much. Thank you to the organizers for the invitation to talk about the SCC with you all today. Max did a great job setting this up. I'm basically going to give you a window into some of the inner workings of one of the models that led to updated SCC estimates recently. And I want to highlight throughout this talk how these updated models allow us not just to improve our estimates of the SCC, but also to begin to unpack the inherent inequities in the climate change problem. This is all collaborative work with the Climate Impact Lab. We're an interdisciplinary group of economists, climate scientists, computer scientists working to build high-resolution projections of climate damages over the coming century. So I don't need to motivate this very much because Max did such a great job. I just want to put this in one given perspective. So the idea here is that all of the motivation factor behind the SCC is simply that mitigating greenhouse gas emissions is expensive. And so policymakers are trying to weigh the costs of that mitigation against these diffuse benefits that occur to many diverse populations around the world across many different years into the future. And so the SCC comes in by monetizing those benefits of avoiding a ton of emissions so that policymakers can weigh, in an apples to apples way, the benefits and the costs in the same sort of monetary units. Max gave you a great history of how the SCC has evolved, particularly in the United States, and it's been used and adapted in many countries around the world. I want to just put sort of a cherry on the top of that history and pointing out that very recently we have an indication that the SCC is going to be used in a much broader set of policymaking. So in September, the Biden-Harris administration announced orders to agencies to incorporate the SCC into many different government decisions like procurement, international aid, budgeting. And this has implications for the billions of dollars a year that the US government spends and things like its very large vehicle fleet of 600,000 vehicles. And so I think this is more motivation for us to get the number right and to think broadly about how this tool can be used to solve the climate problem in a much broader set of policies than has previously, at least in the United States, been used before. You don't need me to tell you why the SCC needs updating. Max did that really well, but I am going to focus particularly today on the damage function component of this. Many other components of the original SCC estimates needed updating, but in particular, I'm going to focus on how we build accurate climate damage estimates and these damage functions. One component I think that maybe we haven't talked enough about when thinking about why we should bother updating these SCC estimates is I think that spatial and sectoral resolution of newer SCC models are not just nice to have features, but I think are really important in building policy relevant metrics that come out of these processes. So on the one hand, when we're building aggregate SCC numbers of the total global damages that are designed to inform mitigation policies, we are going to get those aggregate climate damage numbers wrong if we mischaracterize or fail to characterize heterogeneity around the world. And that's just because all of these systems are highly nonlinear. So using aggregate damage functions and aggregate exposure to warming is really going to miss the overall number when we think about the extreme amount of heterogeneity that we see around the world. But the other reason is thinking about adaptation. So we've been talking a lot about the SCC and mitigation, but regardless of what we do on mitigation in the coming decades, we have a huge adaptation problem going forward. And local individuals, governments, businesses cannot appropriately plan for the future and thinking about resiliency if we don't have highly resolved estimates of climate impacts that are sector specific. And I think, I've been enjoying watching this debate between Max and Jim from afar about how much effort we should be putting into this type of damage calculation going forward. I think it's an important debate to be having. I think one thing to add to that debate is the importance of adaptation and the importance of better characterizing damages if we are trying to inform not just mitigation policy, but also adaptation policy. There's sort of no better example of the importance of these heterogeneities than last summer's devastating floods in Pakistan. You're seeing a picture of that on the left that were happening at the same time as we were getting a heat wave across the United States. The human welfare implications of these two events, both of which are driven by the global process of climate change, are obviously very, very different. So part of what we want to do is capture those differences as well as get the overall SCC number right. So Max laid this out really nicely. We are in an era for SCC estimation where we can do a lot more than we could in the past. This is mobilized by increasing availability of data, econometric methods, computing resources that are now at our disposal. And so we want to be and can be building SCC estimates that are built off of empirical, data-driven evidence, the best available climate science. We want to be globally representative, not just taking data from places that are wealthy where data is easier to access. We want to think about adaptation into the future and value uncertainty and inequality. Unfortunately, the SCC space is full of annoying and difficult to remember acronyms, and I'm just going to add another one in for you. Our model that we've built to sort of answer this call is called the Data-Driven Spatial Climate Impact Model, or DSIM. The only thing I would ask you to remember about this is the data-driven and spatial part. So the idea here is we want to meet this call for updated SCC estimates using an empirics forward data-driven approach and one that is spatially resolved so that we can inform not just mitigation policy, but also thinking about adaptation. We're going to be building climate damage estimates at the scale of about 25,000 regions around the world and thinking really hard about uncertainty in many dimensions, but particularly the climate dimension. So we're going to be using probabilistic climate model representations that think about the full uncertainty of warming that we face going forward, but also uncertainty in the spatial distribution of that warming. There was a really interesting question about tipping points earlier. I want to address that right now. I would say explicitly, we are not integrating tipping points. I think the question asker was correct that that's a really important thing to think about going forward. But this characterization of uncertainty does include some really extreme climate scenarios. So we have climate models, low probability, but they're in here in this distribution. Climate models are projecting warming up to 8C into the future. Given the nonlinearities in our damage functions, those are going to lead to some really severe damages. But I will point the audience and the question asker in particular to work by James Rising and Simon Dietz, and co-authors focused on explicitly trying to update these models to take into account tipping points. I think there's a lot of progress being made there. The other key feature of our model is that we're thinking about impacts that are empirically derived and heterogeneous around the world. So what you're seeing on the right are examples of what Max called a dose response function, where you're seeing some outcome of interest, in this case, mortality risk on the y-axis and daily temperature on the x-axis. And the global average dose response function in blue, you can see really misses what's happening on the ground in individual locations. So in contrast, in Oslo, Norway, a very wealthy and relatively cold place, we see a very different response than we do in Accra, a poor place that experiences an extreme amount of heat. And so the idea here is characterizing these locally will allow us to build better estimates of the SCC, but also think about local adaptation needs. Our approach to this problem, which looks different than I think there are other valuable ways of thinking about this problem. We're taking a bottom-up approach, which means we are going to be building estimates in a sector-by-sector fashion in just seeing scenario assumptions first that come from other modeling groups about future population, income, emissions, et cetera, including some of the new probabilistic scenarios that Max pointed out in his keynote. These are the sectors we are currently tackling. Those are then integrated together along with a simple climate model and then valuation assumptions that involve discounting, inequality, and uncertainty to build an SCC. What I'm going to sort of give a window into today is how each one of these sectors itself has sort of a pipeline starting with historical data on an outcome in that sector of interest and how it has responded in the past to climate events through an econometric model, and then pulling that through climate change projections and what we call a partial social cost of carbon, which just involves the damages in that one sector. And once we build that for each sector, we will combine them ultimately together into an overall SCC. But this is a bottom-up approach where we're going sector by sector and characterizing heterogeneous damages across these different sectors. This is sort of the outline of how we tackle this problem. We are a data-driven approach here, so we're going to start with data collection, build econometric models that importantly try to capture dimensions of adaptation that we think may be important. We want to think not just about the benefits of adaptation, but also their costs. I will briefly touch on this in this short talk, but happy to answer questions if people are interested. And then finally, we want to build those econometrics into climate change projections of the future, translate those into damage functions that allow us to compute an SCC. And then I'll talk briefly at the end about the many interesting welfare questions about how you take empirical damages and turn them into an SCC, thinking about inequality and uncertainty and discounting in a variety of different dimensions. Okay, so starting with data, our attempt here is to build the most comprehensive data sets we can for each of the outcomes of interest. I think this is a rapidly evolving space and all of these maps could probably look better than when each of these projects started. But you'll see that there's a lot of heterogeneity in what is feasible for each of these categories. So here we're thinking in energy about energy demand going forward under climate change, particular changing heating and cooling demand. The data that we have are very spatially comprehensive, but also very spatially coarse. We're using country-level data at the annual scale from the International Energy Agency, including residential, commercial, and industrial electricity and other fuels. Mortality looks very different. We have much higher resolution data here, but much poorer spatial coverage. So we have subnational age-specific mortality records for a little over half of the global population, with really important omissions in key regions of Africa and Southeast Asia in particular. And I'll talk about how we try to tackle that going forward. In agriculture, we have subnational crop production data for 6 different staple crops, including crops that are very important as subsistence crops in key regions of the world. You can see the spatial coverage is maybe a little bit better, but we're still missing really important regions, and I think that's an important thing to think about going forward. In labor, some SCC models think about labor productivity. We're going to think about sort of the disutility that laborers are experiencing when they are faced with extreme heat on the job. And we're going to do that using time use data that tell, where an individual writes down what they do every 15 minutes for, say, a week. And you can get very precise characterization of how many minutes per day a worker is working. These represent about 30% of the global population. And again, there are important data gaps we're going to have to work to fill. And then our final sector is the coastal sector. We've constructed a lot of the data necessary to do this exercise. So downscale measures of both the exposure, so what type of sea level rise are we looking at, but also the hazard. So what is on the ground, what types of people and infrastructure and value of assets is sitting on the ground at high resolution that could be exposed to this coming hazard. And these data sets are all publicly available. So with that data, the next step in our approach is sort of the heart of a lot of our damage function calculations, which is to try to econometrically estimate how these outcomes have responded to climatological events in the past. We build on a very rich literature in climate impacts econometrics to estimate these models. These are now very standard at this point. We're just applying them to our particular setting. So for example, the way these models might work is to relate age-specific, location-specific mortality rates to flexible functional forms of temperature and precipitation in that place, using a suite of fixed effects and other non-parametric controls to isolate plausibly random variation in the weather. The idea is comparing mortality in Santiago under a year with a slightly hotter summer than to a year with a slightly cooler summer. We recover very standard nonlinear relationships in many of these sectors. For example, mortality has been studied extensively by economists and epidemiologists, and this sort of U-shaped relationship for the over 65 population is very common. Extreme heat and extreme cold both elevate mortality risk. So this gives us sort of an average sense of vulnerability. But what I've been talking about a lot is the importance of characterizing inequality and also characterizing adaptation. And that type of average dose response function ignores the fact that different populations are very differentially vulnerable. So we build on this model to allow the shape of that curve to itself depend on conditions in a given location. So for example, I'm sitting here in Santa Barbara. We don't get enough hot days for me to invest in air conditioning. I'm not very well adapted to a hot day, but someone living in the southwestern United States that sees those hot days all the time likely do have an air conditioner, and they likely respond in a given to a given outcome, whether that's mortality or energy, in a very different way than I do. So we're just going to build slightly on this model by including a vector of covariates that will shape that response function differentially based on the conditions in a given place. That can be income, it can be climate. For agriculture, that's going to be irrigation, etc. And visually, what this allows us to do is to capture differential vulnerability as we have seen it manifest in the historic record. So if we go, for example, to the coldest regions of the world, the figure on the right is showing you the marginal effect of a 35-degree day relative to a moderate 20-day for these vulnerable populations of 65 and over. And you see the death rate is projected to be incredibly extreme for this population in the places where those hot days are very, very rare and not expected. But reflecting adaptation we can see in the data, we see that in warmer locations, that marginal effect declines somewhat pretty substantially, such that by the time you get to the hottest regions of the world, this curve is much flatter. We're seeing very low marginal responses to heat in the places where these days happen a lot and people expect them to occur. This is important when thinking about average climate driving adaptation, but of course, income facilitates investments in adaptive technologies. And we see this really shining through in our work on electricity, where we see that the sensitivity is very much driven by income. So if you look on the right, you're seeing now a dose response function for electricity consumption. We see people increasing their consumption, both to respond to cold and to respond to heat. I actually lived in Chile at one point, and the lack of response was very notable to me. I was like trying to study in the middle of winter, and there was not a lot of indoor heating. And so we weren't seeing a lot of this increasing expenditure on electricity in order to respond to cold, which is what we actually see in the data. So while in the wealthiest regions of the world, we see this protection against cold and heat by increased electricity consumption, we don't see much of a response, even in slightly poorer locations. And for the vast majority of the global population, there's virtually no response. So these are not places where people are using energy services to respond to daily fluctuations in temperature. And that's really important heterogeneity to capture relative to what we're seeing in the wealthy regions of the world. That's going to be important when thinking about heterogeneity and vulnerability today, but particularly when we think about the future. Moving these dots forward under projected income growth means that we're going to have to think about a changing dose response function as people get wealthier and wealthier over time. Each of these sectors, we uncover sort of different drivers of vulnerability and therefore different drivers of heterogeneity in these response functions. So for electricity, we see that income is really important in facilitating investment in energy services to respond to climate events. In labor, it seems that the sector of employment is incredibly important in determining sensitivity. This aligns with prior work from the United States and a few other regions. So what this means is that workers who are working in what we call high-risk sectors, agriculture, mining, construction, manufacturing, we see a large drop-off in their time spent working when temperatures get very extreme. In contrast, for those of us that work inside in climate-controlled environments, there's no statistically significant relationship between daily variations in temperature and the amount of time that you work. And so when we think about this sector, both across the world and going forward, what's really going to matter is how many people in your economy are employed in these high-risk sectors today and going forward. And then finally, in agriculture, there's, I would say, sort of the econometrics of climate impacts really began in agriculture. There's an enormous body of work thinking about the weather conditions that matter for agriculture, as well as the covariates that may shape your sensitivity to those weather exposures. And so we take a little bit of a different approach in this sector, where we take some sort of basic machine learning tools to try to unpack which weather exposure measures and which covariates are best predicting the overall variations in yield. And this process leads to some pretty intuitive outcomes. So for example, if you look at the lower right, you're seeing how maize yields on the y-axis respond to variations in precipitation. And as you might expect, irrigation is really important here. So places that are very highly irrigated don't see much response to variations in precipitation. They're insulated from the impacts of drought and extreme, to some extent, extreme positive rainfall, but in places with no irrigation in blue, there's a lot of sensitivity of maize yields to dry conditions. We use this type of surface with a variety of different covariates and weather exposure metrics to build high resolution estimates of sensitivity for each of these crops. And you can see, for example, sensitivity of corn in Illinois looks very different. And in fact, something that's documented in Marshall, as in many other people's work in the past, we actually see in the United States much more sensitivity to heat than we do in places in South America, for example, in Mato Grosso in Brazil. So these econometric estimates allow us not just to characterize the shape of the response function, but also how it differs across populations, reflecting differential adaptation we can see in the historic data and can inform what we might see adaptation-wise going forward into the future. But the challenge with just taking that sort of what we call a response surface, so dose response functions that vary over space and time, and taking those forward into the future to calculate climate damages, is that those changes in sensitivity reflect the benefits of adaptive actions, but not their costs. So if you think about a heuristic mortality response function, for example, here at the top gray line, that top gray line reflects a very vulnerable population where death risk rises substantially under extreme heat and extreme cold. And we want to think about adaptation either through income or climatological adaptation, pulling that curve down towards a flat line. The perfectly adapted location or population would be one in which death risk does not vary at all with variations in daily temperature. But to achieve that flatter line, we have to pay some costs going forward. We have to invest in air conditioning. We have to change the hours that we spend outside. There's a variety of monetary and utility costs that we must incur in order to achieve that adapted state. And we want to generate projections going forward that don't just characterize those benefits, but also attempt to characterize the costs. This is a really hard problem. There's a lot of different ways to try to tackle it. We take one approach. I think there's a lot of other work that can be done to improve upon this approach. I don't have time to get into the weeds of it, but essentially what we do is build a revealed preference approach to try to infer what those costs of adaptation must be under a variety of stylized assumptions. So the idea here is that the full value of the climate impacts that we want to measure are not just the impacts from temperature hitting your outcome of interest, but also whatever adaptation you incurred to change your sensitivity from some original sensitivity we can characterize heuristically with beta 1 to a future sensitivity beta 2. For example, if we want our agriculture to look like it does in Holland with these highly insulated greenhouses that very closely control the climate, we're going to have to pay for the energy and infrastructure to achieve that resiliency. This, our approach here builds on a lot of prior work thinking about revealed preference and adaptation decisions. And the idea intuitively is that we are going to start by assuming that what we observe in the data are investments that people are making to optimally trade off the benefits and the costs of investing in adaptation. If we make that assumption that basically on the margin, people are equating marginal costs and marginal benefits of adaptation, we can use the fact that those econometric models I just showed you gave us estimates of the protective benefits. We can see how two different populations with slightly different climates invested differentially in protecting themselves, say, in terms of their mortality risk when we observe a hot day. We then use those estimates of protective benefits to infer what the cost must be under the assumption that people are making rational decisions and weighing marginal benefits against marginal costs. We integrate marginal costs out over the coming century to get estimates of total costs, essentially building revealed preference estimates of adaptation. I think there's a lot of exciting questions and work to be done here. This is making a lot of assumptions about rationality of investments in adaptation. I think there's exciting work about belief formation and expectation updating that should play into updates and improvements in thinking about adaptation costs going forward. So at this point, with an empirical estimate of dose response functions reflecting adaptation benefits, a revealed preference approach to try to capture adaptation costs, we can generate projections into the future of what climate change may do for each of these sectors at high resolution. The problem of doing this is one, not just about projecting over time, but also about filling in over space. So as I made clear earlier, we don't have comprehensive data on these outcomes of interest everywhere. And so we face a spatial extrapolation problem like the one that you're seeing on the slide. These are the places where we have data. You're seeing each region colored by the marginal effect of a hot day on the mortality risk in that 65 plus population. We can see a lot of variation in our sample, but there's a lot of places that are missing. What we do is use that estimated response function that we've built from these observational data to infer what sensitivity must look like in the places where we don't have data. So for example, we have some really nice mortality data from Chile, but we do not from Argentina. So the idea is sort of a covariate matching idea in which we say which regions of Argentina look very similar in climatological in terms of their climatology and in terms of their income to certain regions of Chile, and can we infer sensitivity to heat for that region of Argentina looking at the variation we have in our observational sample. We do that to fill in this map so that it looks not just like this, but instead like this, to reflect heterogeneous sensitivity around the world. Of course, this is a massive amount of spatial extrapolation, and we expend like many appendix sections in each of our papers trying to probe the reliability of this assumption. But critically, this allows us to at least attempt to characterize heterogeneous sensitivity instead of imposing the assumption that, say, sensitivity we see of mortality to temperature in the United States applies to regions in sub-Saharan Africa. And you can see this sensitivity on the map reflecting, in this case for mortality, both the role of income and the role of climatology. So in cold regions, we're seeing very high sensitivity, but we're also seeing high sensitivity in regions that are very hot, but are sufficiently poor that investment in adaptive protective technologies and behaviors is infeasible. This is what our map looks like when we think about sensitivity today. But as we project into the future, now that we've sort of filled in estimates for the globe, we are likely to see hotter locations and wealthier locations into the future. And so you can see this map as we go forward begin to lighten, reflecting our projections of adaptation in the future based on the variations in adaptation we can see in the historic data. By the time we get to the end of century, you see a much more muted map indicating a much more adapted world than you would have recovered today. We can collapse these estimates to build sort of a time series of what we think these damages will look like going forward, aggregating across regions to get global numbers. We start with sort of a benchmark estimate that ignores adaptation going forward, so it doesn't allow people to invest in air conditioning or other behaviors and adjustments going forward. For mortality, we see that making that assumption of no adaptation leads to really extreme mortality rates around the world. Auto fatality rates in the US are somewhere around 12 deaths per 100,000. We're projecting over 200 deaths per 100,000 by end of century under that assumption of no adaptation. But we see really large projected benefits from accounting for the role of income in facilitating resilience and adaptation. So this falls to closer to 100 deaths per 100,000, falls even further when we account for the fact that gradually warming climate will induce people to adapt to their slowly changing conditions. When we account for those adaptation costs that we infer using revealed preference, this rises to somewhere around 80 deaths per 100,000 by end of century. These are highly uncertain projections. Max talked a lot about one of the exciting components of the NAS report that led to updates in the EPA's approach to the SEC is to take this uncertainty very seriously in valuation. We try to characterize uncertainty both in terms of the climatology, but also the econometric estimation that inherently has a lot of uncertainty as well. So both the damages and the climate are uncertain. You can see there's a really wide spread of damages here, even by end of century. For mortality, we're seeing even under a high emission scenario that this includes zero. We build these types of time series for each different sector. So we see increases in electricity spending to protect against heat, declines in other fuels in response to warmer winters that require less heating, increasing damages from sea level rise, declining labor supply, and for most crops, pretty severe changes in yield, although rice is an interesting outlier in that case. Those aggregate time series, of course, mask a lot of important inequality and heterogeneity around the world. What you're seeing here is a map of these damages at our impact region scale, where it's very clear that the lion's share of these damages are felt by the global poor. This is true not just in mortality, but largely in many other sectors, although there's some interesting outliers. One way to look at this is to plot damages against income deciles today. On the left, you're seeing that the death risk from climate change is largely borne by the poorest populations today, whereas we are projecting the relatively wealthy regions of the world to spend money on adaptation. This looks somewhat different in agriculture. So I think what's interesting to probe here with these types of results is how inequality looks very different in different sectors and in very different sectors of the economy. So for example, in agriculture, we're projecting very large losses in the bread baskets of the world that tend to be relatively wealthy and relatively temperate, although there are some concerning losses in the very poorest decile of the globe. Labor looks very similar to mortality in that the poorest regions of the world are facing the largest impacts, and particularly the poor and very hot regions of the world, we project to see the largest impacts. When we pull all these damages together and plot aggregate damages against global warming level, kind of doesn't matter what global warming level you want to project into the future, we're seeing the vast majority of these damages being borne by the lowest and lower middle income countries around the world. In some scenarios, if we achieve Max's goal of hitting 2C, on average, we're projecting benefits for upper middle and high income regions, whereas there's still substantial damages in the poorer regions of the world. This is particularly true if you are in a poor and hot place. So here you're seeing damages in a heat map against GDP on the y-axis and average temperature on the x. And really where the lion's share of these damages are manifesting is in the poorest regions of the world that are also hot. All right, so I said that we were going to talk about the social cost of carbon. Mostly what we've talked about so far are damage estimations and local level damage estimations. I want to spend the next few minutes wrapping this together into an SCC. So the way that we do this is you can think about each one of those maps being replicated thousands of times to reflect uncertainty in the econometric estimation and uncertainty in the climate. And then I'm going to collapse after monetizing those damages into one dot for each one of those projections and then index that dot against global mean surface temperature. So each one of these dots represents a probabilistic estimate of damages, in this case for mortality, against the amount of warming from a given climate model. Under RCP 4.5, we don't see a lot of warming. Under RCP 8.5, we see a lot of warming. And this distribution allows us to construct an empirically derived damage function fit through these points. It turns out that we see in most of our sectors, we see evidence of a quadratic damage function, which is what Bill Nordhaus wrote down many years ago. And we're really able to recover that in the data here. With these empirically derived damage functions, they look very different across different sectors. So we're seeing, for example, increases in electricity spending, but really substantial declines in other fuels, caloric damage function here in agriculture reflecting lost calories due to yield losses going forward. These damage functions then allow us to pulse the global climate with just 1 ton of CO2, that's the SCC experiment, trace that change in CO2 through a change in GMST and then through this damage function. So we take a simple climate model, we use the fair climate model that Max highlighted that came out of a recommendation from the NAS report. We pulse that with a ton of CO2. That leads to a long trajectory in changing CO2 concentrations and a long trajectory in temperature change. With those damage functions I showed you on the prior slide, you can convert that temperature change into a present value, or if you don't want to discount it yet, just a total value of damages for each sector. In this case, we're seeing mortality damages. The uncertainty here again comes from econometric uncertainty, but also over the FAIR model itself. So Max pointed out how these numbers have changed since over the evolution of updated SCCs. I want to focus on how these have changed in a sector-specific fashion. So our approach here has been local estimates that are also sector-specific. And what you're seeing on the right in the gray are original SCC estimates by sector for the fund model, which allows us to break out estimates by sector. And in blue are estimates for each of these sectors. And so not only are we getting very different overall numbers, which Max highlighted, but what's important for thinking about adaptation and sector-specific planning is that the nature of these damages also look very different. So we see much larger estimates for mortality, flipped signs for both energy and agriculture, and then we're adding components like labor disutility that weren't included before. All right, So pulling these sector-specific estimates together into an aggregate SEC, this is where like a lot of the really interesting welfare economics comes in. There's a really rich, mostly theoretical literature thinking about how we conduct valuation when we are aggregating uncertain damages across heterogeneous populations and time periods going forward. There's a lot of work showing us that it can be critically important to think about how you value uncertainty, how we equity weight, as Max pointed out, how we deal with discounting, and we think we're in a unique position to sort of explore the quantitative implications of these theoretical insights because we have characterized uncertainty in a really rich way, because we have heterogeneity at the scale that we do, and that we can integrate probabilistic scenarios to think about endogenous discounting. In particular, when we're thinking about equity, like the importance of equity weighting is going to depend on the resolution at which you can resolve climate damages. And so I think exploring heterogeneity and equity weighting becomes really interesting when we have something at the scale of, say, 25,000 regions instead of a few regions around the world. Here's sort of one window into what some of these estimates look like. We have taken a stance of like, you can sort of choose your own adventure here. I think that's important because policymakers around the world are approaching these valuation assumptions very differently. Max pointed out that equity weights are being used in Germany. They are not in the United States. And so we've been trying to produce tools to allow policymakers to explore different valuation assumptions. The only thing I want to highlight here is that these assumptions really matter, even with the same underlying toolkit in terms of thinking about how you value uncertainty, how you discount, and how you handle equity weighting. So for example, comparing the mean over uncertainty here to the equity weighting column, you can see that taking into account the fact that declining marginal utility of consumption means that $1 is worth a lot more to someone poor than to someone rich really matters for the SEC, not just because of heterogeneous incomes, but also because we are seeing heterogeneous damages. So people are valuing that dollar differently, but they're also experiencing very different dollar impacts around the world. We've been building this tool to integrate the probabilistic scenarios that Max highlighted coming out of RFF and Jim's work. And then the same infrastructure can be used to compute the social cost of methane and nitrous oxide. I think I have about 1 minute. And so I'm just very briefly going to talk about where I think we should go going forward. I think this sort of hopefully contributes to the conversation Max and Jim have been having about where to go from here. So I think one striking thing that's coming out of both our work, but also this graph on the lower left is coming out of the work led by RFF, is that non-market damages are critically important in current estimates of the SEC. There's lots of sectors that we haven't tackled yet, so I'm not saying that we don't know that this will necessarily hold true, but so far we're seeing that these non-market damages are really, really important, and that means that how you monetize them becomes critically important for the SEC. And so I think we need to probe a lot more how we do this, whether we should be doing this better, and thinking really hard about this monetization problem, because if we're building sector-specific damages in the way that we are now, these non-market damages really take center stage. How you monetize things like mental health or crime and conflict, I think, could be very important in the overall number and needs a lot more attention going forward. Max highlighted completeness, ecosystem services really jumps out here, but there are many other categories. But not just categories that are being missed, but I think dimensions of inequality that are very insufficiently characterized. We have a very crude way of thinking about heterogeneity, I would say, so far, and there's a lot more that can be done to better characterize differential vulnerability. Echoing Max, I think that thinking about GE here is increasingly important. There's a lot of exciting work being done on this. I think the interplay between non-market damages and GE is an interesting one. If these damages are really dominated by non-market factors, how do we think about GE components in non-market damages is really interesting. And then any time you look at the maps that I've shown you, it should jump out of the page that migration is likely to be very important. And I think we've got a long way to go in building empirically derived, but theoretically sound projections of what migration might look like and how that may shift adaptation and mitigation pressures going forward. So I'll just briefly wrap up by saying, hopefully Max and I have both convinced you that the SEC is important for thinking about mitigation policy, but also what we've built with DSEM helps us think about adaptation policy as well. We think that showing how inequality and uncertainty matter here for the SEC become really important for policy conversations going forward as the SEC gets used more and more in a broader set of decision making. Thanks so much.
Thank you very much, Tama. your timing was perfect, so thank you. And now we are going to continue with Joaquin Vial, who is going to discuss this paper. And Joaquin, you have 15 minutes for the discussion, and then we have a few minutes for questions.
Thank you very much, Gonzalo. Thank you very much for the organizer for inviting me. And thank you very much, Tama, for a very wonderful presentation. Lots of very useful information compressed in a very tight presentation and very useful insights. I learned a lot. I'm not a specialist in this issue, so it was really nice and helpful. I'm going to concentrate mostly on the issue of the information that is coming out of this model and this way to present the data that we currently have, and a little bit a final comment on the issue of introducing social weights in the estimation of the social cost of carbon. One thing that, let's say, on the first thing, on the data and all the working of the model that has been presented, I think having the spatial distribution of social impacts of climate change is absolutely crucial, and I think Tama has done a wonderful job here. I think if we look at the different categories, areas like mortality and labor productivity, we haven't seen before much on these areas. In labor productivity, we see there is very little coverage, so there is a big task ahead in terms of providing more basic information. I think mortality rates probably are easier to get in the sense that if you dig into the health and mortality data from the different countries, it's going to be a lot of work, but I think it can be produced. On labor productivity, I think you need specific studies, and that's going to be much more complicated surveys or things like that are experiments and so on. On issues more like linked to the direct physical impacts like agriculture, energy, and coastal impact, I think there is much more information. We know now much more than what we did know a few years ago. Here in Chile, the Ministry of the Environment has done a wonderful job in terms of building this ARCLIM model. It's an atlas with a very disaggregated data with physical risk of this type at the level of the different communes of the country. So it's a very important effort. The one thing that let's say, looking at the basic information for damage function estimation, I think the one missing that is very important one is that related to deforestation and change of land use. I think especially this is particularly important in the case of emerging markets. The information coming out, the latest IPCC report shows that for most of Latin America, Africa, and Southeast Asia, most of the carbon emissions come from deforestation and change in land use. And at the same time, most of the regions are a large fraction of poor population. And in addition, these are the areas of the world where the last reserves of biodiversity remains precisely in these forests that are being destroyed. So I think there is a very big win-win situation if we can improve these damage functions here. And there is a sort of a feedback loop into climate. So in terms of calculating social cost of carbon and thinking about mitigation policies and directions of flows of money in terms of preventing climate change, I think there is a large contribution if we can improve this information. I think this is of a critical importance. So my suggestion would be to put more effort in terms of trying to go further into this information. And I think in terms of the data, it's not so difficult. I think that there is a lot of information about changing in forest cover. We have data running for 20, 30 years with satellite image. So I think we can do a relatively good job there. In terms of the computation of the social cost of carbon, I would like to say this is very important. There are things that are very important. Some of the assumptions are very critical. We have seen also in Frank's discussion this morning, the importance of discounting. This is a huge issue when so many, for this long period of time, especially when lots of these effects accumulate over time and make things that lie further into the future into higher risk, but if you discount them, then if you go beyond 50 years with 2% rates of interest, they disappear from the map. So I think the exercise is very important, the estimate of the damage functions. We need the information to identify economic damages for specific locations and social conditions. This is critical to define priorities for the allocation of resources for adaptation. I think this is a very useful input. This will also be very important for the direction of international assistance to where it is most needed. So I think this is a very crucial issue. So I commend Tama and the team for this job. I think some of the information here is also important to answer yesterday's Elias questions, the one about limits to growth, in the sense that if we want to incorporate these limits to growth into our modified traditional long-term growth models, we need to address the issue of productivity. That's the way in which this will show up in our models. And as the state of the physical world deteriorates, that will show into these damage functions, affecting mostly different types of productivity. So if the way I think to incorporate this in our calculations for long-term growth, it will be to gradually increase the impacts on the estimates of productivity, different types of productivity, labor productivity, for instance, which is like suggested here because the data are really not so strong, but it's something that could be very important. But it's going to be, at the end, it's going to be TFP. It's the general productivity, the one that will be affected if nature services deteriorates a lot. And so I think that we have to work through this. We should incorporate whatever happens to productive capital and also to the natural capital into the provision of services. But the way in which this will be incorporated, it's labor, but mostly it's going to be the need for more capital intensity, especially for adaptation, and a significant decrease in total factor productivity. One last issue concerning the weight of impact climate damages according to socioeconomic variables. I think this is I think it should be very controversial. We have something, you saw these intervals, and when you get into this weighting process, you have to introduce very subjective criteria to weight. It's very difficult to have objective criteria. Let's say, if you want to weight mortality, for instance, as suggested, giving a higher value to the impact on consumption on poor people, it's in general of the damage functions. That's one way to do it, but there are many other ways to weight these variables. if you think from an economic point of view, what you would like to weight probably more are the losses of productivity due to this. And that means that probably you will weight more those workers that die prematurely that have higher productivity. Most of them won't be in the poor regions of the world. If you, let's say, probably also thinking in terms of potential output that is lost by early mortality, you probably want to give more weight to younger people who dies earlier. But on the other hand, if you are concerned about demographic impacts on the global warming, for instance, then you would probably give more weight to it would be just the opposite. So I think this is a very difficult exercise. There will be a lot of criteria. So my guess is that you will put a very controversial variable into an estimate that is already very difficult and controversial. So I think the political economy of using social cost of carbon will get more complicated than what it already is. If you want to think, one last issue here also, because you have to take into account that wealth and income distribution within poor regions is also very unequal. So if you want to do it rightly, you have to go into far more detail. I think if we would like to introduce some weights, again, I would try to give more weight to those damage functions that affect directly other critical environmental variables where we can have some information. For instance, biodiversity losses. If you have variables that are affecting biodiversity, I think this is a variable that is critical. It might be very difficult to put prices there, but if we see a direct link between carbon, deforestation, and biodiversity losses, it would make a lot of sense to put some additional weight to carbon emissions coming from deforestation and change in land use. We don't know how much that weight should be, but I think it should probably be higher than 1. So it's something that I would like to suggest. And again, thank you, Tama, for a very useful and very interesting presentation. Thanks.
So, thank you very much, Joaquin. So now we have time for a few questions. So, Marshall, and we are going to take a couple of questions, and then we can go with Tama and Joaquin.
Great, thanks. I'm wearing 2 microphones, so hopefully one of them's working. Tama, this is Marshall. Excellent talk, per usual. Thanks. I had one question, and this actually follows up on a lunch and dinner time discussion we've had here about the sea level rise impacts. And I think what's puzzling, maybe is surprising in your results, is how small they are relative to the amount of sort of public or popular attention that they get. And so I wonder if you could speak more about those. You didn't talk much about them. And can you speculate on why, I guess, the estimates look so small? I know there you have to use a different machinery. It's not going to be the sort of causal econometric stuff that drives the rest of your pipeline. And so is it a difference in the machinery? Why are those, or are the effects really, you know, over the next few centuries really that small?
Yeah, great question. It's a very different machinery, as you point out, which is why I didn't try to get into too much detail. My personal opinion, not speaking on behalf of all of my co-authors, is that I definitely think they're too low. And the 2 core reasons I think that's likely happening, and both of which are being worked on largely by Bob Kopp and other colleagues of mine. One is that the different machinery is a much more process model-based approach where we are modeling like representative agents making optimal decisions about adaptation. And I think the built-in assumptions about rationality of adaptation and that decision-making process are quite optimistic. And so you see a lot of either migration away from the coasts or optimal defenses that are potentially unrealistic amounts of adaptation at costs that may not be reflective of true costs. So I think there's general kind of accepting that those are probably pretty optimistic. And then the other is that storms are included in these estimates to the extent that they interact with sea level rise, but these are not estimates that currently include changes in storm activity. So if you think about all the work that you highlighted yesterday on cyclones and the enduring effect of tropical storms and the likely increase in those tropical storms going forward, those are not currently in this sector of impacts, and that's another dimension that's likely to inflate that number.
Any other questions?
Y a su vez la cuantificación económica de la interacción de todo eso o nada.
Okay, so maybe I can ask a quick question, Tama. So I wonder how your results compare with the results for instance, from Esteban Rossi-Hansberg work. So yesterday we talked about how the literature in damage functions, including geographical or spatial disaggregation, is increasing now. But of course you include adaptation, which reduces the damages, but at the same time you extend the dimensions of the damages, so that increases what we see as results. So how would you compare your work with, for instance, the result from Esteban's work, where he doesn't find so big effects?
Yeah, I mean, I think you just summarized it really well, but I think my view on where these literatures are at is that there's been a lot of exciting progress made on our end on empirical characterization of sector-specific damages in spatial and temporally heterogeneous ways. But the more that we push in that dimension, the more the questions about spatial and other forms of general equilibrium effects become very apparent, and those are not tackled appropriately or at all in some sectors a little bit, but I think we've been pushing in that direction, and that group has done some really exciting work thinking about characterizing those GE effects, and I think there's a lot to be done on trying to bring these approaches together and to see what we can learn from one another. So I think you are right in outlining the ways in which different features and bugs of each of the approaches push in different directions. And largely these have been pretty different communities of people. I think it's really exciting, I think Max pointed this out, to see a conference like this where we have a lot of macroeconomists talking about climate change. I think increasingly we are likely to see more work at that intersection that can bring some of the benefits of both approaches together to learn, where the pinpoints are on which direction we should be pushing in with those two different sets of benefits and costs, but that's not a space where those two have come together fully yet.
Okay, so thank you very much, Tama, and thank you very much, Joaquin. So this was a wonderful discussion. So now we are going to continue with Marshall Burke, so I'm going to ask you to come here, and also Klaus Schmidt-Hebel, who is going to discuss Marshall's paper.
Paco, qué gusto.
So we have the pleasure now to have Marshall here. Marshall Burke is Associate Professor of Global Environmental Policy in the Dorr School of Sustainability and Deputy Director at the Center of Food Security and Environment, both at Stanford University. He is also Research Fellow at the National Bureau of Economic Research, and his research focuses on social and economic impacts of environmental change and on measuring and understanding economic livelihoods across the developing world. He holds a PhD in agricultural and resource economics from UC Berkeley and a BA in international relations from Stanford. And also we have the privilege to have here Klaus Schmidt-Hebel, who is going to discuss Marshall's paper. And Klaus is Professor of Economics at the University del Desarrollo, Chile. Previously, Klaus held the position of Chief Economist of the Organization of Economic Cooperation and Development, the OCDE, and Director of the OECD Economics Department in Paris between 2008 and 2009. He also was a professor at the Catholic University of Chile, and he holds a PhD in economics from the MIT. So now, Marcel, the floor is yours. You are going to talk us about climate change and economic growth.
Excellent. So I, for better or worse, I have a face mic so I can wander around, which is not good for me because I tend to do that. So apologies in advance. Thanks again to the organizers for this great event and for inviting me to come. I've learned a lot. It's been wonderful. So Max and Tama are very, very hard acts to follow. So I'm sort of the cleanup guy here. I am a microeconomist, but am going to try for the next 30 minutes to play as a macroeconomist. And so you can think of this as taking some of the methods that Tama just showed you and some of the machinery and applying them to more aggregate data to try to make causal statements about the relationship between past variation in climate and aggregate outcomes, and then to heroically take that information, project forward, and think about what future damages might be, guided by an understanding, again, about how these aggregates have responded to changes in climate in the recent past. So Max and Tama, I'm going to spill this water, did a great job of setting up so I can move quickly through my early slides here. Here is the obligatory IAM damage function plot. I reversed the sign on the y-axis, so Tama showed something like this. These are damages in 3 different damage functions from the 3 leading integrated assessment models. In the first interagency working group that Max showed, these were actually used to estimate the social cost of carbon. And if you look at these, and here I really want to call your attention to the magnitudes here. So a business as usual scenario right now, we think our best estimate is around 3 degrees Celsius of warming by 2100. And so if you, I'll walk over since I have this. So if you go to 3 degrees Celsius warming and just read off the plots here, so Nordhaus says we're going to lose about 2% of GDP. Toll says we're going to lose about 0%, right? So no impacts out to 3 degrees Celsius warming, which is our best estimate of where we're headed right now, given emissions trajectories and policy commitments. Okay, so minimal damages below 2 to 3 degrees Celsius, and then perhaps accelerating after that, more for DICE than for fund. This point has been made. Again, let's just sit with those estimates for a little bit. So consider a 2% effect on GDP. So an economy growing at 1% a year by 2100 will be something like 170% richer. Most economies are growing faster than that, so they will be comparably richer. But let's say an economy is growing only at 1% a year in real terms, be a lot richer in 100 years, right? So with climate change, it's going to knock 2% off that, so it will only be, 165, 166% richer, right? So instead of 170% richer, we'll be just a little bit less than that 80 years from now. So why are we worried, right? Why is this a big deal? Climate change, why are we having this conference if these are the main effects? I think as you've just seen, as Max set up nicely, as Tama showed us new evidence, not everyone is necessarily on board with the, I would say, much older science that went into estimating these original damage functions. Here are 2 key quotes that are now about a decade old, so this was a recognized problem even a decade ago. Bob Pimdyke, who was mentioned earlier, I would say he's the most vocally critical here. The damage functions used in most IAMs, integrated assessment models, are completely made up with no theoretical or empirical foundation. I'd say that's a little mean. There were data beneath these, but indeed, they could use some updating. More recent paper a year later, the models should be revised more frequently to accommodate scientific developments. So Tama just gave you a whirlwind tour de force on many of the scientific developments developed in the Climate Impact Lab. Max gave you a summary of the other group working on this, Berkeley RFF group. A lot of this is based on great microeconomic work across sectors and an updating of that microeconomic work. So here I'm just showing you screenshots of key microeconomic insights about how key outcomes that we care about in the economy respond to changes in climate. And here I'm focused on temperature. So we see agricultural productivity mirroring what Tama showed you, labor supply, so those were both in what Tama showed. Ergonomics here is sort of a weird word. In an office environment, we think about it as how comfortable is my office chair. In the labor productivity literature, it literally refers to how productive am I as a laborer. It turns out people have been running experiments for decades, putting people in hot rooms or colder rooms or the same room and cranking up the temperature and measuring their labor productivity. And what they find repeatedly is as you raise the temperature, and specifically in these examples, as you raise the humidity as well, people's labor productivity goes down. And this is true on manual tasks. It's also true on cognitively demanding tasks. So we see an important impact on labor productivity, which was mentioned by the previous discussant. And finally, we see interesting and emerging impacts on cognition. So multiple papers now see a very strong relationship, or at least an observable relationship, between hotter temperatures and poorer performance on tests. And that's true, again, on the day of the test, or if you look at the temperature in the year before the test. Either of those, when the temperature gets hotter, it tends to drive down test scores, and the effect sizes are meaningful. So it looks like, again, evidence that Tama showed, the two top plots, these bottom plots are suggesting additional impacts on labor productivity and potentially on cognition. So these are important scientific developments. So how do we use these sort of estimates to improve damage functions? Tama just gave an excellent presentation on one approach, which I will call the bottom-up approach. So this is, as you saw, it's using very trusted, high-quality microdata from around the world or from as many regions or subregions as you can get. And it's using really careful and well-honed econometrics to identify, to causally identify the relationship between a climate variable of interest and that outcome. As Tamid showed, this is really sectorally focused, so you have to do this, you go sector by sector. And so some challenges are you have to be able to measure all the sectors that you care about, and you need to be able to integrate them in a sensible way. And I think Max and Tama were both very clear about how these are challenges. We don't have measurements for all the sectors we care about. We might not have causal impacts. We might not be able to measure them everywhere. And so some sectors are necessarily left out for lack of data. And right now, we don't have a great way to integrate these, right? And the way Tama and co are doing it is they're simply adding up the estimates. Their main approach is to add up the estimates across sectors, which I think is the sensible thing to do right now, absent sort of better ideas of how to do that. And I think there are great opportunities, as Tama just mentioned, to integrate with folks who are thinking about the spatial trade models as a way to integrate these. So the bottom-up estimates are excellent, data-driven, and as Tama just showed you, really important and influential now in setting the SCC in the US and globally. Okay, I'm going to do something different. Instead of doing a microeconomic, sort of a micro-founded bottom-up approach, we are going to look at impacts in aggregate data. I'm going to call this a top-down approach. So again, we are just going to study economic aggregates directly, and here by economic aggregates, I mean GDP. Let me say at the beginning, again, that GDP does not equal welfare, echoing Jim Stock. GDP is GDP, and I'm going to show you how changes in climate have affected GDP over the last 70 years, and again, try to project those forwards. So why should you do this? What are benefits and costs of this approach? So one benefit is you might think that a lot of the adding up is done for you, right? So if sectors are impacted, those sectors have an impact on the economy, so that will be relevant for some of Tama's sectors, but not all of them, right? It will not be relevant for mortality. It might be relevant for time use, labor productivity, agriculture, right? Those are observed in GDP. So if you think that there are impacts in those sectors, and those sectors interact in important ways in generating the economic aggregates that we see, then studying the aggregates directly is nice because a lot of that adding up is done for you. You don't have to take a stand on how to add up across sectors. That's nice. And similarly, many costs and benefits of adaptation. So again, if you think there's some sectoral reallocation, that is an important part of the adaptation process. Arguably, the aggregates are going to capture that in a way the sector-specific estimates won't. So I would say those are the benefits of doing the top-down approach. There's a clear lots of costs or lots of downsides of doing it this way. One clear one and very important one is you're going to miss stuff that's not in GDP. Again, GDP is not welfare. The mortality costs, as Tama showed, are quite large. The monetized costs of those larger still, and that's basically not going to show up in GDP at all, right? So let's keep that in mind as I go through these estimates. Okay, so again, we're going to take a top-down approach, and this is basically what it looks like when a microeconomist tries to do macro. I'm going to use standard microeconometric panel approaches for identification in macro data. Many of you are macroeconomists, and so you can tell us how we're messing this up, and I really look forward to that. I'm going to show you two different ways that we estimate that. One, the way we've been doing it for a while, and the other is the way that macro folks tell us to do it now, the local projections method. It turns out they give us something very similar, which is nice. Okay, so again, what is the goal here? So I have GDP, time series of GDP, and really we're going to study growth in per capita GDP here, and we have data from most countries around the world, so 190 countries have data for at least some years in our data set. We're using the World Bank data here, back to about 1960. So we have 60 years of data for most countries around the world. This is annual data on GDP growth. And I want to relate that to observed temperature, precipitation in those countries in each year. And then I want to identify the effect of temperature and precipitation on GDP growth. So what am I worried about there? I'm worried about all sorts of things, right? Things that could be correlated with average differences in temperature across locations, or trends in temperature and trends in GDP growth across locations or within locations, right? So I am going to estimate a regression that tries to account for both these spatial differences, these unit differences, and I'm going to take those out with a set of unit fixed effects. So this is the units here are subscripted by I, a set of year fixed effects, and then pretty aggressively also try to control for local trends in either temperature or GDP. So we have country-specific trends. We can estimate them non-linearly. But again, that's taking out any country-specific trending things. GDP in Chile is trending, and temperature in Chile is trending perhaps differentially than in Argentina, and I want to control for that. Again, just to make sure I'm not picking up spurious correlations in trends, right? So we're trying to strip out any of this offending variation and just leave what we hope is then plausibly exogenous variation in this case, temperature and precipitation. So temperature here is T, precip is P. I have a function for temperature here. We want to estimate this non-linearly. I'm going to do this with some simple polynomials, which seem to fit the data pretty well. So again, what does this do? It's going to use within country variation over time after taking out these trends, so standard panel econometrics, if you've seen this before. And by estimating this non-linearly, we're going to do something very similar to what Tama showed. It allows the within country effect to vary as a function of average temperature. And you can see that just by taking derivatives, which I'll do in a moment. But basically, it allows the effect, the marginal effect of temperature to depend on your level of temperature, right? So the effect can be different in hot countries versus cooler countries. Okay, so again, the data we have is what I showed you there. We're using ERA, temp and precip. It doesn't turn out to matter what climate data you use too much. And we're cutting the data off in 2019. It's hard to know what to do with the COVID years, so we just drop them. So I am going to run regressions. So the regression I showed you is going to have the change in log GDP per capita on the left-hand side is the dependent variable, so that's growth. But just putting growth as the dependent variable in the regression does not necessarily mean that you are measuring growth effects. The nicest paper on this, which I will just crib from directly, is the Del Jones-Olkin paper that I think really started this whole line of research about a decade and a half ago. And their insight was that to understand, even if when you're running a regression with growth on the left-hand side, to understand whether you're really getting growth effects, you need to run a distributed lag model. You need to look at estimates both in the year of the shock and in the years after the shock. You need to sum up those estimates, and if the sum is different than 0, then that's consistent with growth effects. If the sum is 0, or is not distinguishable from 0, then that's consistent with level effects. Here's a plot that tries to show that. So on the top is just the level of GDP per capita, what we would call a level effect of a shock. So here, imagine that you have a shock in year T. So GDP per capita is growing. In year T, you have a shock that lowers GDP per capita, and then it recovers, and you're back to your previous path before. We're going to call that a level effect. Distinguish that from a growth effect in red, or there's multiple flavors of a growth effect, but the simplest story is you grow more slowly. So for a growth effect, you grow more slowly in year T. In year T plus 1, you return to your previous growth rate, but you've lost that wedge, right? You've lost it's the year of lost growth. So you don't return to your previous path, you return to your previous growth rate, but there's still a wedge in the level of GDP. What does that look like now in growth rates? So if the level story is right, what you see is a decline in the growth rate in year T, but then a recovery. Growth has to speed up in the year afterwards to return you to your previous path, right? And so the idea then is if you sum up the negative effect in T and the positive effect in T minus 1, you get something close to 0, and we're going to call that a level effect. The growth story, of course, is the opposite. You grow more slowly in T, you return to your growth rate in the next year, and the sum of T and T plus 1 is still negative, right? And so looking at the difference in the sum of the distributed lags tells you or gives you a sense of whether or not you have growth effects or level effects. We wrote an earlier paper on this, and that used data through about 2010. Through 2010, we were not statistically powered to really distinguish whether we had found growth effects or level effects. We heroically and maybe incorrectly treated them like growth effects. With updated data, we can now do so. I'll show you that in 2 slides. Okay. So as I said, we're going to estimate this temperature response nonlinearly. Here's the 0 lag model. So if I just regress growth in this year on temperature in this year, I'm showing you a bunch of robustness here. You basically all get the same thing. You can change the functional form. You can change the sort of time controls, or you can control more aggressively for region by year FE. You can use different climate data. You all get roughly the same answer. So this thing is nonlinear. Mentally take the derivative of this, right? The slope, and that gives you the marginal effect. I want you to do that because I'm about to show you some marginal effect plots. So think about the slope. So if you're a cold country, so Mongolia is out here, average temperature of about 5 degrees Celsius, quite cold on average. It's on the upward sloping part of this, and so there we would estimate that warmer than average temperatures increase GDP growth in Mongolia. Chile is almost, and the US, it turns out, is almost right at the peak of this thing, so we're on a pretty flat part of the function. Although if you warm either the US or Chile up by 2 or 3 degrees, you push it onto the downward sloping part. And then most of the tropics are out here on the hot part of the function, and the slope here is about 1% per degree. So that means in a year that's 1°C hotter than average, economies that are warm to begin with grow about 1 percentage point more slowly. So that's a very large effect. Okay, so that's the 0 lag model. Now I'm going to show you what happens when we start adding lags, right? So adding temperature lags, and again, that is the machinery that is going to hopefully allow us to distinguish growth effects from level effects. So I'm going to take the derivative of this, and then I'm going to start adding lags. So here in the upper left is the derivative of the function I just showed you before. And then as we move through, I add 1 lag, I add 3 lag, I add up to 5 lags. We've done this up to 10 lags, and it looks about like the 5 lag, a bit noisier. So what do we see here? What we see is that the function starts to move slowly down and a little bit to the left, right? So once you've added up to 5 lags of temperature, you still see positive marginal effects. So again, remember, this is the derivative. This is the marginal effect. You still see positive marginal effects for the coldest countries in our data set, but now it's noisier and no longer statistically different than 0. This thing now crosses, goes from positive effects to negative effects at about 7 degrees Celsius, so much cooler than our 0 lag model. And for most of the sample, it's substantially negative and statistically different than 0. So our 2015 paper, if you had the misfortune of looking at that, had confidence intervals that contained 0. These confidence intervals are well below zero at this point. So at least by the Dell-Jones and Elkin test for growth effects, we find, I would say, for most of our sample, evidence of growth effects. Okay, the other way we can do this is using this local projection method. It's now 20 years old, but it's finally, I would say, seeping its way into this kind of work. So this is this very nice paper, and incredibly well-cited paper now from Jordan, 2005. And basically, this is pretty close to the distributed lag regression. So we can run this like a panel. I'm going to do the nonlinearity slightly differently because it makes the projections a little bit easier to look at, but if you take the derivative, it's pretty similar. So basically what you're doing is you're looking at changes in growth over longer periods, right? So you're differencing some baseline period and then some future period, j years in advance. You're a little constrained by data. I'm going to show you j out to about 10 years. And then what this is estimating, so you estimate it for every j, and you can plot out the impulse response function. Macro folks seem to like to control for a lag of the dependent variable, so I'm doing that, and tell me whether that's wrong. Jordan seems to do that, so I can control for multiple lags. It doesn't seem to matter. And then again, I'm estimating the impact, the impulse response of a shock, a temperature shock in year t, and I'm allowing that effect to differ as a function of your average temperature, which again, functionally is what that nonlinear function does as well, and then including the same FE and time trends as before. Okay, here's what you get. These are the impulse response functions. So year 1 after the shock out to year 10 after the shock. And so this is the sort of, let's call it the medium term effect, the 10-year effect of a 1-year temperature shock. The effect is larger for hotter countries to begin with than cooler countries, but consistent with the increasingly negative marginal effects that I showed you in the panel regression approach, I'll call it the vanilla panel regression approach. In this local projections, we see something pretty similar, right? So the cold places, after a year, it looks like the marginal effects are positive, and then the marginal effects get increasingly negative, and that's more so for the hotter countries. The magnitudes here, I think, are pretty directly comparable to the cumulated distributed lag estimates I showed you before, and are pretty similar in magnitude. If anything, they're more negative for the cooler countries, which matters for places like the US and Chile, which again are on the cooler part of the distribution globally. Okay. We can test these data quickly to try to understand or evaluate some conventional wisdoms that you hear a lot in economics that relate very closely to adaptation and might help inform a projection exercise that then takes these historical estimates and run the world forward. Let me show you two. So one, and you hear this a lot if you go to economic seminars, one is the idea that income or wealth insulates you from the effects of climate. This is explicitly built into some of the integrated assessment models. So fund has an income elasticity of damages. Tama showed you evidence for mortality anyway, that impacts do seem to go down as a function of income. So we have micro evidence that this is true. The other is just that we've become less sensitive to climate over time. This could be due to our incomes getting higher. It could be just because we're more experienced with temperature fluctuations or hot temperatures. Maybe now we have a lot more science on impacts. So something like the Lucas critique, we're changing our behavior now because we're aware of what might happen if we don't. So just to show you where we've been getting richer, this is the pop-weighted global average income has gone up, by a factor of 2 or 3 over our sample, so we've gotten a lot wealthier. And the average temperature has gone up, and this is readily observable. So we can evaluate these in data. So here I'm going to take, again, the distributed lag function I showed you before, but now I'm going to interact it with income, much like Tama showed you before. I'm interacting it continuously with income and then evaluating that function at different quantiles of the income distribution. And what you see here is at least notionally consistent with wealthier countries. So the more green the lines get, the wealthier the part of the sample is where we're evaluating the function. And so the darkest green would be at sort of US per capita income, and the darkest red here, or the steepest function, would be at, this is sub-Saharan African sort of average income. These are in PPP corrected incomes. And what you see, again, is notionally consistent with the effects getting flatter as you're wealthier, but we are actually not powered to distinguish between these statistically. So while the point estimates look different, the data are too noisy to say whether the slopes are actually different between the low income and the highest income groups. And we tried to cut this a bunch of ways to increase power and weren't able to get anything that suggested a strong, statistically significant difference as a function of income. So here I would say the evidence is somewhat mixed. The other thing we can do is just look at changing sensitivity over time. This is maybe a simpler test. So what we do is carve our data up into, in this case, 3 periods of 2 decades each and estimate that same function in each of those decade pairs and ask whether that function has changed over time. Again, if things were adapting, you would expect that to flatten out, and we don't see that at all. Perhaps you see it a little bit if you squint your eyes. So the blue here is the most recent 20 years. But we really don't see much evidence that this response function has changed over time. Okay, so again on wealth, I would say no strong evidence, maybe suggestive evidence in the point estimates that I showed you that wealth is a little bit insulating or income is a little bit insulating or something correlated with income. Again, so a lot of things are going to be correlated with income. In Tama's case, as in our case, it's hard to know whether it's actually income or something else, institutions, education, something else that's correlated with income that could be causing this heterogeneity. But in any case, we don't see a strong statistical signal that that's the case. And again, no obvious change in sensitivity over time. Okay, now we're going to take that historical data and we are going to, and I want to emphasize heroically, run the world forward. And so we are going to project the future evolution of GDP per capita in each country around the world. The way we're going to do this follows a lot of the machinery that Tama showed you. But here we're going to, again, be projecting growth rates. So your GDP per capita in 1 year is what it was last year times how quickly you grew. We're going to split the growth rate into a couple components. One is the secular growth rate, so how quickly we estimate, or others, Jim Stock, it turns out, estimates you have grown absent climate change, and then our estimate of how much climate is going to increase or decrease that growth rate as a function of your observed temperature in that year. And we're going to get that delta from the response function that I showed you before. And we can use the 0 lag. That turns out to be much more conservative than the 5 lag, again, which had much more negative marginal effects. So everything I'm going to show you here is just with that 0 lag. The temperature changes, this is a lot like follows Tama. We're going to use the climate models to get the temperature change. And then for the growth rates, we can use Jim's restat estimates or the SSP estimates, and I can show you both. So we can estimate country-specific damages, we can estimate global damages, we can also estimate a social cost of carbon. Jim says we don't need to do this, I'm going to show it to you anyway. Okay, there's lots of things you might worry about with this exercise. Happy to dwell on these, and hopefully people will want to chat about them. One that comes up a lot is, so this G function, again, is just what tells us how to translate temperature into growth impacts, is what I showed you before. You might think that this is a short-run response function and that the long-run response function might look different. This is a bit of a squishy idea, but you hear it a lot. It has the whiff of truthiness to it. So what's our response here? Do people respond differently to long-run changes in temperature versus short-run? How do you even know if a given temperature change is a short-run change or a long-run change in a year? You don't. So do you know what you're responding to? So all we can say on this is we don't see evidence that responses change over time or that they differ much across space. Again, caveat the sort of noisy income results, right? We don't see strong evidence of heterogeneity. The only real source of heterogeneity is what is your average temperature, right? That's our main determinant of heterogeneity. If you're cool to start with, you seem to benefit, again, consistent with all the microevidence. If you're hot to start with, you seem to be harmed. So again, we're allowing, just as Tama did, these short-run response functions to vary as a function of the key source of heterogeneity that we see, which is average temperature. Okay, and the other one that I would love folks' feedback on is this one that has come up multiple times. So how do we think of sectors interacting, or in our case, countries interacting? So I argued that an advantage of our approach over, say, the bottom-up approach is that you get sectoral interaction, right? The economy does some of that adding up for you. But we're still treating Chile as completely independent of Argentina, right? We're not letting them interact in any way, and so you might be worried that those interactions are important and they're not going to be captured in any exercise we have here. The one thing I would say here in our defense, and this is not a full-throated defense, it's not a great defense, is that so we've looked at this very carefully. It turns out that temperature shocks are highly correlated among trading partners. So Chile trades a lot with Argentina, and if it's hot in Chile, on average, it's also on average hot in Argentina, right? US trades a lot with Canada, and similarly, those shocks are highly covariant. And so long as you think the pattern of covariance is going to continue into the future, I think it's the case that our reduced form estimate of this response actually then implicitly captures some of the spillovers that we're worried about. If that covariance changes a lot in the future, trading patterns change a lot, then that will not be true. But I think to some extent, some of what we care about these spillovers is actually baked into our historical estimates. Okay, you all know what the social cost of carbon is. Tama gave a great explanation. There's the math. So you have many researcher degrees of freedom here in how you want to calculate the social cost of carbon, the discount rate, so this is the delta, how far out you're willing to run the world. So Tama showed 2,300. That feels just remarkably audacious to me that we have any sense of what the world in 2,300 is going to look like. So I'm actually going to cut the world off in 2,100. I don't want to project growth rates out past 2,100. It seems hard. You have to take a stand on the secular growth rate. We're going to take Jim Stock's stand, so blame Jim. And then, again, the regression model, we sort of have to choose what form of the regression model. I'm going to pick the most conservative one, which is the zero lag model I showed you before. If we run it with the 5 lag model, we get much bigger effects. Okay, for the discount rate, we're going to use Ramsey. Ramsey actually undoes a lot of the choices about the secular growth rate. So because again, it endogenizes the discount rate is a function of how fast you're growing. So if you assume Jim's growth rates, you grow faster, but the discounting is faster. If you use SSP, you grow more slowly, but then the discounting is lower, so it sort of cancels out. Okay, so under the most conservative assumptions, we can get an SEC of this approach of $275, which is in the ballpark, a little higher than what Tama showed and what Max showed from the Berkeley RFF crew. But again, this is under basically our most conservative set of assumptions. Here's, I can send this if anyone's really bored or having trouble sleeping. So we can make our assumptions less conservative. So here's no impacts past 2,100. This is the number I just showed you using Ramsey discounting. If we allow impacts to go out to 2,300, we get estimates that are about an order of magnitude larger, right? So if you imagine, if you heroically assume that these growth rates continue for centuries, right, you get really, really big effects centuries out, and even when you discount, these are pretty large, right? So again, I'm pretty uncomfortable personally with some of these, and so I sort of prefer to cut things out in nearer term. Here, we are, again, assuming growth rates based on, or growth effects based on the evidence that I showed you. Okay, so the SEC is one thing we can do. A second thing we can do is estimate a global damage function. So this is now going country by country, adding up damages, computing damages as a % of GDP, and we can do that under, so we only run this out to 3 degrees Celsius. We assume this is our sort of business, our worst case right now, which is also maybe heroic. And so you can compare sort of SSP3 7.0. This is our, if in the IPCC parlance, that's our sort of representative concentration pathway that we're closest to right now, and compare that to something that keeps warming to about 1.5 or 2 degrees Celsius. And that's about a 10% difference in global GDP through 2100. That's our estimate. And so again, this is about 5x larger than what we saw in the IAMs. This is actually smaller than what somewhat smaller than what we published in the paper 8 to 10 years ago. If you want it in dollars, you can also calculate in dollars. So again, the difference between a 3-degree world and about a 2-degree world is something like $160 trillion discounted. I think this is using a fixed discount rate, so 2% discount rate. So that, to me, seems like a large number. It's a lot of trillions. And because we're doing this country by country, you can also put the impacts on a map. So here's the benefits of limiting warming to 1.5C. Max pointed out that we're going to blow past 1.5C, so maybe this is not a reasonable exercise. I think he's right. So maybe we should do 2 versus 3 by 2100. You might have trouble seeing the color on Chile here. I made sure to look up the number on Chile. It's about a 3 to 4% impact on Chilean GDP by 2100, so loss. So Chile is in the blue here. Or here, the sign is flipped. This is the benefits of keeping warming to 1.5 relative to 3. So the Chilean economy is 4% higher under 1.5 versus 3. So again, that might seem like a small effect. You tell me. The reason it's smaller for Chile than other parts of the tropics, say again, is because where it's relatively cool, right? These are population-weighted average temperatures. Santiago is nice and cool. Southern Chile is even colder, so it's a cold place. Okay, to wrap up in my last few seconds, what do we see? A nonlinear effect of temperature on, I'll say, output historically. To us, these look like growth effects. A couple different models, I think, suggest evidence consistent with growth effects. We do not see strong evidence of adaptation. Maybe income is flattening the curve, but we don't have enough data right now to be able to distinguish reliably whether income is helping. Pretty substantial likelihood of losses under future climate change. So again, even odds of losses greater than 10% of global GDP by 2100. And again, that's only under the 3C scenario. 4 or 5C, push that up above 20%. I think these damage estimates and the most easily comparable numbers are to the IAMs or to the social cost of carbon. These are, again, larger than the estimates you just saw from TAMA and certainly larger than the integrated assessment models. And I want to emphasize that they do not have some of the impacts that TAMA showed, right? So I think these impacts and the mortality impacts are to a first order additive. I think they're picking up totally different things. Whether or not we should add them is a separate question, but they're certainly picking up different things, and our numbers look pretty large relative to existing estimates of the SEC. So I will stop there and really look forward to your feedback. Thanks.
Thank you very much, Marshall, for such wonderful presentation. And now we are going to continue with Klaus Schmidt-Hebel, that is going to discuss your work.
Do I see something there? Thanks. Well, first of all, congrats. This conference is one of the 5 top central bank conferences in the world. And I'm very glad that it's still there because I started this conference 26 years ago and did it for 10, 11 years. So it's very good to be here as a discussant of a wonderful paper, actually. Let me go immediately into business, asking somebody, oh yes, this here, to go forward. So what does Marshall do and his co-authors? I went through his 2015 paper, his 2023 paper, and this presentation, which is not so clear. I understood many things now better because you put some words where there were graphs or numbers, so I appreciate that very much. He develops a very original model to understand better and quantify the GDP effects of climate change. Now, this is absolutely key for assessing losses and damages and possible transfers to countries, to regions which are most affected by climate change. Although I have more than a grain of salt about this, their feasibility. Now, what's the main contribution? What he and his authors do, he addresses inconsistencies between micro and macro results. It's basically a macro study, panel, GDP, time series, econometrics, for a large panel, really large panel, a fantastic panel of 60 years in 190 countries, taking account precipitation and temperature effects on growth, and its implication for GDP levels. Main results, economic productivity is nonlinear in temperature, really GDP more than economic productivity, peaking at 13 degrees centigrade, declining strongly at higher temperatures. It's nonlinear, sort of quadratic. It's not exactly quadratic, but quadratic function. climate change will reduce average global income by roughly 23% by 2100 was in his 2015 paper. Now in your presentation here it's around 10%, which still is large, much larger than, I think this is for 3 degrees, plus 3 degrees, plus 3 degrees, 10%. And then very interesting calculation about the effects of 1 ton of CO2 emitted in 1990 causes $4 in global cumulative discounted damages by 2020, 3 years ago, and an additional $327 in discounted damages through 2100 at 2% discount rate. So great paper. I don't have too many specific recommendations, and I will do, to a large extent, general comments on how this line of research could be extended in the future. Now, let me start with GEC. What is GEC? I invented this acronym. It's a global environmental catastrophe which we are facing. And the scenarios of climate change, according to IPCC, they reflect a very large dispersion, but scientifically based, with probabilities sometimes assigned to the different scenarios. A time trend and upward revision of probabilities associated to more catastrophic scenarios. What does it mean? It means that every 2 or 3 years, the projections are more pessimistic by IPCC. And certainly a strong presence of nonlinearities and catastrophic trigger points. More worrisome is that there are very few scientific models, to the best of my knowledge. I'm pretty ignorant, so this is a very, how should I say, patudo in English? A very patudo kind of assertion, but no estimates of the economic effects of the interactions between the 5 direct drivers, according to IPBS, of the anthropogenic GEC. For example, I have not seen scientific models of the interaction, although Tamar mentioned a little bit this at a qualitative basis. No scientific models of the interaction between global warming, wildfires, desertification, more land use, and more global warming. So these type of interactions, this is just one example, are typically not much modeled. And certainly no estimates of the economic effects and socioeconomic feedback to the environment. That's a problem because our world is one of 5 drivers and not just one driver. Now, on the GDP effects beyond this paper, they're highly sensitive to model specifications. The dependent variable presents some micro foundations that relate temperature to output levels. This is in Dell and others. Sector-consistent macro models for GDP growth, which has been done by Burke, by Marshall and his co-authors. And growth effects compound over time. Predictions of future losses vary enormously. Level effects do not, which is a point which is at the heart of what you do. The temperature functional form, the linear effect, could be linear, like in Dell, or higher order polynomials like in your work, and I think there is a great value added in doing it with a higher order polynomials. And this affects enormously the magnitude of damage estimates. Let me go to simply a listing of the literature, which identifies different mechanisms of transmission from temperature increases to GDP. And there are those models which identify levels and other growth effects, and very different dimensions regarding other parameters or specifications regarding temperature functional forms, country fixed effects, year fixed effects, region and year fixed effects, time trend polynomials, and so on and so forth. And this implies an enormous variety. I went through Newell et al.'s paper of 2021, which was also quoted by you in one of your papers. Look at the enormous difference across different columns, and within a column, across different specifications, year fixed effects, region, year fixed effects, with time trends, with no time trends, and so on and so forth. Let me focus on the one number which sits there in the middle of the upper part, which is 49.4% loss in GDP as a representative average number across different studies. This is done by the simulations by Newell et al. 2021, which follows a methodology in this little cell, minus 49.4%, the effect of global warming on GDP by 2100, as compared to the 23% presented by Berg and co-authors in their 2015 paper, or the 10% which you present in your figure. So this comes close to his methodology and his co-authors. But look at the variance. Look at the variance. Some effects, some studies, some simulations have positive effects because they are on regions which benefit from climate change, and the upper dimensions far away from the latitude of the equator. And others, however, have very, very negative effects of minus 56%. Now, this is for the A category of models, with the GDP growth models. If you go to GDP level models, look at that dispersion. It's around minus 2%, minus 1%, minus 3%. It doesn't move away from single-digit numbers. So this is an example how the different specification and model can yield completely different results, and that's certainly a problem. Here's a dispersion of studies, which basically presented by Newell et al. It's simply amazing. Now, GDP is not welfare, is a point which you raised in your presentation too. There is, and here I want to make 3 points. One is that the mechanisms through which climate may affect GDP are many, are complex and hard to analyze comprehensively, an old point made by Dell. Even if we were to know each mechanism, we don't know how these mechanisms interact. Now, economic aggregates are not direct welfare measures and do not reflect non-market values affected by climate change, the quality of life, health not measured by health expenses, and so on and so forth. The complexity of the climate-economic relationship is apparent in different sector studies: agriculture, ocean fisheries, freshwater access, storm frequency, migration, tourism, mortality, and even conflict. Now, loss and damage compensation. Is it feasible? And before that, which are the questions which we have to address? And some of them were also mentioned by Marshall. The estimates of social cost of carbon, SEC, are highly sensitive to the discount rate. For instance, 4 to 8 times of differences in SEC when we compare a 3% rate with the Ramsey discount rate. Let's remember the Ramsey-Koopmans discount rate. RT is delta, which is the pure annual rate of discount, plus the aversion to risk, rho, times the growth rate of the economy. Now, once we take into account that G, the rate of growth, is also endogenous to climate, then R will be endogenous to climate and may change over time. We know since Usawa 1961 that rho, the risk aversion, depends on the level of wealth. The wealthier you get, you're less risk averse because you move away from subsistence levels of consumption or income. So this is a very complex, it seems to be very similar, it's a very complex formula equation. It interacts with many other parts of overall model of the economy. And it's very hard to choose a socially optimal discount rate and its change over time in order to calculate the present value for the SEC. If I were to ask you personally, what's your personal discount rate? It's plus 5%? Is it 0 or is it minus 5? That would take too much time to you to respond, but let me venture my own personal subjective discount rate, minus 5%. When should we start to calculate loss and damage? It's not clear when to begin counting emissions that parties should be held accountable for in order to come for a sensible compensation scheme. Consumption or production-based emissions. Should we be held responsible for emissions associated to production or consumption? There's a huge difference because many developing countries are producers of some stuff like oil and importers of other stuff which they consume. So I'm very skeptical regarding the loss and damage, not the calculation actually, even though the range is huge, is immense, but about the political feasibility to do this in any near future, which does not excuse the world at an aggregate level not to finance, let's say, maintaining the Amazon basin and preventing that it is burned down over the next 10 years. Implications. Where do we have firm science? Basically only up to now accounting for CO2 flows. And this is the figure taken from this week's fantastic special issue in The Economist, which presents simply the graphs of inflows and outflows of CO2. The stock we pretty surely know that there's 1 trillion tons of CO2 which have been accumulated up to now thanks to humans, obviously. Flows per year now, human-caused gross flows into the atmosphere, 41 billion tons per year. Total Earth's net flows into atmosphere, 19 billion tons. Is it small? No, it's terribly large. It's small compared to what naturally is exchanged between oceans, waters, the Earth, and the atmosphere out and back. It seems low, but obviously it's all our contribution is what caused all of climate change over the last 100 years and the next 100. My second point, I am at the end, is that science is shaky regarding forecasts, and the commitments are even shakier. The IPCC AR6 scenario, which is graphed there, assumes commitments to achieve net zero by 2050 or 70, as long as they are enforced. And we see very little enforcement up to now. It's highly unlikely given current trends. Every year, the peak of CO2 emissions is pushed a few years forward, or at least 1 year forward. And this is happening since the Paris Agreement of 2015. Carbon dioxide removal, CDR, is still an infant technology and an embryo industry. In Iceland, there are some very low-scale plants, and in other countries too, but it's real an embryo industry. It requires a lot of government subsidy before sufficient scale and more innovation is developed. So the main problem is politics, obviously. It's politics, stupid. Market-based solutions. Among market-based solutions, I think what holds most promise is carbon pricing, enforced carbon pricing, and realistic setting of that pricing. This graph is great because it shows the enormous dispersion of current prices per ton of CO2 equivalent. In the EU trading system, it goes up to $90 or so as of now. In Japan, which is the lowest part of the red on the right-hand side, it's a few cents, US dollar cents is the pricing. In Chile, please correct me, colleagues, it's around $5. In Uruguay, I heard the Minister of Finance at COP26 some years ago to commit to have a price of $100. So $100 in place by 2025, which is the highest commitment, but let's see if they will be implemented by 2025. Well, a fantastic example is different US administrations. Trump forced EPA to reduce its social cost of carbon to $5, which is current Chile's price. Today it stands at 51 under the Biden administration, still very much short of EPA's socially optimal level of 190, which they have published. So, in conclusion, I think this is a wonderful paper. It's a wonderful line of research. It's a promising line of research. which you developed with an impressive research agenda based on estimating macro relationships between global warming and GDP losses. You show large aggregate effects, not an order, but many times the effects shown by conventional IAM studies before. And this is per se very valuable. Yet both science and economics are still far away from modeling, estimating the true dimension of the global environmental catastrophe. The strong interactions between the 5 direct drivers of GEC and their implications for economic aggregate variables and their distribution over time across countries, across income groups, and their implications for other social variables. We will have massive, massive effects on poverty, migration, crime, wars, health, institutions, and democracy. Effects attributable, which will be traced down to climate change. Every imaginable social, political, and economic variable will be deeply disturbed by GEC. So, good domestic and international policy is the only way to avoid the most severe consequences of GEC, which means that we have lots of work to do. Many thanks.
Thank you very much, Klaus. So now we have a few minutes for a couple of questions from the Eduardo.
Yes. Thank you very much. Excellent presentation, Marshall and Klaus, the discussion. I may have understood this wrongly, so I apologize if I did, but it seems to me that based on the differences of the results that you showed from your 2015 paper to this paper, the aggregate effect from -23 in the 2015 paper to -10 now seems too large. But I may have gotten that wrong, so I wanted to ask if it's indeed very large and what's your explanation, because the results don't look that different to your 2015 paper, no?
Yeah, apologies for not making that more clear. The largest difference is we are evaluating at a different temperature in 2100. So our previous paper assumed we're going to get about 4.5 degrees warming by 2100. That's what we thought circa 2015. Now those estimates have come down a lot. They're closer to 3C. And so really it's just the cumulated effect of that 1.5 degree difference, which again, if you're pumping that through growth rates, is a really big difference. So nothing fundamental has changed on the response function. It looks pretty similar. It's more tightly estimated. The only difference is the temperature we're evaluating at.
Thanks. James and Elias?
Yeah, a really nice feature. This is great. A really nice feature of the simple SEC calculations that you're doing is that they really don't involve too many moving parts, which means you ought to be able to put things together in a way to get some confidence intervals that are interpretable. That would be nice to see. And then a question on the local projection results. Great that you're doing that because it's a nice complementary tool. It looked like those were essentially, especially for the already hotter countries, essentially a levels effect. Now, it only is going out 10 years, but there's like this decrement. The dependent variable is log of future minus log of past. And so it's going to just have a straight percentage on GDP interpretation. And those lower lines were pretty flat. So I wonder if you've thought about, but it only goes out for like 10 years as opposed to a longer thing, but it looked to me like that was giving qualitatively somewhat different results.
Yeah, that's a good, I think maybe we should try to run it out further and try to distinguish you run out of sample pretty quickly because you have to run the lags out, so I don't know the best way to deal with that. One thing we thought about to gain power is to go subnationally. So there are estimates of subnational GDP, which gives you sort of a wider, maybe you can claw back some power. But you're right. I think the short answer is we need to run up further.
Elias?
So thanks for a great presentation and great discussion, as usual, Klaus. I also agree that the 10% is larger, but still way small, I think. So let me give you one additional thing that could be added perhaps in the econometrics here, which as far as I understood is not included. and goes back to a comment that came out in the panel yesterday. We will have more frequent extreme events. So some might be captured when they're extreme temperature events or rainfall events, but a cyclone is not captured here. And the number that came out yesterday is that, I don't know, they're 5, 7 times more likely. So even if they don't leave a persistent effect per se, it's just they're 7 times more likely. So they add up. Yeah. And they do probably leave a persistent effect, right? That was the comment made yesterday, right? Because they increase debt, and debt we know from just traditional macroeconomics that particularly in poor countries, that drags on growth with a significant effect. So maybe, at this point, maybe in the US or other advanced economies, you get a cyclone and the effects are kind of small in GDP, but for other countries, the effects are big. And I would venture to say they're also persistent. And this stuff, you just add it up, because it has nothing to do with the regressions that you're running. So this is totally additive. So I think that's one way of getting that estimate larger. I don't know if much larger, but probably much larger for some countries. Thanks.
Are you a referee on this current paper, Elias? This is the exact comment we just got. Well, why don't you also do, and I think you're totally right. And so, as you mentioned, and as Eduardo mentioned, there is great work showing the persistent impacts of tropical cyclones, of extreme heat waves, so even separate from the sort of mean annual temperature. So even within temperature, if you look at the extreme part of the distribution, you get some additional effects that we don't pick up. They're smaller than the changes in mean. So even with temperature, you get more. Certainly with precip, there's papers showing that precip can have an independent effect that's not fully correlated with temperature. And cyclones, I think you're right, is the biggest one that's not in here, that I think you're right is almost fully additive. It maybe has a little bit of correlation with temperature, so maybe we're implicitly picking up a bit of the cyclones, but I think you're mostly right, and I agree with you entirely. Just more work.
Okay, so I think, yeah, we have time for 1 or 2 more questions. Yeah, Tony.
Thanks. That was a great paper. I learned a lot. I just wanted to follow up on what we were discussing yesterday, just to give you some more chance to help me out here. I still worry in this literature, it's not just in this paper, but in this whole literature, that we're using temperature shocks, a short-run response to estimate what happens if there's a permanent change in temperature. So we're really interested in climate. Well, maybe we're interested in temperature shocks per se, but we're interested more in climate. So I still worry, is this really picking up the long-run response, to a permanent change in temperature? Maybe you could just help me out a little more there and what your thinking is along those lines.
I think that's right. So I sort of stated this problem and then ignored it. So thank you for bringing it back up. So I think there could be some additional statistical approaches that could help shed light on this, even in the historical data. So one that we've tried before is looking at long differences. So you use longer-term, slower-moving variation in the historical data and ask whether that has, what effect it has, basically. Does it have the same effect as the sort of short-term shocks that you see? Does it have a different effect? And that's a way to try to understand empirically whether responses to slower-moving changes in temperature or some climate variable look different than the faster-moving stuff. We need to run that in the GDP data. We have not run that yet. We've looked at this in US agriculture, and there you see basically identical responses to longer-run variation as you do short-run variation, which to us is evidence that either there's no adaptation or we're somehow picking it up in the short-run stuff. We haven't run it with the GDP data. You're sort of short on units with the GDP data, so it's a power problem. The earlier DJO paper did a version of it. It was noisy, but looked consistent with their panel estimates. We should just try again on our data. That's a great point.
Yeah, sure.
Very briefly, I'm not quite sure. There's a comment on the comment. Elias, you raised a point that maybe you could, in your paper, consider some consequences of climate change which are not exactly the increase in temperature, like hurricanes. Is it just an example? Because there are many, many more examples, like, for instance, precipitation in a country like of Chile doesn't come now. It comes down in liquid form and not in snow, which means that during the rainfall season, California, maybe the same happens. it comes down as water, and that water, the huge deluge of water, causes tremendous damage, which is another example. The other is obviously wildfires, California, Chile, Australia, Mediterranean area, the world over. So you have lots of consequences which are directly attributed to the rise in temperature, not just hurricanes, and this should be considered too.
Hyun, last question. You have to push the...
Okay, perfect. Yeah, just building upon the discussion, I was wondering if you have thought about compound risk. So this temperature can obviously co-vary with these other types of disaster, but what would be interesting would be estimating the compound impact. So one natural disaster happening, two disasters happening at the same time may not be, it could be greater, the damage could be greater than the sum of the two. So it'd be really cool if you can estimate that effect.
I agree entirely. I think that's going to be easier done in the sort of micro data that Tama showed than our much smaller number of observations in the macro data. We've been arguing about growth and level effects just because we're underpowered to distinguish them in the macro data for a decade. I completely agree with you as an important thing to look at. I do worry about power in the GDP data.
Okay, so thank you very much, Marcel and Klaus, for such a wonderful discussion. And now we are going to continue with our last paper. So thank you very much.
Thank you.
¿Sí? Ahí sí. ¿Se escucha bien? Muy bien. If I could have my slides on the... All right. So, we're going to end up with a more cheerful note. I'm kidding. That's not going to happen in this presentation. But what is going to happen, that we want to talk about joining different disciplines into a very important question that has been implicitly alluded in many of the talks, that has to do with the impact of climate change on future migration. And it's kind of interesting that the disciplines that we are trying to mix involve earth sciences, history, and economics. And we are, 1, 2, 3, 4 co-authors that are only economists and have no formal training in either history or earth sciences. But I say this without any shame. I think what counts is the spirit. So let me just give a quick round of motivation, if you want. Climate migration is a potential social tipping point in our modern societies. We are already seeing strong migration flows from low-income countries. Basically, they have doubled in the last 30 years. So you get an idea, the current number in official statistics is about 2 million migrants from tropical countries outside of the countries, to other nations. Okay, that's the current rates. It's about 2 million per year. And this flow is increasingly associated with climate degradation in nations that are heavily dependent on agriculture. This process is often confounded with weak institutions, violence, and strife, which is one of the reasons why it's not always associated with climate. But the good thing about the climate econometrics is that climate, for all practical purposes, is exogenous. Now, countries at the receiving end also have been affected. With an increasingly negative perception among the general population, migration has contributed to social and political polarization, which itself is associated with the recent deterioration of the geopolitical landscape. But the problem is that the scale of migration thus far will probably pale in comparison with what the future holds. Because, as we've seen, I mean, climate is going to further deteriorate. And as it does, the map of uninhabitable ecosystems will continue to expand. And in particular, it will expand in the regions that are already the most affected and that house some of the largest concentrations of people today. As I said, regions that will suffer the most are often those already degraded. You can see this at the IPCC latest assessment report. And this suggests that the trends that we've seen may soon become highly non-linear. And I'll talk about the non-linearity quite a bit in the presentation. Thus, mass migration, which if you think about it, has been the main adaptation mechanism of our species to survive climate change in the past, may well constitute a key social tipping point in our modern, overpopulated societies. So what do we do in this paper? We try to advance the study of climate migration and it's the relation between climate and migration relative to previous studies. And let me point to the key challenge. The key challenge is data. I mean, it's not that the data that we have is not good. It's pretty good, actually. It's I'll show you. It's a panel of 30 years and 150 something countries. It's pretty good. But it's typical post-war data. And in the post-war epoch, we have not seen any significant dislocations in climate yet. So here I'm going again to the nonlinear part. The nonlinear part is about to start now. We haven't seen it yet. So what's going to be our approach? Our approach is to, and this is how we also extend the literature a little bit, we're going to put our historian hats without any formal formation in history, but still. And we're going to study the past, because the past indeed has many episodes in which we can identify precise and severe climatic events, and we know either from the archaeological records or from written records, usually both complement each other, we know the effects they have on the societies that suffer the shocks, but also, importantly, the societies that receive migration. And I'll show you that this, I think, gives quite a strong support to the notion that we have intuitively that, a 3-degree world is going to be a lot worse than what the climate models are giving us. Because the climate episodes that I'm going to show you, well, I'll actually only show you one. I mean, this is much smaller than what we expect to happen in the Earth in the next 50 years. Okay? and I'll show you the consequences. They're pretty dire. That's one thing. So that's studying the past. Then we're going to extend the studies about the present with the standard data. We're going to revisit the empirical literature on climate migration, and we are going to extend previous studies in several dimensions. Most importantly, we are going to interact the impact of climate with income levels of different climatic zones. And this is going to give us an idea, and I'll show you that results actually do depend on income levels. And I think they speak very naturally with the presentations that we've seen, actually the last presentation that we saw, and the previous one by Tama, in the sense that it the capacity of adaptation does seem to be playing a role. And then we're going to use this estimated reduced form empirical model to project future migration under different scenarios. We're going to use two IPCC scenarios, one where the temperature increases. So of course we're not going to use the 1.5. I think there's consensus that that's kind of gone already. So we're going to use the 2-point-something scenario, and then the more extreme SSP5 that has a temperature increase somewhere between 3.3 and 5.7, I believe. Although this is not yet in the paper, we are working hard on constructing a third scenario, which is a tipping point scenario, one in which the Atlantic meridional ocean circulation ceases. And the reason is that we haven't done this yet is that there's it's not clear what the implications on temperature are of this exercise. But I'll show you from the historical records also that this is a big deal and it's worth studying. Preview of the results. The past shows that the history of human migration is strongly related to climate change. We have 4 selected episodes in the paper. I'll only have time to discuss one, but they basically show that climate disruptions leads to significant outward migration, and furthermore, it has very highly disruptive consequences on societies at the receiving end. And they constitute one of the main elements, but I would say the main, precipitating violence, regime change, actually, in many cases, and in some cases, complete societal collapse. Actually, the one that I'm going to share with you, which is the end of the Bronze Age, is classified as the latter, complete social collapse, in the formal sense of what the concept of collapse means. Then, a preview of the results of the present, we confirm, I would say, a non-linear relation between temperature changes and migration. It's an inverted U shape, so a lot of points in common with papers that we've seen today. Very importantly, the non-linearity is stronger in poorer countries, probably reflecting less capacity of adaptation, or perhaps poor institution, or perhaps both. Indeed, despite having the experience as yet the smallest increase in temperatures relative to other zones, the tropical climate zones, which start from a higher temperature, are the ones that have exhibited the largest increase in outward migration. And this, again, I think speaks to us about the importance of the non-linearity of this whole process. Our results about the future, when we use our model to project these different scenarios, we actually find moderate effect on migration increases under, well, moderate climate scenarios. But under the more extreme climate scenarios, we find a doubling of current cumulative migration from tropical zones, which is a result that surprised us in the sense that we believe, or at least intuitively, it seems small. I'll show you. I mean, migration from the tropics has already doubled in the last 30 years. So projecting to 2100, and it has doubled with an increase in temperatures of 0.6 degrees. It's not even 1 degree in tropical zones. So projecting, an increase of another 4 degrees and just getting a doubling effect seems rather low. So some thoughts on this I'll share right away. I think there are two things that we're not capturing well in the nonlinearity, and this is the data restriction that I was telling about. One comes from the earth sciences. Ecosystems have this important property that the more shocks you throw at them, they start to lose their resilience. And at some point, that resilience is completely lost, and ecosystems enter a tipping point, and they don't recover. You can just take a stroll if you have a couple of days through the mountainous zone in Santiago, and I did. I live actually in the top of a hill. And this year was beautiful. All the trees recovered, and I did like a census, like an informal census. And I counted that roughly only 50% of the trees are still alive. since the time I moved there, which was 7 years ago. So that, I think, is a very good example of, one drought in Chile of, 10 years or 6 years, 7 years, basically destroyed the half of the life of trees in that area. This is, I don't think, is well captured yet, because again we are at the start of the nonlinear process. But this nonlinearity is typically not included or this characteristic of ecosystems is typically not included in models, and I think that's one of the reasons where we might be underestimating the nonlinearity. And another one that's more economic in nature is that we are going to be projecting migration with the projected incomes of these scenarios. But as climate, further deteriorates, of course, GDP in the most affected regions is going to fall. And that, by the same argument that I just described, is going to enhance this relationship. And we are not covering that in the simple sort of partial equilibrium exercise that we're doing. Let me just a quick outline. I'll only have time to describe the end of the Bronze Age, which you cannot miss that one, trust me. And then I'll quickly go through the quantitative analysis, describing the data and the empirical approach we follow with the post-war data. I'll describe the main results, and then I'll show you the projections for the two IPCC scenarios. And I'll describe a little bit, if I have time, the motivation for this other perhaps more ambitious exercise, which is to simulate migration under a tipping point scenario. Great. Let me talk a little bit about the Bronze Age. The Bronze Age, just to give a little bit of context, marks the transformation of life of human settlements from dispersed Neolithic villages into what we understand as the state, and eventually small regional empires as well, which were characterized by high population concentration. And this started between 4,000, 3,000 before Christ, depends on exactly where you look. And it ended quite abruptly at the episode that I'm going to describe, which is around 1200 before Christ. This period witnessed technological improvements, irrigation systems, bronze tools, wheels, wagons, and also increasing social complexity. There's marked social differentiation and inequality. This is where inequality was created, essentially, in the Bronze Age. There's writing, and importantly, there's hierarchies for administrating these vast agricultural resources that the state starts to produce. Now, the late Bronze Age also saw a growing trade network between what came to be called the Club of the Great Powers. Okay, and this is like the top 5 universities in the US. There are like 15 of them. Right? It depends on who you ask. So who's in the Club of the Great Powers is not clear. Let me just give you the names that I'm sure about. Egypt, the Hittite Empire was one of the dominants. Mitanni was right south of Hatti. Kassite Babylon, and minor players included Assyria, which was a sort of a rising power and threat to Mitanni and Egypt. Arsawa, and many city-states of Mycenaean Greece. And here I want to put the accent, Mycenaean Greece, because this is where the migrants are going to come from in this episode, okay? And geographically, this is important for the story, the region sits between 2 major climatic regimes. One is dominated by North Atlantic winter precipitations. This is towards the northwest of the region I'm going to show you in a second. And at the other extreme, we have the monsoon summer rain system towards the southeast of the region. And importantly, shifts in the range of Earth's wind circulation cells, there's 3 circulation cells going up, 3 going down, it's the same cells, it's kind of symmetric. They basically describe the climatic regions of the world, and they shift. They could shift, they shift from winter to summer, but they can also shift in multi-year episodes and even several decades. And these shifts correlate with cycles of solar radiation intensity. So how strong the sun radiates, that is not constant, it has cycles. There are many cycles from 11 years to 2,400-year Hallstatt cycle, which is actually the most important one, and it will be important for the story that I'm going to tell you. So this is the map. This is how the Bronze Age looked right before, not right before, but close to the collapse. So you have at the right of the figure, you have a Mycenaean. Does this work? I don't know. Well, I show it here. This is Greece, right? This is Proto-Greece, right? The Mycenaean Greece. Then you have the Hittite Empire. This is Mitanni. This is rising Assyria. This is Babylon, dominated by the Kassites. And this is Egypt. Notice that Egypt, at this point, was an empire. It extended beyond the Egypt that you know today. It also included most of the Levant. So what happened? Around 1200 BCE, during a Hallstatt radiation minimum, a multi-decade drought appears to have hit several states in the north and northeast of this region. And this is documented by Egyptian and also Hittite trade contracts. So the archaeological evidence for the Hittite Empire and Egypt is very rich when it comes to this, to compare it to other cultures, say. And they both documents basically the Hittite king imploring the Egyptian pharaoh to send more grain. And this is happening a couple of decades before the big invasion that I'm going to describe now. The drought seems to have hit Mycenaean Greece the hardest, triggering mass migration into Anatolia. So basically, it's like all this purple area here became depopulated. So first, they started fighting between each other, and there's looting, burning of cities, total abandonment of the main population centers, and all these people, and these are not only warriors, these are families basically migrating. And they migrated to the east. They migrated first to, this is Arsawa, this is Hatti, this is one of the main empires. Consequence, they burned Hattusa, who was the capital. The Hittite Empire completely ceased to exist. There are no more written records after the invasion, or population displacement, as you want to call it. Then the Babylonian Empire also collapsed, and the territories held by Egypt in the Levant were also lost to this population displacement. So when it comes to understanding the effects of climate change on migration, I think this is a great example in telling us that, you know, migration is not like some little nuisance that you should add to the GDP or welfare effects. I mean, in this episode, it's the main thing. It is literally the main thing. Without migration, Hatti would probably have survived just by trading more with Egypt, which was not affected. I mean, it was affected in terms they were invaded, but they weren't affected climatically. So this is one good example of the effects that we've been kind of hinting at. What's the aftermath of this episode? We have a 400-year dark age. And the reason is back then, writing was pretty hard. You know, the writing was represented, like if I wanted to write this, well, there was no pointers back then, but if I wanted to write a shoe, there was a word for the shoe. So, you know, you had to keep track of thousands of words, and the only people who did that were the scribes. So only the scribes knew how to write. But the scribes are only useful when you're writing contracts. And for that, you need a complex society that administers resources. And the very concept of collapse is that when something bad happens, the level of social complexity that can be sustained basically drops a couple of notches. And here it dropped quite a few notches. So empires cease to exist, at least in this broader region. So, you know, very high unemployment rates among scribes. So nobody to carry the torch, no more writing. So we have no idea what happened, or very little idea what happened in the next 400 years. Which actually is mentioned in one of the Plato's famous books. I don't remember which one, the Timaeus, I think. Anyway, let me make a summary of the historical episodes because I'll only show you one. These selected episodes illustrate a tight relationship between climate change and mass migration, particularly for the severe and long-lasting events. And it's usually accompanied by violence, strife, socioeconomic impacts that range from regime change to societal collapse. Now you might say, look, I mean, that's interesting, but it happened a long time ago. Why should we care about this? And I kind of sympathize with that. I mean, our societies are very different today. But I'm going to give you 3 points for you to wonder and just think about it a little bit, okay? Climate disruptions in all the episodes that we describe in the paper were actually much milder compared to the scenarios that we're projecting. So that's one thing to keep in mind. Second, disruptions were local. This disruption that we're talking about is global in nature. It's called global warming for a good reason. And third, in all these episodes, this is maybe a one-year cyclone or a multi-decade drought, like the one I described, but that's not where we are heading. We are heading for a very, very long-lasting stress on our environment. So basically, 3 differences with the past that, in my opinion, tell us that, the past is a very imperfect mirror, but this is cause for concern, not reassurance. Let me move into the present. Let me just describe briefly the data. We use migration. For migration data, we use census data from the Department of Economic and Social Affairs and Population Division at the UN. And we construct immigration stocks in a 5-year frequency for 154 countries between 1990 and 2020. We also use data on agriculture and weather. We use the agriculture data, the crop and livestock production and utilization, and land and water section from the FAO's data collection. And this is to identify the maize growing season for each country in the sample, okay? So this is not the average temperature in a year in a country. It's the temperature at the time where the maize is growing in countries, okay? So that required more work because obviously it's not the same time for each country. But this is important because previous work has found that this distinction is key. I mean, if you just put the average temperature in 1 year, you don't get much effects on migration. But if you use the temperature anomaly, if you want, at the growing season, then the thing is completely different. In terms of economic temperature, we use the climate change knowledge portal from the World Bank that provide historical series at the country level. For economic data, we essentially use the World Bank for population and GDP. And we also classify different climatic zones. This is not very important for the regressions themselves, but it is for the classification that I'm going to show you when we summarize the results. And for that, we take a countries many times, especially for big countries, they have different ecosystem and sort of climatic regimes. And therefore, we're going to take the one that is dominant, and we're just going to classify the whole country into whether it's temperate, arid, cold, or tropical climate. And you can see Peel for more details on how this is done. This has a lot of information. On the one hand is the graph, just the map of the world dividing these regions that I spoke about. So, Canada, Russia and China are cold. The United States and Chile are temperate. The equatorial Africa is, well, it's basically, this is arid, I'm sorry. And then sorry, this is Northern Africa. Equatorial Africa and the north of South America is essentially tropical. Okay? So here I just want to point out a couple of numbers that I have in the table down, which summarizes both the migration flows, that's in the first row of each of the different climate classifications. That's how the stock of migrants has changed through time. And then what you have in the row immediately to the right is how temperature has changed. So for example, let me just go right into the meat of the analysis. And this is actually highlighted with red. In tropical regions, migration flows went from somewhere in the 36 million stock at the beginning of 1990 into the 85 million. So that's more than a doubling of migration from tropical zones to other countries of the world. But the temperature increase was just from 24 to 24.6. Again, this is the temperature increase during the period in which maize is growing. Okay? That's actually the region with the smallest increase in temperature.
And you saw the highest increase in migration. This is the empirical model that we estimate. So essentially, our dependent variable is the ratio between immigration, the stock of migration from the country, from a particular country in a particular year with respect to 1990. So basically, essentially, this is the stock of people, I don't know, from Zimbabwe that are not living in Zimbabwe. Okay, that's for the case of Zimbabwe, obviously, for one particular year. Okay. T is the mean temperature of the maize growing season of that country over the previous 5 years. Y is the log of GDP. Population is the ratio between the population of country Y in year T with respect to its population in 1990. And then we have country and time fixed effects in the regression. And let me describe the regression a little bit, because this is the kind of quite important in the results I'm going to show you. So we have a temperature entering linearly, quadratically, but also very important, and this is one of the extensions of over the paper that is closest related to ours, which is also the paper of the discussant. So there'll be some action there, I'm expecting. We interact temperature and the quadratic term of temperature with the level of GDP as well. And we'll see that this actually leads to some interesting implications. Let me show you, yeah, you cannot see any, I mean, if I can barely see this, I'm guessing you don't see anything. So let me just summarize. We choose our baseline specification is the third column. That's basically because we find that essentially the driver here is temperature, not so much rain, so we discard the one that's more complicated. We just stay with the baseline, row 3. And here we have highly statistical coefficients associated with the increase in temperature. But they play out in a non-trivial way. So if you just take the linear effect of temperature, it gives you a negative relationship. So the higher the temperature, the lower the migration. But that's why it's important to take the non-linear form. So when you take the quadratic term, that has a highly statistical significant positive effect. And that means that at some point you reach like the optimal temperature. And after that, migration actually starts increasing with temperature, which is kind of, we've seen this graph in different forms throughout the whole conference, actually, in other elements, not in migration, but it's also true for migration, as I'm going to show you. And also, we interact this with GDP, both the level of temperature and the quadratic term of temperature. And basically, the conclusion here is that the richer the country is, the less convex the relationship is. Okay? Let me say this in other words. The poorer the country is, the more nonlinear this relationship is going to become. Okay? And this is going to be particularly important for tropical countries, which is where I'm going to concentrate the discussion. So these are the results look if we just take, say, the global averages for, say, GDP and population and so on, and we just do a thought experiment on what happens with this relationship as we vary temperature. This is just to give you a graphical representation of the regression that I just showed you. This is not a projection of anything yet. This is just the regression that I showed you. But when we when we differentiate this by the level of GDP of different climatic zones, we get a picture that looks like this, actually. And this is kind of more interesting. It shows that, first of all, different climatic zones are at different starting points. Here I'm going to use my finger. So basically, let's take the cold regions. They're here. Okay? So they're at the declining stage. So when weather warms up further, migration is going to further decline here, right? Because, people have, it's nicer to live there. And maybe expats that are living in Indonesia are going to return to the UK, for example. So that's kind of the effects that we're capturing here. But you take the tropical countries, they're already here, okay? I should say this is the immigration stock relative to 1990. So for example, tropical countries, which are here, this blue point here, they are already at roughly double or a little bit more the levels that were at 1990. And importantly, they are already in the start of the nonlinear increasing zone of migration. So an additional increase, 1 degree in temperature, is going to have a higher effect on tropical zones, because they have lower GDP, and that's what the regression tells us, than it does, for example, at richer temperature zones where the relationship is still nonlinear, but the nonlinearity is not as marked. Okay, that's kind of the conclusion here. And I'm just going to simulate these two scenarios, SSP2 with a radiative forcing of 4.5, and SSP5, which has a radiative forcing of 8.5. I think that's what this nomenclature stands for, unless I'm terribly mistaken. Great. So these are the results. Essentially, as the weather warms up, you get a decline in migration for the areas that I showed you that were still in the sort of the left-hand side of the figure, right? Because it gets nicer, according to this model. But the tropical zone, which is where the most migrants are coming now, this thing gets worse. It doesn't get terribly worse. It gets 25% worse in the model scenario. Okay. If we now go to the more extreme scenario, in which the temperature increases somewhere between 3.7 and, I don't know, 5 degrees, which is the range of this particular IPCC scenario, then we get roughly a doubling of the current migration from tropical countries to the rest of the world. Okay? So again, are the effects large? I mean, they're not. I mean, in terms of magnitude, this is 60 million people, an additional 60 million people migrating. But I would have expected larger effects, and probably this reflects the issues that I discussed at the beginning, that we are probably reporting a sort of a lower bound on the estimates, because this nonlinear relationship, there are good reasons to think that we are just beginning to capture its form, and as more extreme events occur and as temperature increases, we will really start seeing the true nonlinear relationship, and for the reasons that I described at the beginning, that will probably be a more nonlinear relationship, so stronger effects. I have 34 seconds to describe one scenario. I'm gonna have to pass on this one, unfortunately. But let me show you this picture, okay? Tipping points. There is a tipping point that we kind of fear. It's called the cessation of the Atlantic Meridional Ocean circulation. This circulation, what it does is it basically redistributes temperature from the equator to the North Atlantic. So it makes the North Atlantic not as cold and the equator not as warm. Okay, that's how we live. That explains to a large extent the fact that there's the range of habitable zones in the world is large. So let me show you a little bit of prior history. This is where the Holocene starts. This is basically here, right here. And the start of the Holocene, it turns out, I think that's my own alarm, actually. It's kind of embarrassing. I'm interrupting myself in my talk. But anyway, so what happened here? So this is not the last glacial maximum, okay? The last glacial maximum is here. So the Earth started to warm up about 20,000 years ago in a very chaotic way. So you get this spike, and then you get this, then it settles down around this temperature. And then you have this huge decrease in temperature that lasted for 1,000 years. And this is the temperature measured in the North Atlantic. It comes from ice cores records and so on. And this is what is called the Younger Dryas episode that lasted 1,000 years. And this is essentially caused by a collapse of the Atlantic Meridional Ocean circulation. That's what happened. It was a natural accident. The Earth was warming up, and as it warmed up, it accumulated a big chunk of water in a huge lake, the Lake Agassiz in North America, And it turned out that the borders of the lake were also made of ice. So as that ice melted, this huge lake got dumped into the North Atlantic in a matter of months, and that essentially made the water less salty. And for this ocean circulation to occur, it has to be salty. We can get into the details of why, but that's essentially what happened. So basically, we don't have the scenario of what will happen now if this stops, but we do have the scenario of what happened before. And what happened before was that humans were actually starting to domesticate agriculture back here. There's archaeological evidence of this. And they had to stop. And that's an understatement. They basically, human population almost collapsed through this episode. They went back to hunter-gathering activities. And then, when the circulation started flowing again, you get this huge spike that occurred over, 30, 50 years. And that's where the Holocene starts. So, in a summary, is this a big deal? Well, if it marks the beginning of our current epoch, I would say it's kind of important, just intuitively, right? But we are left with the task of trying to actually quantify this scenario. Because this scenario, I should say, this is the last thing I'll say, is important because this implies that countries in the North Atlantic are essentially going to freeze. So they are also going to move, but they're going to move in the other direction that I just showed you. So now we're going to start having migration from rich countries and also from poor countries. So it's not clear where they're going to migrate to because essentially, the world becomes a much harder place to inhabit. To conclude, climate migration could represent a social tipping point if it leads to within-country conflict and polarization and between-country conflict and further deterioration of international cooperation, which are both already happening. And it's a social tipping point because this cooperation is a prerequisite for international climate and environmental agreements to get traction. So climate and the effect on migration will probably get on the way of that very needed international cooperation. Past episodes suggest that climate-induced migration is not a nuisance that slightly amplifies GDP or welfare losses, but it's often the main thing that causes the disruption. Estimates with data since 1990 suggest migration from poor nations will further increase, although data scarcity in the nonlinear region probably leads to an underestimation of the effects. And just to end up, we highlight two immediate policy priorities for the analysis. One was touched upon by Tama in her talk. We should put high priority to identify and to finance the key investments that are needed in adaptation to mitigate emigration from poor countries. But of course, those are the countries that have the least resources to adapt. So we should think about that problem hard. And second, you can adapt and mitigate this to some extent, but just the magnitude of the migration that is coming, I don't think is something that can be stopped by a wall or a growing number of dictators around the world, because the alternative for people that are living in these regions is death. If you take all the money that you save and you take a boat to cross to Sicily with roughly a 10% chance that you and your children are going to die, that is telling us something very strong. These people are not going to be deterred by a wall. So basically what's the message here is that climate migration is inevitable, and we do not have, to my knowledge, any international agreements on this sort, and this is probably something that we should be also talking more about today. Thank you. I'm sorry for being a bit late.
Thank you very much, Elias. So I couldn't do the introduction at the beginning, so let me do it now. So Elias just presented this paper. He is the director of the Monetary Policy Division at the Central Bank of Chile. Previously, he was the manager of the the Research Economic Studies Unit and head of the Modeling and Economic Analysis department. He holds a PhD in economics from Harvard University, and he has taught several courses on financial markets and macroeconomics, and currently teaches the lecture Planetary Limits and Economic Development. And now we have Anuj Misirian as discussant for this work. Anuj is assistant professor at the Toulouse School of Economics within the environmental economic groups and a research fellow at the National Research Institute for Agricultural, Food and the Environment. She holds a PhD in sustainable development from Columbia University, and her research seeks to address environmental and social issues through an interdisciplinary approach combining questions, methods, and data from both ecology and economics. So thank you very much, Anuj. It's a privilege to having you discussing this paper. So the floor is yours.
Well, thank you very much for the invitation and the opportunity to read and discuss this paper. And thank you for the presentation. It added a lot to the working paper I had to read. So sorry for not being here. I'm stuck in Toulouse, but it's a joy to join this afternoon. So first, I want to start with a quick summary of the paper and its contributions. So the authors ask a very simple but very complex question, which is what has been, is, and will be the effects of short-term and medium-term weather variations on migration and conflicts. And they do so by looking at the past, the present, and the future. When they turn to the past, they do so using motivating examples in a narrative fashion of environmental shocks leading to migration and regime shifts. And when I say regime, I mean political regimes. And the examples span millennia BC to the 90s. Then they turn to the present, and they do an empirical analysis to uncover a weather-migration relationship. And finally, they use that relationship in combination with IPCC temperature trajectories to see how that could bode for the future. And in brief, what they find is the paper highlights and actually confirms the present and past influence of environmental fluctuations on the stability of societies and on migration, thereby adding to a growing literature on that relationship. So that's a very precious contribution. When they turn to the future, they project a decline in immigration stock in the more moderate warming scenario, despite an increase in tropical and arid country-born immigrants. And that's probably this more moderate increase is probably due to the GDP explanation that was provided earlier. I fully agree with that. And then in the more extreme warming, you actually see an increase in global immigrant stock. And finally, the tipping point scenario is actually very exciting, and I hope it will shape up very soon. So first, turning to the discussion, I want to start with the past and inflict to you my own favorite references for past environmental shocks causing mayhem and including migration and regime shifts. My absolute favorite is The Year Without a Summer, which you may have heard of. It was caused by the eruption of a very big volcano in what is now Indonesia, Mount Tambora, in 1815, and that released into the air a huge plume of particles of various sorts, and the explosion was so big that it obscured the skies for a long period, which led to crop failures, extremely poor weather around the northern hemisphere, transforming into crop failure and social disasters because of famines, etc. And that has been documented by here. I have two references of historians and natural scientists who have talked at length, among others, about that. And the reason why this writing lady is here is because this episode pushed her and a bunch of her friends to a remote house in Switzerland, and the weather was so bad that they were stuck in there. And at some point, somebody suggested writing ghost stories to entertain one another, and her story eventually became published, and it's now known as Frankenstein. And all this to say that this dreary weather inspired her, but also caused a lot of other turmoil in Europe, the Americas, and elsewhere. And that had various far-reaching consequences, from a series of famines, a book being written and with cultural significance. But also it's alleged that Napoleon's demise was also caused by that. So I'll let you reflect on that. And the second one is way closer to us, and is alluded to in this PNAS paper that I'm citing here, and it's the onset of the Syrian civil war. And what the authors propose is that it is the combination of a context, institutional context of the Assad regime failing in many dimensions, and a series of droughts caused by climate change that together produced famines, crop failures, internal migration, unrest, and eventually international migration. And they really emphasize this combination of institutional features, which were also present in the narratives that you had in the paper, with climate events. So I think that's a very nice example for you. There are many others that have been discussed in the literature, but I give those to you for free if you want to use them. Now turning to something that is more familiar to me, because I'm not a historian, is your empirical analysis. And I'll start very directly with questions. One is, it wasn't clear to me how temperature was aggregated over space. And given that you do a really good job taking into account the maize growing season in the time dimension, I was wondering if you were adopting the same treatment in space, which was what we had done in the 2017 paper. And then as for your dependent variable emigrants, I was wondering whether that was the best variable you could use here, or if you were making your life way harder by using it. And what I mean by that is that immigrants at any given time is a stock. We typically don't think of migrants as a stock, or seldom. And you yourself, in your first slide, referred to recent immigration as a flow. And so that's what policymakers, people in the street will think of it as a flow. And then the second aspect, which is more technical, let's say, is that it's more complex to impact the evolution of a stock, because there are many things that play into it. There are, of course, the new people that migrate, so that's the inflow. Then you have the existing stock of migrants, and then you have people who will leave the country, as you alluded to. So, for instance, coming back from Indonesia to the UK, but also will get naturalized into their new country or die, and that's many things that will make the stock move. But my sense is that you're more interested in the new people migrating in. And so the question is, what exactly are we picking up when we're looking at the stock, whereas the flow is a cleaner variable. And that might just add noise, make your life more complicated. And that's why I would prefer going for a flow if you can manage it. And then the last point is that people change countries for a variety of reasons. They find work, they become a student, as I have been, a migrant myself. They get married, or they are desperate for better economic opportunities or flee civil war, etc. And so these are all the people that are considered in your stock. And again, that makes for a more complex group to unpack when you're probably just interested in a minority of those people. Third point is touching on the GDP improvement in your paper, and in the narrative that you have around your empirical analysis, you emphasize the buffer effect that GDP can have, and I think that's probably very real, that you can cope internally better if you have a higher GDP level. But it could also be that if you have a higher GDP per capita in a given country, you're less exposed to shocks because the share of your GDP that is coming from agriculture and the share of your population that is involved in agriculture is smaller. And I didn't see too much of that explanation in the discussion. The second aspect of the GDP variable is that even though in the past segment of the paper, you seem to allude to the fact that weather affects GDP, it doesn't seem to transpire in the empirical analysis, so what I call the present and future segments. And in the present, that causes an empirical problem, because then you have weather affecting two variables in your equation, and then GDP affecting possibly migration in return. And then you have this problem rippling into your projections into the future, and you've suggested yourself probably good fixes that will help dampen that in the projections. But I would suggest taking a serious look at it in the present regressions. And then finally, that's my last annoying comment on the empirics. I was wondering whether, especially given the picture you've painted of the drastic changes that were about to come, and especially with the graph that I didn't have on AMOC, I was wondering whether those short-term, somewhat moderate variations in temperature and precipitations that you use in the regression suited to model the reactions to the absolutely brutal changes that an AMOC collapse might bring about. As the drop was very brutal, the magnitude was immensely steep, and I wonder whether those small year-to-year changes in temperature that were, in addition, reversible from year to year are suited to model the reaction of farming systems and further societies to such a brutal change. So I'll conclude, not to go over too much. Overall, this paper is ambitious and addresses an important issue from multiple angles. In my view, the first part makes an original use of a narrative approach as motivation or literature review. The empirical approach confirms our results, which is always heartwarming, with very different data. So the migration part, of course, but we didn't discuss the weather, but that's always a good thing. And you test the mediating effects of GDP with caveats, but that's a very interesting addition. And so I have a few additional suggestions for to improve the contributions that are already clear. Maybe you could streamline the narratives. In the presentation, you showed us a map, and that's extremely helpful to wrap our head around the various peoples that are involved and how they're connected together in space. And maybe you could substitute certain case studies for others that would be more connected with the variables of interest. So for instance, the Bangladesh one talks about what I would classify as a natural disaster rather than a weather shock as you measure it in the empirical part. So maybe you could find something that more closely connects to your variables. In the regressions, maybe rather than normalizing by the T0 immigration, we normalize by population and account for population growth in the extrapolations. Maybe that seems more natural. The one other suggestion I have is maybe you could make a greater use of your 5-year time step. I know you're limited because the 5-year time step in the migration data prevents you from, makes you run out of power very quickly, but maybe you could try different transformations of the temperature variables within that constraint of only 7 years of data. Contrary to you, my preferred regression specification is in column 4. So you should keep the precipitation variables, and I think Max will explain over dinner if useful. And last 2 points, if you want to account for the possibility of that channel that I mentioned of weather directly affecting GDP, but still want to account for GDP, maybe you could use the GDP at the beginning of your time series to avoid this endogeneity problem later on. And then last point, I'm really excited about the EMOC collapse scenario and really curious to see how you go about it. And to conclude to take a step back, I think this is very valuable work. I think that we agree on history being a very good guide, and that with many caveats, that the changes in temperature and climate that were experienced then, that we will experience in the future, are very different, but also that our societies are very different, for better or worse. We're more connected, we have different technology, and that might either amplify the effects or dampen them, and the question is really open. So the work that continues in that literature is immensely precious. And with that, I'll just stop here, and thank you very much.
Thank you very much, Anuj. So I think we are a little past, we are over time, but still we are going to have a couple of questions. So Klaus?
Great paper, Elias and co-authors. Fun to listen to you to your presentation. I'm as puzzled as you are by the result of the relatively low numbers of 60 million going into the future. Probably it's because you take literally your coefficients estimates. And those are probably small because of what you explained, because the non-linearities, the exponential growth and migration only comes into the future, not in the current data. Having said that, however, I also would comment something which may even reduce the magnitude of your coefficient estimates of emigration stock to temperature, which is controlling for a host. I'm sure you thought about that. Maybe you discarded these other variables. A host of other variables which economics of migration identifies since George Borjas sort of founded this subfield of economics in the late 80s, early 90s, meaning things like not only the GDP difference between the two countries where they migrate from, but also the opportunities to find a job, the type of policies which are imposed in order to curtail or not illegal immigration. Maybe you have no data to distinguish between the stock of legal and illegal migrants because the illegal ones get legal after some years. And then geography. You have very, very little illegal immigration into island countries like, let's say, New Zealand or Australia, by definition, because they're islands. So if you control for all of that, and other variables identified by George Borjas and others, maybe your coefficient size, depending on the correlation between your temperature and other omitted variables, if positive or negative, you might have even smaller coefficients, but I think it's something which is worthwhile.
Felipe and, sorry, Guillermo, thank you.
Thank you, Elias, for the presentation. It's somehow related to Klaus's comment, because I was thinking that colonialism links between countries could reduce somehow the frictions of migration. And somehow the pattern of colonialism also coincides with countries in cold regions colonizing countries in warmer regions. So I'm thinking of the flow of migrants from India to UK or to England that is somehow reduced by the fact that they share some cultural elements after many years of colonialism. I don't know if that's controlled in your estimation, or if you have the data that is disaggregated enough to do something like that. Thank you.
Okay, so and Marshall.
Okay.
The last question.
So I have a question which was also for Marshall. You didn't see me in the first session, but I wondered to what extent, I mean, there's another source of nonlinearity, I think. And I wonder whether you skip that or eventually you may have some information, is the issue of individual rationality. So we used to think of rationality in a kind of game theory approach as a kind of planning over a certain horizon. But if that horizon suddenly collapses, and for reasons which are attributed to anthropogenic action, my feeling is that the individual rational reaction to that process is very unknown and probably very nonlinear. So I would like some reflection on that.
Marshall?
Thanks for the great talk. I love the historical examples too. Those are super interesting. I wonder if the framing though in the modern era is somewhat different. I mean, do we think of, your framing is, I would say, a bit negative in thinking about all this potential migration as a problem, but what if we think of it as adaptation, and instead of thinking about how to mitigate migration, which I think was your sort of policy implication, we think about how to enable it and work out the politics and allow people who are in really tough places to live, another opportunity, treat it like adaptation.
Ernesto, quick question.
Super quick. Shall we think about migrants as, so the welfare cost of migrants as a lower bound for the welfare cost of stayers? As migration probably is a way to try to not get much affected as those who are have not the capacity to migrate and therefore has to bear all the cost.
All right, so there's a lot of things to answer. First, Anush, thank you very much for those thoughtful comments. There's a lot to unpack in your comments, so I'll just take a shot at the easy ones, and if you allow me some time to think about the more challenging ones. So quickly, how temperature was aggregated. So basically, we take for each country, for each year, we take the average temperature for the whole country during the maize growing season. Okay? And that's for 1 year, and then we average for a 5-year period to match the way the other data is packed. There are extensions that we have thought of, we didn't have time to do. For example, not all countries grow maize as the main crop, so we could do with different crops that I think will lead to a more precise estimation of what's relevant for a country, for instance. So that's one thing that we could do as well. You made an important point on stocks versus flows. We've tried different specifications, but I think this is a point well taken. We should think more about this, and also ask ourselves whether the censal data that we're using may have some, at least partial, answers to some of the questions. Maybe we could exploit the fact that this data is censal and perhaps get a little bit more light on some of the questions that you raised. But the point is well taken, and I think we should test the robustness of this to alternative specifications. If I understood your question about GDP, I mean, we are using GDP essentially as a proxy of, I mean, it's a broad proxy of maybe institutions, the capacity of a country to adapt. So it's it's a bunch of things that are summarized in GDP. When Tama Cardo was presenting, I was thinking, wow, that would be a great data set to get our hands on, because that's a direct estimation on the cost of adaptation. So maybe we could add that directly, and then GDP would play a different role, and then we'll have the variable of capacity of adaptation as an explicit one. But that's something that we can also work on. But that's essentially the reason why GDP is there as a control. Let me turn to some of the questions of the audience. So Klaus, yes, we share the puzzle of the small numbers, but I think we have an intuition for why this is so. Your point on controlling for other things that contribute to migration, I think that's a great suggestion, but that does have some complications, because then you enter into the Cambridge causality police issue, right? Because many of these elements are not, variables are not completely exogenous, as is climate. Right? So climate, that's the one thing about doing climate studies, that climate change is exogenous for the country. But still, I think we could do an effort into exploring other covariates that explain in the work that you cite migration. And I'm not sure actually if the results would get smaller. Maybe they'll get bigger, because we would estimate the regression more precisely. We're trying to estimate the relation between climate and migration. And maybe we are confounding with a bunch of other things that are causing migration that are not related to climate, and that probably just add noise. So I'm not sure in which direction it will play out, but that's something certainly to think about. So Felipe, I'm not sure if I understood your point. I mean, and I wasn't very clear in the presentation, but the source of the data is basically country to country. So again, the amount of people born in Zimbabwe that are living in all the different countries of the world. Okay, that's how the data is set up. And then we run these regressions, and then you can aggregate them to the level that you want. We have not tested if there's any relationship between the colonial relationships. I think that was your point. That's perhaps something we could do. We didn't do that explicitly. Guillermo, the point you raised on non-linearities about individual rationality, I fully agree with you. And actually, I'm always surprised by these studies on migration that show a surprising resilience of people to stay in the places that are affected by a storm, and then another storm, and then another storm, and they kind of stay. And there's a lot of empirical work that's more sort of a survey nature. So people go, and they survey households, and they ask them, why do you remain here? And it has to do with what you said: social ties, living. It's hard. Poor people they don't have resources to live. But I agree with you. I mean, when the future becomes the present and there's nothing left to grow, then all these plans and all these social ties basically go out the window, and people just have to move. And I think that's where the non-linearity really kicks in. And my suspicion is that in the data, it has kicked in only very modest number of places. And we will see more of this in the future. Marshall, I'm actually positive about migration. I just read a book, I can't remember the author. Melissa, no, I don't remember the author, but it's a great book that basically says the same point. I mean, migration is our main adaptation mechanism. I mean, it's what gave us bipedalism, for Christ's sake. So, I mean, it's clearly an adaptation mechanism. And I'm personally very positive about migration. But the problem is that I am in the minority, right? I mean, as things stand, countries that are receiving migrants, they do not have a positive perception of this. I mean, we see this in Chile, we see this in the US, we see this in the UK, we see this, I mean, everywhere you look. Maybe the first wave of migrants is not a big deal. The second wave of migrants, third wave, fourth wave, it's like, man, we don't want this anymore. And then we are seeing the political shifts that are coming. I mean, so that's why I also alluded in my last point. I mean, adaptation is important, but migration is coming anyway. So we need to do something about it. And that something about it, I think, is not just trying to exogenously, with some communication strategy, try to change the perception of people. I think it has a lot to do with making illegal migration legal. And that requires, international cooperation, treaties on how to assign people that are living places that are uninhabitable into different countries in an orderly fashion, that they get, they get the proper visas, they get the proper work permits, and then you incorporate them in society, as opposed to becoming, soldiers in some narco coalition versus another one, which is what is happening in Chile as well and in many other countries. So migrants are getting in anyway, and if they come illegally, they, of course, they're going to have a much worse time, and the receiving country is going to benefit a lot less from that migration, and therefore, it's sort of understandable why the perception is not great. So that was the last point on working on this international cooperation for tackling this issue. And finally, Ernesto, if I understood correctly, your idea is to somehow use the standard of living of migrants in other places where they migrate to proxy for the cost of the people that are left behind. I don't know if I understood.
It's a very simple point.
Correctly, but
it's since migration is a way of adaptation, those who cannot migrate probably are doing even worse. That's all.
No, absolutely. I totally agree with that point.
Okay, so thank you very much. And so we end here the fourth session of the conference. Thank you.
We will break for 15 minutes, so we're going to come back at 5:20. We're gonna start the last session. Thank you.
Mi amigo me dice,
So I guess we should start. So welcome to the last discussion panel of this conference. We'll try to honor the title of the conference that talks about implications on macro, financial, and also financial stability. So this policy panel will discuss issues on the impact of climate change on financial stability. So as our Governor Costa mentioned yesterday in our welcome remarks, financial regulators and policymakers around the globe are facing a relevant challenge, not only to understand the macroeconomic implications of climate change that we have been discussing thoroughly yesterday and today, but also challenges in terms of financial regulation, financial stability. Challenges to identify, assess, and monitor the impact of climate change on financial stability, to understand how those traditional financial risks can be exacerbated or amplified by climate change. Also to make sure that the risks associated with climate change are correctly internalized by financial institutions and market participants through appropriate risk management practices and also disclosure. And finally, to understand the role that the financial sector can play in accelerating transition and mitigation, contributing by allocating resources towards investment, taking climate risk into account. So to have this discussion today, we have a great panel that gathers a lot of experience in policymaking and research regarding climate change, financial markets, and financial stability. I trust that during this discussion we'll be able to gather a wider perspective of the recent efforts that have been made globally and locally to understand implications of financial stability, the evolution of tools, models, and scenario analysis currently in progress, and also future challenges that we're facing. I guess we'll also discuss the relevance of international cooperation and coordination among local authorities. So let me briefly introduce my fellow panelists, and let me explain the format of this panel. As yesterday's panel will basically raise 2 or 3 questions for the panelists and start a discussion from there. So my first fellow panelist is Ms. Charlotte Garth Landolfini, who's joining us remotely. Hello, Charlotte. Thanks for joining us today. Charlotte is a climate economist and financial expert in the IMF Monetary and Capital Markets Department, focusing on climate financial policy, surveillance, and technical advice, primarily in emerging markets and developing economies. Prior to joining the IMF, she was deputy head of unit in the French Treasury. She started her career in the International Regulatory Affairs Department of the French Securities and Market Authority, focusing on EU asset management, regulation, and risk assessment. Charlotte holds a master's degree from Sciences Po, Paris, the Sorbonne, and in macrofinancial economics and securities law. Our second panelist is also joining us remotely, Marcus Molvak. Welcome, Marcus. He's the senior lead. Hello, Marcus. How are you doing? He's the senior lead climate economist in the Danish National Bank. There he coordinates climate and energy-related analysis and data collection, responsible investment, and climate-related disclosures across Denmark National Bank. Marcus is also co-chair of the climate-related disclosures subgroup of the Network for Greening the Financial System, NGFS, that we have heard many, many times during these 2 days. And Marcus holds a PhD in economics from the University of Copenhagen. On my left here is Daniel Santabarbara. He's head of Advanced and System Economies Unit at Banco de España, analyzing macroeconomic effects of energy and climate change, while also monitoring major world economic and modeling international spillover. And in the field of climate change, his work is extensive. He has contributed to the ECB strategic review of climate change and monetary policy, and actively participating in the work stream scenario design of NGFS. He holds a master's degree from CENFIS program in economic and finance, and a degree in economics from Universidad Complutense. And our local representative, Mauricio Larraín, he has also been introduced in the previous panel, but he's currently associate professor of economics at Universidad de los Andes. He began his career as economist in the research department at the Central Bank. We're very proud of that. Then he served as associate professor of finance at Columbia University, Grad School of Business. Most recently, Professor Larraín, professor now, served as commissioner and later vice president of the Financial Market Commission of Chile. And during his tenure at the CMF, he played a leading role in the strategic initiative focusing on the interconnection of climate change and financial markets. Mauricio holds a degree in economics from the Universidad Católica de Chile, a master's degree in financial economics from the same university, and a PhD in economics from the University of California, Berkeley, United States. And starting next year, I heard that Professor Larraín will be visiting professor at Stanford. So let's start. Throughout this conference, we have already touched upon a lot of issues regarding financial stability. We have discussed a little bit about the impacts of physical risk and climate events like hurricanes and wildfires in the price of real estate, for example, and the impacts on collateral. We have also heard about how that affected the availability of insurance policies, how that affected insurance companies. We heard about that this morning. We also touch upon effects that may cause higher cost of financing for debtors, and how that risk may be translated to banks through risky mortgages or through securitization. We also talked about risk cascades and even tail risks associated with geopolitical risks. We also heard during these days about how financial markets anticipate or internalize climate risk that may also have an impact in house prices, for example. We discussed about how coastal properties prices could be affected by the risk of sea level rise, although it may be long ago in the horizon, or how the markets already anticipate transition risks associated to regulatory changes, to new technologies, to consumer preference, and how they can affect already stock prices and investment decisions today. In the last panel yesterday, we even discussed about the impact on fiscal pressures and governmental debt. So in this panel today, I would like to pose 3 questions to our panelists. The first one is, how does your institution see climate change mapping into your financial stability mandate, objectives, or activities, how that has changed over the past 10 years? In the case of the central bank, the mandate of financial stability is pretty clear, and as our governor mentioned yesterday, we have already been addressing this through our financial stability report, but I would like to hear your views. My second question is the challenges on quantifying climate-related risks. Should those be similar to quantifying other financial stability risks? So my question here is, what do you think are the main hurdles, the main challenges that you have encountered in your own experience? What are the lessons that you have learned in terms of being able to quantify the impact of climate-related risk? And finally, see if you have any view about the strategy of the horizon. For monetary policy, the scope usually extends out to 2-3 years. When we talk about financial stability, it's a little bit longer. The financial cycle may be a little bit longer. But when we talk about climate change, the horizons, as we have discussed these days, tends to be much longer. We talk about 30 years, 100 years, and that brings a lot of uncertainty. So my question here is, what's your view on how that mismatch can be bridged to align incentives to both public sector, regulators, and private actors? So those are the questions. I would appreciate if you want to touch upon some of those, one of those. Maybe we can begin with you, Charlotte. You can give us a broader view from the IMF, from the messages that you've been bringing through the Global Financial Stability Report.
Sure. Many thanks for the introduction, and many thanks for hosting us here. I wish I could be with you in Santiago right now. So indeed, I work in the Monetary and Capital Markets Department of the IMF. So in terms of how climate change has progressively been included within the IMF's mandate, something important to recall, I think, is that in 2021, the board of the International Monetary Fund adopted a climate change strategy. So since then, we've considerably stepped up our climate work in many areas, including in an expansion of coverage, for instance, in Article 4 consultation, and also in financial sector assessment reports. And we've also significantly increased climate-related capacity development. And to deliver these outputs, to be able to do so, country teams in the IMF, they need to be supported with the expertise that is basically at the conjunction of macroeconomics and climate science, but also analytical tools, data, and guidance. So basically on these grounds, something that we do underline a lot is that the overarching objective of the IMF's engagement on climate is to provide high quality, granular, and especially tailored, I would say, advice to the membership of the IMF on macroeconomic and financial policy challenges that are related to climate change. So we have this direct country engagement through Article 4 consultations, for instance, when it comes to surveillance. So every 3 years, we're able to allow covering adaptation and resilience for these countries that are most vulnerable to climate change, and also every 5 to 6 years, for all members when it comes to transition risk management. In addition to direct policy advice and I would say surveillance as part of Article 4 consultations, exposure to climate risk and policy options also to manage climate risk has become an integral part of all the analyses we're underperforming now with financial sector assessment programs, so the stress test. So basically that helps us understand better the potential pressure points for the financial system from the physical climate shocks, but also from the transition to a low-carbon economy. And this bilateral surveillance tool that allows the IMF to better, let's say, inform policies that are needed to enhance risk management and the resilience of the financial system. So we actually published, I think it was a year ago, a staff climate note that actually shows how we are completely embedding, let's say, climate change into financial sector assessment programs. And I would totally advise you to go take a look at that, because I think what's interesting, and that relates a bit to your last question, but is that the time horizon for the EPSAP, for the financial sector assessment programs, is 3 to 5 years. So it's a much shorter time horizon than most stress tests that have been, most climate scenario analysis, I should say, that have been currently performed by central banks all over the world. This is due to the typical time horizon that we have for EPSAPs, and we have to apply the same one for climate change. So that's really, I think, an interesting exercise, because when it comes to physical risks, also transition risks, we applied, for instance, for the UK EPSAP, a Minsky moment approach to stress testing, and so that makes the results, I think, all the more interesting, but also the methodologies that we are sort of tailoring to this special time horizon. Also something in which we apply climate in our work, and that's related to financial stability as well, but that's obviously the IMF supported programs. So within the fund's lending mandate, basically, financing may be provided under IMF supported programs when climate-related measures, they are deemed, let's say, critical to solve the country's balance of payment issue. So, sorry about that, I'm a bit sick today. So basically, the IMF is already providing rapid assistance to countries that are hit by natural disasters. We have facilities for that, the rapid financing instrument and the rapid credit facility, but also we've incorporated climate-related elements in fiscal sustainability programs. So anything related to subsidy reform, to carbon pricing, to financial resilience building, for instance, is now incorporated into programs, and we have capacity development for that. Obviously, we also do multilateral surveillance, so usually that's kind of the tip of the iceberg that you see from the IMF is the flagship reports, like the Global Financial Stability Report and the regional surveillance reports, policy papers, etc. So perhaps to take more, let's say, to be a bit more specific on your first question, when it comes to, for instance, the conclusions from the Global Financial Stability Report, I think something important to note here is that it's been 3 years in a row that in our Global Financial Stability Report, we have a climate dedicated chapter. And something that we do emphasize, first of all, is that not only are climate-related risks per se, so the physical risks stemming from climate change and transition risks, source of financial stability risk, but the gap in climate financing, climate change mitigation and adaptation financing is a risk to financial stability. And so this is building on this conclusion and on the analysis that we do to support that conclusion, that we do a lot of efforts to scale up private climate finance, especially in emerging markets, developing economies. And so the latest chapter that we published in the Global Financial Stability Report about a couple months ago actually shows that and says that there are policy solutions to scale up private climate finance in emerging markets, developing economies, related to structural issues, to cope with macro financial and political risk issues, for instance, but there are also climate-related policies that are needed to be able to support that scaling up of private climate finance in emerging markets and developing economies. And so we do elaborate a lot on financial regulation and supervision, on the need for sound and robust climate information architecture. We also do a lot of work when it comes to, let's say, the need to share the risk of investment, of climate investment in emerging markets, developing economies. And so there, we're doing a lot of work in the context of the operationalization of the new climate lending, a new lending program of the IMF that is dedicated to climate change, that is called the Resilience and Sustainability Facility. And so there, we do support countries not only in solving potential balance of payment issues that would let's say, stem from climate change, but also implementing reforms, fiscal reforms, structural reforms, sectoral reforms, but also financial regulation and supervision reforms to be able to cope with climate change and to be able to scale up the private climate finance that needs to come for this purpose. So this is basically how in the recent years we've worked in incorporating climate change into our work in a nutshell. I would be happy to answer the other two questions a bit later, but I don't want to take up the whole floor, the whole time, so I'll let my colleagues obviously give their impressions as well. Thank you.
That's great, Charlotte. Thank you very much. Actually, Chile is one of those countries that benefited from your views and insights on our FSAP and exercises on transition risk, and also on messages in our Article 4. So Marcus, your turn now. You may want to share your view and also the role that maybe NGFS is playing, not only in terms of disclosure, but trying to address this global topic.
Right, so thank you, and thanks so much for inviting me here today. I would also have loved to be here. I just took over a house, otherwise I would have come, but I think the schedule was a bit too pressed at the moment. But thanks for the invitation. Right, so first I'll say something about the NGFS and how I see its role, and then secondly, I'll talk a bit broader about scenarios and I think some of the gaps that we see there, and where I would think that central banks should dedicate their intellectual attention to in the years to come. But first to the NGFS. So of course the NGFS has been hugely important in disseminating information about climate-related risks to the economy and to the financial system. I think the NGFS has also been important in clarifying that work on climate-related risks is key to central banks' mandates. It's clearly within the mandates. It's important that central banks understand this, that financial and supervisory authorities understand that, and just spreading the competences in this regard. I think many of us now are thinking about what is the central, like the NGFS has grown up now, but then the question is, what will the NGFS be as an adult? So what is the role of the NGFS going to be in the years to come? For disclosures, there are a lot of parallel standards being developed right now. So where does the NGFS disclosure frameworks for central banks fit in with what the IFRS is doing with the sustainability disclosures there, how it fits in with the European regulation and disclosures, these types of things. Private institutions are also developing scenarios now. Where do these scenarios fit in with the NGFS scenarios? I think that's some of the discussions that we will see in the years to come, so some of the questions that have to be settled. So that was my first remarks on the NGFS. but obviously in very important collaboration. I think it's also important that we see more international participation in the NGFS, by the way. It has, to a large extent, been a European-led initiative. Other central banks have made important contributions also, but I think there is a disproportionate representation of Europeans there. So I hope that also the Latin American and the Caribbean region will be happy to continue with efforts there. Then I want to say something on scenarios, because I would say, like, we are developing scenarios at the Danish Central Bank, the NGFS is developing scenarios, the IMF is developing scenarios, we just heard that from Charlotte. I'm not always so convinced with these scenarios that different institutions are developing. And I think there are some problems with many of the scenarios. And I think this is a key concern when quantifying the climate-related risks, and also when thinking about this question about the temporal dimension and perhaps the temporal mismatch when doing monetary policy. Because, and my point is, I'm not always so sure that it's the structural transformation in itself that climate change or that the energy transition causes. I'm not so sure it's the structural transformation in itself that's the key loss, that's the key risk from climate change, from the transition. It's more about an increased lack of resilience. And I'll give some examples on this. So, as you know, in particular in Europe, last year energy markets underwent a lot of stress, underwent a lot of change due to Russia's invasion of Ukraine. The decision of Europe to rely on Russian natural gas rather than domestically produced coal, that was a decision made out of climate concerns. Initially, this was a cheap decision to make because Russia supplied a lot of stable, cheap natural gas. But then, once this geopolitical shock, Russia's invasion of Ukraine hit the globe, or hit Europe, then the decision to rely on Russian natural gas became quite expensive. So this is an example of climate-related decisions, the shift away from coal to gas, colliding with a geopolitical shock, and then the interaction between these two shocks has some very big effects, but like the transition in itself, so the climate shock itself does not have an effect. Other examples of this is climate change causing migration, causing geopolitical risk. Again, climate change in itself might not be so economically important, but it causes some other things to happen that then has some economic effects. Or, as a third example, on average, looked over a year, solar and wind energy are cheap and reliable energy sources. But if you're looking at it from a day-to-day or from an hour-to-hour perspective, there are some real issues with resilience, with security of supply from solar and from wind energy. So we might see larger price swings at the short term, at a high frequency, while we have looked at it at an annual average, resilience from oil and gas. From solar and wind. These are some of the things that central banks need to understand. Well, so what do these short-term price swings mean for inflation? What does it mean for your inflation expectations? Is it going to be more difficult to anchor inflation expectations in the future? This is something that we'll have to consider more. And again, the point is that some of the risks, they might have like a climate cause originally, But then it will come in the form of a weather shock, or it will come in the form of a geopolitical shock, it will come in the form of a migration shock. But looking back at the origin, then there might be some climate-related issues that cause this to begin with. So I still don't think we have come very far in the modeling of climate-related risks. And I hope that central banks and researchers will be able to dedicate their intellectual attention in this way in the years to come.
Thank you, Marcus. So you see forthcoming many changes and improvements in terms of scenario analysis. You raised very interesting topics. The different taxonomies that impact disclosure, what's one of the issues I guess we're going to discuss here as well. The evolution of the tools, right? So the traditional tools that we have to measure financial risks need to still improve. And you raised this issue on geopolitical tensions and that may affect scenarios. I think to touch upon many of those topics that we have discussed in the previous sessions of this conference on the relevance on energy supply and migration. Thank you, Marcos. Let me now move to Daniel to hear your perspective from Banco España. I saw that you have made a great progress, and maybe you can tell us a little bit about this new report that puts together all the analysis of the macroprudential authorities, and I think that's going to be a good benchmark for many countries. Daniel.
Yeah, thank you very much for the invitation. It's a great pleasure to be here with you in this amazing conference. I learned many things. Thank you once again. The second thing is that I'm from DG Economics in the Bank of Spain, and then, these are my views. They are not the financial stability views, but this is my understanding of what is on the financial stability front. But apologies from my colleagues on financial stability if not, if they don't share my proper views. Yeah, let me talk a bit about this report. No, the ANSTENFI is the new macroprudential authority in Spain. It was set up in 2019, and then mainly it adds the roles of the three regulators and supervisors of the financial sector, namely the Bank of Spain, the National Securities Market Commission, and the DG of Insurance and Pension Funds. And then, the law that rules this, the climate transition and the policies has forced to this entity to publish a biannual report on the climate change risk for the financial sector. No? This report has been published recently, this summer, and there has been a collaborative work of these three supervisory authorities. No? And then the role of this report is just to try to have a common framework to establish what are the risks that the financial sector is facing. No? And then the structure is quite straightforward in the sense that first they talk about transition risks, and mainly this considering a common scenario for all the financial sector, that is mainly a disorderly transition scenario in which carbon prices are going to increase abruptly, and another scenarios on physical risk. The problem of the scenarios of physical risk is that they are not going to be comprehensive and not going to be harmonized. No? And then this first scenario on transition, it has some impact on market valuations, and on top of that, there's some impact on the solvency of the banks. No? And then the report has found what has been the impact on the investment fund portfolios, in the pension funds, and also in the insurance companies. No? And in the banking sector takes into account two factors. No? One of them is what's going to be the implication of the drop in market valuation of these more polluting firms that will be affected by this disorderly transition scenario, and also the effects on the solvency via the great expositions. No? On the physical risk, the report recognized that this that this analysis is in an early stage of development, and that there are a lot of limitations in the data. There is not much historical information. I will talk a bit later on this. No, And then they recognize that the analysis on physical risk has been very limited. It has to improve in the next report that is going to be published in 2 years. In this edition, there is only covering 2 topics. No? What is the impact of the drugs and the heat waves via labor productivity in the banking system? And the second phenomenon is what could be different water shocks affected to the capital of the insurers. I think that the report really is a very good first step, to compile and just to share methodologies and to share knowledge about among the 3 regulators in the financial system. I hope that in the next editions, the analysis, especially in the fiscal risk, will improve a lot. Related with the last point, I would like to stress what are a bit the limitations that assessing the climate risk has in comparison with other risks. No? I think in the second question that you were doing, was saying that the financial institutions could see financial risk could see climate risk as a traditional financial risk. Mm-hmm. And to some extent it's yes, no? Because it's going to be mainly located with credit and market exposures to other sectors. No? This will going to be the traditional credit risk channel, the market risk or liquidity risk. No? And then, that we can say that it is more or less the same framework. But there are some features that make it very much different. No? Especially that we don't have enough data to assess properly these risks, and also the quality of this data is very limited at this stage, and the techniques of analysis are to some extent very much different. No? Let me elaborate a bit on this point. On the first point, we need high granularity information. No? Because this risks vary very much between industries, between sectors, between firms, even between households, no? Even among geographical localizations, no? Even between companies could be very much different because the technologies that you are using are very much different, no? And they may be facing different transition risks, no? Or even between households in the same municipality could be also quite different, because some of them could be located, their houses close to riverbanks or the coastal beaches, and others not. No? And then we need a really granular data, as on this conference has been amazing, the developments that has been in this front. No? On the other hand, mainly the assessment of the climate risk has been the assessment of financial risk has been in many cases backward-looking, but we need much more forward-looking analysis, no? Because with the past, we cannot estimate what's going on, no? As previously. No? We need now just to incorporate that we don't have much information neither on physical risk nor in transition risk, because some of them has not happened yet. Even that we need longer time series to estimate there. Even that they happen, the duration is very short for doing this kind of analysis. No? And also we need to estimate the spillovers between sectors, the interlinkages, and between the real and financial sectors. No? And another thing that is very much different with the previous approach is that here for instance, the transition policies are designed to make the households and firms to react and to buy inputs or to buy goods that are less polluting. No? And these kind of things we have to consider that the economic agents will react to the transition policies, and it will imply that this consideration has to be dynamic, meaning in comparison with this some static consideration of the risks. And also, we are facing, that is very much related with the points I was talking before, we are facing enormous uncertainty. We might face possible tipping points, and then in these conditions, I think it's really difficult to estimate some kind of probability of default or loss given default or whatever. No? And I think my impression is that the best tools that, from the financial perspective, we can have to assess this financial climate risk is doing some kind of sensitivity analysis or top-down stress test. No? That is a methodology that we can use to have an idea what could be the climate risk. And then the issue of the stress test is the tool that we have been using in the Bank of Spain to assess the climate risk, either the transition risk or the physical risk. And the point here is that it's very needed to clarify which are the assumptions that we are taking, and to clarify that maybe this is just an illustration of what could happen, but not overestimate the power of the stress test.
You raised very interesting topics. I was suspecting somebody would raise the issue on data gaps and the granularity of the data that we need. So Mauricio, you have a great challenge now to bring this to the local scenario. I guess that most of the topics that we have discussing here on coordination of authorities are things that we have been discussing previously in Chile as well. So as former vice president of the CMF, or currently as an academic that I'm sure will follow on interests in sustainability, what's your view? What are the lessons that you learn about this topic?
Yes, thank you, Rosario, for having me in this panel, and thanks to the audience members for sticking until the end. And also thanks to the rest of the panelists. So, how to quantify the effects of climate risk on financial stability? It's a hard question. There are many challenges, but in my experience as a board member of the Financial Market Commission of Chile, I can think of at least two challenges. So the first is related to information, data, transparency, disclosure. So at the very least, if you want to quantify the effects of climate risk on financial stability, you have to understand as a regulator what is the exposure of the different financial institutions, banks, insurance companies, etc., to climate risk, and exactly how are they mitigating, how are they managing that climate risk. So that's the very basic. It's a necessary but not sufficient condition to try to quantify these climate risks. And disclosing information about climate risk, it's tough. It's not like when a company discloses its sales or its cost. Disclosing exposures, scenarios to climate risk, it's much more challenging. And moreover, there's more than one international disclosure standard, which makes it very difficult for investors and regulators to compare the exposure of different financial institutions to these type of risks. So what we did at the Financial Market Commission, by the way, Rosario was also a board member of that same institution some time ago, is we published a regulation in which we require firms in the real sector and also financial institutions to disclose their exposure to climate risk and more general to sustainability risks, and to explain how they manage those type of risks. And in order to make that disclosure comparable across institutions, we ask them to do it according to TCFD, which is the standard disclosure, international disclosure standard for this type of matters. So that's one challenge, information disclosure, and that's one practical way in which we at the Financial Commission at that time tried to address that challenge. And then the second challenge, which Daniel mentioned it as well, is you have to model climate risk, but it's very different than the way you model credit risk and the way you estimate the default probability or the loss given default, because for the standard risks of financial institutions, credit risk, market risk, operational risk, you use historical data. That's the standard way to do it. We've always done it that way. But you cannot do that for climate risk. First, because you have limited data, and also because climate risk is a moving target. So how can you expect to use information from the past to try to predict what's going to happen in the future if everything is changing? So that's a big challenge. So the models have to include, as Daniel was saying, some type of forward-looking component, and that's something difficult to do. What I'm trying to do, Rosario, right now is a research project with some people at the CMF to try to understand how different climate shocks affect the credit risk of firms. So we compiled a very nice data set on different types of climate shocks. Heat waves, floods, wildfires, 10 different types of climate shocks at the very granular level, at the county month level. And then we crossed this with the data or the credit registry data that we have at the Financial Market Commission, which tells you exactly where's the location of the firm, and you know how much debt the firm has with all the banking sector and whether the debt is in default or not. So then we ask the question of what happens when a firm is located in a geographical area that suffers a big negative climate shock. Does it have more difficulties in paying the debt to the bank it owes? So the idea basically is to try to calibrate the elasticity of credit risk to these different types of climate shocks, to try to advance on this idea of modeling climate risk, and therefore finally trying to quantify the effects of climate risk on financial stability.
Very interesting. Looking forward to that. I guess that we have made some progress, the Chilean authorities, regarding first measures of impact of physical risk, first measures of transition risk. In the morning, somebody commented about the process that the bank has been doing in terms of providing statistics and on carbon emission. That will definitely be a source of information for research. But we also saw today at some of the sessions that the information provided by companies in their filings to securities regulators can also be a good source of information for research. So we'll wait to see what kind of disclosure the companies provide to the CMF and see what they say about management of climate risk and also ecosystem degradation. That is something that we haven't touched upon so far. So in this second round, I would like to ask you if you want to touch upon more frontier issues that you are working. I know, Charlotte, that you've been working on some technical notes that I think they were released today. Want to tell us a little bit about that?
Yes, so I can touch upon that. Sorry, I had to turn off my camera. I'm sick, so I was coughing like super hard. So, I mean, first I wanted to say that I totally agree with all the points that have been made, and especially on on data gaps. I mean, this is an issue that we're working very extensively at the IMF, both on the technical side, working on aggregating actually climate-related monetary and financial statistics, and also on the policy side, we're supporting lots of countries in the, let's say, design of their alignment methodologies. For instance, when it comes to transition taxonomies, transition planning frameworks, but also data collection related to that. So this is a great area of work, and in the NGFS, we actually had co-chaired a work stream on bridging data gaps in 2021, 2022, and some of the conclusions that we had made as part of the final report that I believe was published in July 2022, we actually are trying to implement them as much as possible. So I totally agree with the points that have been made there. And I think, it's not like we have to reach perfection anyway. I think the challenge here is to be able, as Eva said, to assess the exposure and to be able to understand a lot of the other, let's say, effects stemming from physical and transition risk there. But when it comes to climate risk analysis, and this has been raised as well, I mean, obviously there are lots of challenges. that are related to the variety of scenarios to reflect the high degree of uncertainty, also let's say, the difficulty to predict some of the physical and transition risk drivers, the fact that they are intertwined, also compounded risks, I think, is receiving more and more attention in the NGFS, in the Financial Stability Board, in the IMF, and every central bank, that is working in that area. Something that we're looking at in the FSB, for instance, in the Financial Stability Board, I co-chair one of their work streams on climate data and vulnerabilities. It's the second round effects and the interlinkages as well across financial institutions. I think that this is something that has not received a lot of attention so far, but considering the interdependencies across, within, I should say, the financial system, this is something that is receiving more and more attention. And this is in parallel, obviously, to all the work that has been told today on data availability and on modeling interlinkages as well. Actually, when it comes to the IMF's work, so indeed we published actually today what we call a staff climate note. It's like one of the, let's say, publications of the IMF when it comes to climate change. And we published a staff climate note that is directly related actually to scenario design. The exact title is Geoeconomic Fragmentation and Energy Transition, Implications for Climate Scenario Design. And so this staff climate note that you can find on the IMF website, the motivation stems from a very simple fact, is that right after the start of Russia's invasion of Ukraine, and the whole weaponization that Marcus talked about, actually, of energy supply, that led to that renewed prioritization of energy security and rising geopolitical tensions. And so right at this moment, in February, March, let's say 2022, we started thinking, on the implications of geoeconomic fragmentation and the pace and the rate, I should say, also of the energy transition for climate scenario design. And so basically we started thinking that, given the, let's say, the long-term nature of the energy transition, what would be the structural implications of this so-called polycrisis for energy and climate policies, and how should the design of scenarios for climate risk assessment actually accommodate this new reality? And so on this basis, we have published this note that basically on the first hand, let's say, makes a diagnosis on the impact of the polycrisis on the global transition to a low-carbon economy. We look into carbon lock-in, the fact that even though we've seen a formidable, let's say, increase in renewable energy investment, there is still a lot of investment in fossil fuel capacity, including new fossil fuel capacity, especially in emerging markets, developing economies. We see that that generates an amount of carbon lock-in in response to that energy crisis. This has political economy consequences. And that's actually quite consistent with the fact that globally energies have that symbiotic relationship with each other. And so we are doing and have published already some work on the likelihood of oil and gas, analyzing, the likelihood of oil and gas to actually being able to transition to low carbon activities. Is it a decarbonization of oil and gas operations, or is it a diversification of their activity? So in our diagnosis, we talk about that. We talk about the prospects for renewable energy as well. Obviously, in this note, I should have said that from the very outset, but we take, let's say, the tail scenario, right? We're not forecasting. I mean, obviously, there's a slight difference between the two, but we're really thinking, when you're doing risk management, you should think about some of the worst case scenarios, basically. And the disorderly transition scenarios, we believe they could even go further to adapt to this new reality. Mm-hmm. And the reason why I'm making this parenthesis is that in our diagnosis, for instance, when it comes to the prospects for renewable energy, we're really looking into the likelihood of that continuous cost reduction of low carbon versus carbon intensive energy. And we see that this likelihood is decreasing. We see that low carbon technologies that could be affected more heavily by the current high rate environment and higher for longer rate environment than carbon intensive energies, for instance. So we are doing not only this note, but also more generally in our work at the IMF, quite a lot of analysis on this front. And in our diagnosis, we also look at the policy responses to geoeconomic fragmentation and macroeconomic shocks. So monetary policy reactions, but also fiscal policy reactions to high public debt and fiscal deficits. And we say that basically all these more frequent global shocks, they may lead to structurally, lower global growth. And so this is on this basis that we do, in the second part of our note, look at, let's say, underline preliminary suggestions to accommodate that new reality. So we make a lot of recommendations related to the scenario implications of the consequences of this poly crisis. We're not doing the work ourselves, even though some of this work we are, but we believe that this should be a collective work to be done, obviously. We believe that some of the recommendations that we're making, they're totally feasible in the near term from a technical perspective. Some of them would require more work, but we really believe that there are scenario implications from the disorderly transition, carbon lock-in, the prospects for renewable energy, and the geoeconomic fragmentation and macroeconomic shocks. And so we make a series of recommendations in that note to accommodate for that. And obviously, we are totally on board as well to totally, let's say, implement some of that in our own climate risk analysis. This is actually totally in line with a note that was published last fall, so in 2022, in November, I believe, by the Financial Stability Board and the NGFS on climate scenario analysis. I think the Banco Central de Chile has actually participated to the survey, if I'm not mistaken, of central banks that elaborated upon climate scenario analysis challenges, the opportunities, the need for comparability, the tailoring of climate scenarios to the current reality, etc. And so the IMF is totally willing and obviously doing so already, but to cooperate much more also on these grounds. And I think this is in line, if I'm not mistaken, if I understood correctly, Marcus, with some of the points that Marcus made at the very beginning.
Absolutely.
Yeah, I'll stop here. Sorry, I put up hours on that. I think this is a fascinating topic that we're touching upon together.
So I guess it's also very late where Marcus is located, so maybe you can bring us some ideas from the future. You may have a few hours ahead, right?
Right. Yeah. So I actually, so what Charlotte said, I think it's on point to what I'm saying, that we need to look at the interactions between different risk channels. So what I'm hoping that where we'll be in a few years is that we have a more integrated approach, so that we have climate, and then we have say nature-related losses, geoeconomic fragmentation, effects of say demographic change, and then all the other risk channels that we are used to looking at, have them in an integrated approach. Because reality is integrated, so we also need to look at these risks integrated. I'm not sure it's so fruitful to single out the climate-related risks as as a standalone source of risk. These things interact with each other.
Fully agree
I
with
think
that.
perhaps touching a bit on that also, there are some discussions about whether we should change capital requirements, risk weighting, to better factor in climate-related risks. From the perspective of the Danish National Bank, we cannot rule out that this might be a good way to do, but we are not so far convinced that there's actually a need for this, because again, climate-related risks is just one other source of credit loss. It's just one other source of market risks. It's just one other source of operational risk. So perhaps it's better to have like a general risk-based framework than to again begin making too many ad hoc adjustments here and there. But of course, if you have a certain risk type where you thought it was not material historically, but it may be material in the future, then there may be a case for adjusting something. But again, I would be worrisome about singling climate-related risks too much out, for instance, as compared with geopolitical risk.
You raised an interesting topic, and I guess that that kind of tools would definitely change the incentives for banks to internalize those risks, right? But let's start with disclosure for so far. Thank you, Marcus.
Sure. I mean, if you begin to, if you want banks to internalize the risk, or which you of course want to do, that's just risk management. But just remember, from the perspective of the Danish Central Bank, I would say it should be risk-based still. So we should not adjust over and above what we can justify on risk-based grounds. And then if you want to actively support the green transition, then there are government investment funds, there are government subsidies, carbon taxation, that we have these instruments for doing that, fiscal tools. We don't need financial regulation or monetary policy to do that.
Absolutely, but interaction with the private sector is still quite relevant, right? Even to create awareness. Thank you, Marcus. We have a few minutes left, and I would ask Daniel if you can tell us a little bit about ecosystem degradation, biodiversity. It's also on the topics of the conference, and so far I think we haven't touched upon that. So if you can briefly refer if you have doing something like that in Spain.
Yes, sure. I found also the point of Marcus very interesting, no? Because I think that the financial stability has some kind of trade-off. No, on the one hand, they need to they have to ensure that the banks recognize the climate-related risk. No, but on the other hand, the transition process requires that a lot of funds will be directed towards the transition. No, that means a lot of investment, and then the financial sector has to help to channel these funds. No, and then to some extent, that it generates some kind of frictions within the mandate. No, because on the one hand, it needs to recognize these risks, but on the other hand, it needs to try to allocate the funds, or try to encourage the banks to allocate the funds towards the green transition. So, I have the impression, as well as with the monetary policy, that the financial stability policy has to promote, the objective of the governments, but it's not an instrument per se. They have to go and try just to go for the primary goal of recognizing these risks, But but on the other hand, that these kind of measures just to try to change the risk weight, or to try to make a different incentives to go for green activities could pose significant risks, for that. Even I'm thinking, for these activities that currently are brown, but are going to transition to green, what are you going to do with that? Will you classify as brown? Will you classify that they're going to be green? You need to follow these things. I think that this is really interesting. In the monetary policy front, we have some kind of the same of tensions, because also the government is trying to use or try that the monetary policy collaborates in the objective, but we have another goals, and sometimes it's not so easy. I think that we should recognize that the mitigation and adaptation policies is mainly the task of the governments, and then financial supervisors, financial regulation, and monetary policy, the only thing they can do is only help, but they are the ones that first are elected democratically. We are not. They have the tools, and they know what are going to be the consequences of these policies, for instance, in terms of the inequality and other kind of distributional aspects, and I think that governments should take their part, take the lead in all these policies. And thinking twice, I don't know what's the role of the monetary policy or the financial sector policy on top of helping. Yeah, on the ecological degradation, I would like to talk a bit about the what has been a bit the strategy to analyze the climate risk in the Bank of Spain. And then at the very beginning, we started to analyzing the transition risk, because we were thinking they were the ones that are going to materialize first, and then we have to put the resources, and then let's go for the transition risk. But we were discovering, at least in the case of Spain, that physical risks, especially the acute risks, are materializing much faster than expected. And then now we are trying to better understand what could be the impact of drought, heat waves, of floods, wildfires, aridity on the credit, and also on the collateral. And we are setting up some kind of a research agenda to understand what are the implications for the financial sector and from the macroeconomy of the physical risk. Sorry. But one thing that I think is not so common for a central bank is also we are doing some preliminary analysis of what could be the effect of the ecological degradations over the economic and financial variables, no? Especially in this case, it's going to be through the collateral channel. And then the idea is pretty simple, no? In Spain, we have the largest salt lagoon in Europe that is called Mar Menor. This is in the south of Spain, southeast of Spain, that is in a region called Murcia, that is very quite touristic. And then this lagoon, this lake, has been facing a process of ecological degradation. The process is called eutrophication, no? And mainly is because in the lake they are going, given the agricultural use of the surrounding area, they are going a lot of nutrients, and then the alga is growing very much in the lake. But then at some point it means that the alga were so dense that they were not letting the rest of the life living there. And then the dead matter began to decompose, and then there is a process in, feces that have enough oxygen, especially when the temperatures are relatively high, and then you see in the place that you have your house, you see that really you are surrounded by a lot of dead fish. No? And then the question is, if this process of ecological degradation has an impact on house prices of this area in comparison to an area that is pretty close, that is the southern part of Alicante, no? It's very far away. No? And then with the process of diff in diff, the issues we try to analyze since this phenomena started, what it was in 2015, if the value of the houses has changed in a statistical different way between the two areas, no? This Mar Menor and the south part of Alicante. And then Lamas, that is the paper, and Gabriel Perquiros found is that, that it really had an impact, this ecological degradation. No? And the prices of the houses in the Mar Menor has been 45% lower than the prices in the south of Alicante. No? And then, the prices has grown 45% less than in the south of Alicante. No? And then it implies that the people really, with some lags, discover, that they don't want to have their vacation there, and they don't want to go there. And then this process has some kind of impact on economic variables. But house prices also are the collateral of the loans in this area, no? And also has some kind of financial stability implications. And it's quite interesting because also, the amount of the mortgages that the banks are providing in this area is also around 40% lower than the amount of the mortgages that is provided in the control area. No? Meaning that banks have also incorporated, that these developments in their decision taking. No? And then in this way, we found a way just to think about how ecological degradation will affect financial variables, and to some extent will affect financial stability. Obviously, this is a very little region, and it's going to affect financial stability, in a broad manner. But okay,
it's very interesting what you can do with very granular data.
Yeah.
And it resembles a few cases that I think we could do also in Chile. Mauricio, I know you're a very generous guy, so what would you like to do with your 5 minutes?
I would like to
open the floor for questions from the
because
audience.
it's 6:30, so I think
You're very generous.
yes.
So, do we have any questions from the floor? Elias.
Sorry, that's it. Yeah. Thanks for the interesting conversation. So I guess a question for Mauricio, also Rosario, that you've been sitting, you were sitting at some point at the financial regulator in Chile. So indeed, there are some initial steps in terms of disclosure. I'm wondering how you see the next steps in terms of first disclosing the double materiality, because if I understand the way the disclosure works right now is that it's really disclosure on the exposure of the self-declared exposure of firms on different risks that may arise, but not on the impacts that they have on climate or not even going broader to the broader environmental issues, just on climate. And second, which I think is the more important step, when or how do you see this process flowing into actual pricing in terms of charging higher APRs to firms that have higher risks? I mean, when do we see the money in this? How do you see this process going in Chile? Thanks.
There's a strong debate, I guess, in the CMF on these topics.
Thank you, Elias. So the issue about double materiality, just as a reminder, is two sides of the same coin. First, how a firm affects the environment, and then the other side of the coin is how the environment affects the firm. And as Elias said, the disclosure regulation in Chile only focuses on one direction of the coin, which is how the environment affects the firm and what does the firm do in order to mitigate, to alleviate, to manage the risk coming from the environment. And why did we do it that way? Because by law, the securities law in Chile has to protect the investors. So the disclosure regulation was thought always for the investors. And the investors have to have the information about how the environment risks are affecting the firms in which they are investing, so the investors can select which firms are more sustainable in the long run. So that's the reason why we only choose one side of the coin of double materiality. And I don't think that's going to change. But it's because, again, the law is very clear. It's the securities law, 18.045. We have to think about the investor's point of view. So the regulation is done from the investor's point of view. So that's a partial answer to your first point. And then to the second point, I mean, there's two angles. One, you said APR, so you're thinking about Basel III additional capital charges?
Yeah, weighted.
Yeah, so I'm not...
As Marcus mentioned.
Yeah, so maybe Marcus can say a little about that. But there is a second dimension, which is in asset prices, something that Johannes early in the morning mentioned, that there's a market incentive here, that if a firm has high exposure to some type of environmental risk, climate risk or biodiversity risk, and it's not really hedging, it's not really mitigating that risk, and it's disclosing that to the market's going to punish that firm in the sense that maybe a pension fund manager is going to reduce the exposure of that company in its loan portfolio, reducing or producing some sell-side pressure, reducing the price of the stock, and therefore increasing the cost of capital. So I've always seen that there's a market mechanism in which this more disclosure provides incentives for firms to undertake more sustainable activities. But that's the way I see it. But maybe Marcus can tell us a little more about the...
I guess we have enough material for a workshop on financial stability implications of climate change, maybe. I think it's quite late here, and it's probably much later where Charlotte and Marcus. So I would like to thank each one of you for joining the panel, to the audience here to staying with us. And just a few conclusions. I guess it's pretty clear that climate change and ecosystem degradation certainly poses challenges for central banks, for financial authorities, for policymakers in general. We have a lot of work to do on understanding and assessing potential impacts and threats to financial stability. We need to refine and develop our tools, our capacities. All tools may not be sufficient. Scenario analysis, stress testing are definitely going to help, but we still face challenges in terms of data gaps, have to face these horizon issues, and I also trust that disclosure statistics are definitely going to be good inputs. International cooperation and coordination among authorities also highlighted as an important topic, and I understand that some of the measures needed to address adaptation mitigations are responsibility of governments, but still I really think that from the point of view of central bank, we can play a relevant role in generating knowledge, generating information that can also help financial institutions and market participants to internalize those risks and to also play a relevant role in mitigation and transition. And finally, I think we do have a role to play in raising awareness. Conference like this, I really believe that can also help to raise awareness about the risks posed by inaction, and I hope that's some of the messages we can deliver. So based on that, I guess we can close. We can give ourselves an applause, and thanks for joining us. Thank you, Charlotte and Marcus.
Thank you so much.
Take care.
Yeah, thanks for having us.
So thank you all for sticking with us until the end. Thank you to the panelists for a great discussion. And I would like to close this great conference. We had two intense days, but I think we got very useful lessons, and a lot of questions were partly answered, and we got many more. So this is the way it should be. So thank you all. And now I would like to thank all the people involved in the conference. First of all, the board members for their continued support. This is why we have the 26th conference this year. This has been running for a long time, and we're very proud of this conference. And hopefully it will run for some 26 more years, maybe. Thank you to the organizers, Elias, Gonzalo, Max. This was a joint effort, and it has been great working with you. And to the team that was behind this whole event, that made this possible, Daniela Gaete, Alberto Undurraga, Daphne Gilov, Constanza Mantelli, Graciela Román, Carolina Besa, María José Reyes, Felipe Córdoba, Gloria Peña, Rosario Celedón, Mariana García, Juan Guerra, Silvana Celedón, Juan Pablo Rioseco, as you see, many people involved. The team from the Marriott, from the hotel we're in, the team from RLA, the technical team that made the whole thing possible between the online and the in-person presentations, and the team from Seis Sentidos, which are in charge of the registrations. So thank you all, and let's give ourselves a round of applause. In joining us in this conference.